So good morning, everybody, and welcome to the 7th Annual Financial Stability and Macroprudential Policy Conference. So as you know, this is the second day of these two joint events, but as probably was reminded yesterday, they have to be considered two separate events, but they are together also, hopefully also logically connected. So today's conference is more about financial stability more generally, not only on non-bank intermediaries. As you will see, the program is more focused on banks, but I would say it's also more general. And I'd like to thank also you for participating. Also, all my co-organizers, some of whom are here, most of whom are here for the excellent cooperation. You will see the program is really excellent, and I also thank the speakers for accepting this really high-quality program. So with that, perhaps I just leave the floor to Ellen Neer from the IMF, who will present the first paper. As you know, it's 25 minutes presentation and then 10 minutes discussion and 10 minutes Q&A. Okay, thank you.
Yeah, thanks so much, Livio, for the introduction, and thanks for inviting the paper to the program. It's great to be back at the ECB conference on financial stability and macroprudential policy. I'll wait for the slides to come up. So we're interested here in how high interest rates affect the banking system, and in particular the role of interest rates on loan losses and the potential for macroprudential policy to attenuate these kind of adverse effects. This is joint work with colleagues at the IMF, Romain Bouy and Soumaya Mirza. We're all in the Monetary and Capital Markets Department. And as a result of us being affiliated with the IMF, the usual disclaimer applies. The views expressed here are our own. Let me try and motivate a little bit what we're doing in this paper. So why are we interested in what high interest rates do to banks? We've seen high interest rates, of course, recently in the wake of the COVID-19 crisis, when policy rates went up globally. I think the observation is that this increase in interest rates had sort of mixed effects on banking system stability, or let's say several effects. So we've seen in some countries that a drop in the valuation of fixed rate securities can have adverse effects on banks when they hit the profit and loss account or otherwise, causing bank failures in some countries. Silicon Valley Bank was the example in the United States. With time also, as the IMF has warned in 2023, higher interest rates could well lead to higher loan loss provisions, credit risk increasing. And I think we've seen some of that come through in the data as well. But then thirdly, there is an effect that actually potentially offsets the adverse effects, and that comes through high interest rates boosting the net interest margin for banks. And I think the ECB has written about this in several of its financial stability reports. So ambiguous several effects that could partially offset each other. The empirical literature finds a nonlinear relationship between bank profitability and interest rates. That is, profits increase with interest rates, but at a declining rate. And the several papers here by Borio and others, and Claessens and others, are still written in the era of sort of low for long, right? So here in our paper now, we ask three questions. Can higher interest rates weaken banks, and through which channels might that occur? Second, what type of bank is vulnerable to that increase in interest rates? And the third question is, can macroprudential measures reduce such adverse effects? And I'm going to give you a little preview of our findings here. So what we do is we analyze this issue in using a large cross-country panel of banks that are from 31 countries, most of them advanced, some emerging market economies, and we follow these banks all the way from 1995 to essentially today. And we find and document in our study that indeed high interest rates pose risks to banks by increasing their loan loss provisions and also by reducing their non-interest income that is affected when banks are selling securities at a loss, while the effect of the net interest margin is positive. We secondly investigate heterogeneity across banks for each of these components of profitability. So we find that the effect on loan loss provisions is stronger for banks that extend loans at variable rates, and it's stronger for banks that take more risks ex ante. The effect on non-interest income through the losses on securities is weaker for those banks that have high liquid assets, because that makes it so that banks aren't forced to sell securities at a loss. The effect on the net interest margin, we find, depends on the funding structure of the banks. Banks with more deposits in their funding structure gain more in terms of a boost to net interest margin. But also there are effects that depend on the interest elasticity of the loan book, and we'll come to that as we go along. Overall, we find that indeed the effect on profitability can become negative for certain types of banks. So it's not always positive, in contrast to the sort of the headline finding that we've seen from Borio and Claessens. So there's something to worry about. And in that context, we explore the role of macroprudential policy measures in attenuating essentially the adverse effects that come through higher loan loss provisions. And we find that focusing on the borrower-based measures that are well known, I guess, to the audience, LTV, DSTI type measures, we find that if you have taken those measures ahead of time, the impact of an increase in interest rates on loan loss provisions is attenuated, is reduced. So this is essentially supporting banks' resilience to macro shocks. These findings, we think, complement very nicely findings in the literature that already exist at the macro level. So Boisset and others have a paper that shows that as interest rates go up, if a country has taken more macroprudential measures either ahead of that increase in interest rates or just at the same time, that helps in reducing the probability of a crisis. And I think José Luis has similar findings in his work. What we're doing here is we're looking at this at the bank level, bank by bank, and we thereby add to the small literature, I would say, that looks at resilience benefits of macroprudential policy measures and borrower-based measures in particular. So a lot of the literature on macroprudential policy measures focuses on, in the short term, what happens to credit and asset prices as these measures are introduced. Here we're looking at the resilience effect, essentially, of these measures, asking if you have taken these measures, do they help, potentially several years ahead in reducing or in helping to stabilize the system in the event of adverse shocks. Okay, let me just go through some of the conceptual framework and the empirical approach here first off before I go deeper into the results. So as I said, there's potentially 3 ways in which higher interest rates can affect ultimately profitability that we measure by return on assets. So it can have effects on the net interest margin, in particular, if your loans reprice faster than your liabilities reprice, you're likely to see a boost to your net interest margin from an increase in interest rates. But there are sort of 2 risks to your bottom line, to your profits, that also come from high interest rates. One is it can reduce the value of fixed-rated securities, and that can hit your profits, in particular when you're forced to sell those assets at a loss, or if your assets are marked to market. And the final effect, which actually is going to be in focus so much of the paper, is if you have higher interest rates, that can lead your borrowers to default. And so one effect works through the debt service. Higher interest rates can affect the debt service of borrowers, and they may end up defaulting on you. But also, higher interest rates do something to the macroeconomy, right? They will slow growth, they will potentially increase unemployment, and that can have an effect on borrowers as well, and they may end up defaulting on their debt on you. So 2 risks to profits here, and one factor, the net interest margin, that can help offset potential risks to profits and can sort of potentially act as a hedge. The empirical approach here is to do dynamic panel regressions for the banks, 950 banks from 31 countries, where we look at each of these components as well as the overall effect on return on assets. And we have in the regression the 3-month interbank rate as our measure of interest rate, as well as its square. We use quite a bit dummy variables that capture certain characteristics of the banks. An example of this is we have a dummy variable that captures whether or not the loans extended by the bank are primarily at variable rates or not. And using these dummy variables, we essentially do interaction exercises where we ask, do these characteristics affect the extent to which high interest rates affect the bank? And then we have a vector of macroeconomic indicators, including growth of GDP, unemployment, house prices, and so on and so forth, that vary for each country through time. We have a vector X of bank controls that, again, are variables that vary through time. We have a crisis indicator from Levin and Valencia. And we have bank fixed effects as well as time fixed effects as well in the regression. I want to explain a little bit one innovation that we have in the paper, which is, again, to construct an indicator of whether or not loans are extended at variable rates at the bank level. So this is a bank level indicator of how variable is, how flexible rate is your loan book, essentially. And we compute this. Essentially, the starting point here is there's no really very good information internationally on, what is the rate, what is the degree to which loans are at variable rates, at fixed rates. So it's not easy to get information on this. We start by classifying countries into highly flexible, less flexible, and fixed mortgages, because there's quite a bit of variation across countries on that dimension, the mortgages in particular. And then we compute the share of mortgages in the overall loan book for each bank. And we get a sense of how exposed is the bank to the mortgage market. So that leads us to classify as flexible rate banks essentially two groups of banks. One is all banks in countries where the mortgages are essentially extended at variable rates. So that's Australia, Finland, and so on. So if you are a bank from Australia, you're going to be assigned, you are a flexible rate bank. There's also, of course, countries like Canada, Germany, France, where more of the mortgages are at fixed rates. And here again, if you are, let's say, a bank from Germany, you can still be assigned to be a flexible rate lender if you don't extend so much mortgages, but you rather extend more corporate loans, more loans to consumers that tend to be at variable rates even in those countries. Okay, so that gives us a measure at the bank level of how flexible is are your loans. Then we have a second innovation in the paper, the Macroprudential borrower-based index. So this is an index of essentially the intensity of, or the tightness of borrower-based measures in a country. And we compute this by looking at the available data from the IMF Macroprudential databases that gives us information on loan-to-value, debt service to income, income-based measures, and so on. And we compute the measure such that the country is assigned a 0 score if there's essentially no BBMs in place. The country is assigned a half score when there are some BBMs in place, in particular when there is an LTV constraint that seems reasonably tight, 80% or less. And then we assign a 1 to countries where there's not only an LTV constraint, but on top of that, there is an income-based measure such as DSTI. And we look at the overall package and we say, okay, if that's reasonably tight, then the country gets a 1 in this scoring. We validate, it's a little bit of a judgment in terms of judging the overall tightness of the package. So we validate our judgment by also looking at IMF FSAP reports on these issues. And I want to just say, for this measure, essentially half of the countries have no BBMs in place through the sample period, and that's sort of a control group for us. The other half has some borrower-based measures in place, and you see some tightening of that, especially since the global financial crisis. And what we do with this measure in particular is to look at interaction exercises. So I think I explained already that we can think of 2 channels through which higher interest rates affect borrowers' default rates. On the one hand, higher interest rates lead to greater debt service, boosting the numerator of the debt service to income ratio, in particular for loans that are at variable rates. And then there's a second effect which works through the denominator. Higher interest rates reduce income, reduce income flow in the event of unemployment, for instance, which again leads to an increase in the debt service to income ratio. And through both of these effects, and that works for all loans, through both of these effects, you'd see greater PD and greater loan loss provisions. And here the idea is, if you have taken borrower-based measures ahead of the increase in interest rates, then your borrowers are going to be less vulnerable because you're going to have reduced the initial leverage of the borrower, and the increase in the debt service to income ratio works from lower initial levels. And so that's the interaction exercise that we do. I'm going to try and give you some results on all of this, focusing on loan loss provisions, net interest margin, and the overall profitability. Here, first off, loan loss provisions, still without the borrower-based measures. there's three things worth mentioning. One is that we do find that higher interest rates increase loan loss provisions, unless that is, and that's in column 2, unless that is, we also control separately for GDP growth and unemployment, where those variables have very strong effects on provisions, and they tend to absorb some of the effect that comes from the increase in interest rates, because increases in interest rates would lead to lower growth, higher unemployment. So the unemployment effect particularly is very strong throughout, as you can see here across the regressions. The increase in provisions from higher interest rates is particularly pronounced, and it still comes through, in particular for banks that are extending loans at variable rates. So they are still, you see that they are particularly vulnerable to the increase in interest rates. That's, I think, column 3 here. On top of that, we find that banks that ex ante take more risks are more vulnerable to increases in interest rates. And so we have several variables that try and capture that. For example, we look at banks that have initially low market share. And the idea is that if you have low market share, you have an incentive to gain market share by extending credit to perhaps more marginal borrowers. And so that makes you more vulnerable. And so we find that for low market share banks and also banks that grow their loan book fast in boom times, we find that the increase in interest rates leads to higher provisions. So in a way, those banks take more risks, and then they get caught out by this increase in interest rates. What about the borrower-based measures here in this environment? What we find is that the tight BVMs that were taken ahead of the increase in interest rates help unconditionally with reducing provisions, but more so through two interaction effects. So the two interaction effects come about because, on the one hand, higher interest rates increase provisions, in particular, as I said, for banks with flexible rates. But this effect is mitigated if borrower-based measures were in place ahead of that increase in interest rates. And the second interaction is that, again, higher unemployment for all banks increase provisions, but again, that effect is less pronounced if the borrower-based measures had been taken ahead of time. Then on non-interest income, here, the idea is, the non-interest income can come to your rescue a little bit. So the non-interest income does increase with the interest rate, boosting profits. And here again, there are two interactions that are worth talking about. One is this effect of a boost to income is stronger for banks that have a larger share of deposits in their funding, because deposits don't reprice as fast as other liabilities. So those banks have an advantage. And then there's a second interaction where we ask, so what if you have flexible rate loans? Does that help you? Does that not help you? And we find it's complicated, actually. For large banks, if you have extended loans at variable rates, that tends to help you. Your loans reprice more strongly, so you gain. But essentially this is the net interest margin, sorry. So the high deposit rate dummy helps you. For the flexible rate dummy here, you have if you are a large bank, your flexible rates help you because they pull up your income on the loans that you've got. But for the whole sample, for smaller banks, for banks perhaps that take more risks, we find that if you have more flexible rates in your loan book, that can actually hurt you a little bit, even on the net interest margin, because for those banks, you see that loans will move into non-performing loans, and they will no longer contribute to your interest income. So there's a complicated effect here. We find essentially finally that these effects that I just mentioned carry through when you look at a measure of profitability, right? Not the components, but here ultimately the final measure of profitability. We find again you are better off in terms of benefiting from an increase in interest rates if you fund it at primarily with deposits. In terms of your loan book, it's more complicated. For large banks, they gain more if they have extended loans at variable rates. For pretty much everyone else, the interaction is negative, so that you are more at risk from flexible rate loans. And then finally, we here again find the interaction with borrower-based measures, where just as before, if you have extended loans at variable rates, you're more vulnerable, so your return on assets does not increase as much, but the borrower-based measures attenuate this effect. So the borrower-based measures help support the return on assets in times when interest rates go up, and the borrower-based measures again support return on assets when there is a high unemployment. And so that is it. I'm just going to conclude by, again, emphasizing the three messages. We find that high interest rates affect banks through several channels, with a net effect on profits positive on average, but masking important heterogeneity. Several characteristics can make banks more vulnerable to higher interest rates, with implications for central banks that seek to prepare. In particular, banks that extend loans at flexible rates and that take more risks ex ante, so for instance, banks with low market share, fast-growing banks, and so on, those banks are more vulnerable to an increase in interest rates. And we find, finally, that at the bank level, borrower-based measures can help support banks and support the profitability of banks by reducing the adverse effects that come from high interest rates on loan losses. And that works in particular for banks that have extended at flexible rates, but it works also more generally in the context of other macro variables, unemployment, GDP, and so on, for any loan that is at risk of default through those macro shocks. And that's it.
Thank you, Alan. Very interesting work. It reminds me a lot of what we do, also in the policy, in our internal work. So it's really, super relevant. So Luis is the discussant. Please, 10 minutes.
So let me say that it's a pleasure to discuss this paper, and it's a great pleasure to be here at the ECB and this very nice conference. So basically, my general comments would be that this is a very important paper. Why? Because it touches a very important topic, which is how monetary policy affects credit risk. It goes near, Erlen goes to other aspects of bank profits, but it concentrates especially on the credit risk and in general on bank profits. They have a novel data, they create a novel data on macroprudential policies, borrower-based, and then has several results, I would say many tables, but I think there is one very interesting result on the interaction between monetary policy and macroprudential policy, which I will highlight in the next slide. After that, I will give you very simple, specific suggestions to improve the paper, and then I will finalize with two more general comments on monetary policy and financial stability, and monetary policy and macroprudential policy. So the question is how the impact of interest rates affects bank profitability and each of the components. They construct a data set of Macropru on this, and they do a dynamic panel. And the main key takeaway for me of this paper, the key result of the main results, is that, so the first part of this result is kind of obvious, which is if you raise monetary policy rates, defaults are going to go up, especially for mortgage with variable interest rates. But what is nice is that this is reduced if you have a tighter macroprudential policy ex ante. That's a very interesting result. Let me just tell you one thing, which is not in the comments, but given your last comment, which is this increased bank profitability. Of course, it lowers defaults. One should do like a trade-off between these bust times, like you improve when the interest rates go up, but then you sacrifice profits when you tighten LTVs and DTIs in the boom. I have a paper with some co-authors in the Journal of Political Economy looking, in 2017, looking at this trade-off between boom times and bust times. I mean, this is a small comment here. So if you go over the results, there are some weaknesses on statistical and economic significance. Just 3 super tiny specific suggestions to potentially improve the results of the paper and to make it a bit more transparent and potentially to improve the statistical and economic significance. The first one is that is a bit complicated. So there are lots of control, lots of things. Yes, let me, I don't even know whether, even with my glasses I see this. But you know, like if you see in the red stuff, so even in this is the simplest model. Then in table 3, etc., they complicate even further. And as you can see here, so they don't even start from a linear model of what is the impact of monetary policy rates, 3 months interest rates, on profitability, in this case, loan defaults. They already have the non-linear effect. And if you go down, 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 you will see that there are time-varying controls and lots of stuff going on. So my first comment would be, you could start the first tables a bit more simple, and then see what is the relationship between monetary policy and profitability and defaults, and then see how the different controls change the results. There is one thing that you highlight, and this is very consistent with a paper that I have with Carlo and Miguel, which is that if you compare column 1 and 2, depending on how you control for the business cycle, you might find a significant effect of monetary policy or no. Okay? So even, you know, even things like this, it would be not visible if you put lots of controls. The second thing is that you are using this dynamic panel that people used in the past. I mean, I think local projections are nice. And they are much simpler, but in the particular setting that you are analyzing, there should be different lags. So my research and what I know from banks, sitting on a board for almost 10 years, you see that the impact of monetary policy is immediate on NIM, on net interest margin, but it takes time on defaults. That you will see it very clearly in a local projection, but it will be much more difficult to see it here. So your results could be stronger, allowing different lags, and for that, the local projections are good. The last of these simple suggestions is that you have this concave non-linear that people in the past were doing, like Borio et al., Claessens et al. So in this concave, you can do it in absolute terms, the interest rates in absolute terms, and this is what you are doing. And nominal interest rates matter a lot for banks, for profitability of banks. But once you are doing this concave, non-linear, is it too high or too low, then you could have a benchmark. You can have a simple benchmark, which is inflation, which is the real rate. You could have a more complicated one, the systematic component of monetary policy, and you could even have R star. Even if you don't do this, it will be nice a discussion on these topics. These were basically my simple suggestions. In the last 4 minutes, let me advertise some of my papers, but just not of advertising my papers, just because they fit perfectly in Enrique's presentation. So when we are interested, and this was related yesterday to the dinner speech on the interactions between monetary policy and financial stability. Profits are important and defaults, so the paper is about defaults first and then profits. And you're interested on that because of financial stability. So a key point is monetary policy and financial stability. Now, in a sense, you would like to know whether when you raise monetary policy rates, if and when you create potentially financial instability, and in particular, banking crisis. I have this paper with a long-term co-author from Bank of Spain, Jimenez, and two former colleagues of mine in Pompeu Fabra, Dimitri and Björk, which is forthcoming in the Journal of Finance. In this paper, let me explain a bit the paper in two slides, in these slides and the next one. Let me just give you the main result. The main result is a U of monetary policy, meaning like when you raise the monetary policy, you are going to create potentially a banking crisis, especially if before rates were low for long. This is also a paper related a long time ago with Angela Maddaloni, but in that case was lending standards. This is a financial crisis. And you create banking crisis, and the channel is through a credit and asset price cycle. And we are covering not just one cycle, but many, many cycles, about over 150 years and 17 countries. And let me just, in this slide, why this paper is, complements perfectly the paper by Enrique. So basically here we find that when you raise monetary policy rates, as I was saying before, this is especially the case when there has been a prolonged lower monetary policy rates. This is especially the case if those lower rates are below the systematic component of monetary policy, which is much easier to estimate than the R star. And this is very unique to banking crisis. Doesn't happen with recessions, not even the worst non-financial recessions. So it has to do something with finance, which it's, if you go to the mechanism, it will be in the boom. In the boom, when you start lowering the rates and you have these rates low for long, what you are creating is a credit boom and an asset price boom. And what we find with the data, surprising because I thought it was going to be difficult in this cross-country type of analysis to find like a mechanism, we found consistent with credit supply. So banks take some more risk, they give more credit at lower standards, they create this boom, and this boom now, which is very related to the Macroprudential, here is when you have to do the Macroprudential, the tightening of the Macroprudential, to reduce the potential effects when you raise the monetary policy rates. Because once you raise the monetary policy rates in the mechanism, in the bus, you are going to create problems. You are going to create the banking crisis if you were before low for long and you were creating this boom, excessive boom. And what we find, another message which is consistent with analyzing defaults, and also is nice as compared to yesterday's presentations on interest rate risk. People are now doing a lot of interest rate risk because we had the issue with Silicon Valley Bank. But if you look at the data over 150 years, and not only before the Second World War, but even in the last 30 years, what you find is credit risk is much more important in creating these problems than purely interest rate risk over and above non-performing loans. So it is more the non-performing loans that are doing this. Briefly, you should cite a paper of a wonderful guy, Ali Upal, which is very related to your stuff. I put you the citation there, very, very similar. And in the last 30 seconds, let me just tell you that your super key interesting result to me is this monetary policy and Macroprudential. Now, for economics, it would be nice a discussion of are these instruments separated, independent, complement, substitute? That would be super interesting a discussion. Even if you don't want the discussion, for econometrics is crucial because these two policies are set up at the same time. Like just from the country Diane, Spain, when Spain joined the European Union, the euro area, and monetary policy was very soft, then they introduced dynamic provision, which was a kind of tightening macroprudential. So they do this combination. So I have a paper with Carlo and Luke in which we do, I will not explain you the paper, but I will explain you one trick to trick endogeneity. So if you take monetary policy surprises, not the change, not the level of interest rate, even the level of interest rate, but instrumented by surprises, the nice thing about this is that if you lack macro-pru, as you do, then this lack macro-pru is exogenous to future surprises of monetary policy, And also future surprises of monetary policy are independent of previous macroprudential stuff. And then we do, apart from this trick, we use the euro area, because in the euro area we have these nice settings that displays the ECB and the euro system set up the monetary policy, while the macro-pru is set up more in the country, at the country level. Thank you. It has been a great pleasure to discuss your paper, and super interesting. Thank you.
Thanks a lot. Thanks a lot to both. So if you are fine, I will still collect questions and then you will respond to everything in one go. Is okay? Okay. So I would open the floor now. Just raise your hand and yeah, okay, probably start here. You don't need probably to mention your affiliation, but the others should mention also their affiliation name when speaking, so please.
Yeah, so your paper obviously is very topical and fascinating. And I was sort of wondering whether you can do more work on the stickiness of deposit rates. You know, sort of in the light of recent sort of banking stress events, we have seen that banks are pressured to raise interest on deposits much faster than the past. And obviously that should affect their profitability. And you know, because you have this sort of rich cross-country setting, maybe some institutional details in those countries will help you to nail this particular channel. Thanks.
Thank you. Was there a question over there? No? Yeah, please.
Hi, I'm Florian Haider at the Leibniz Institute SAFE. Have you thought about the role that financial constraints could have in your model or in your thinking? Because that would mean that profits may not be the best indicator of a bank state. So once you're in a model where you have financial constraints, it's the rents that matter because part of the profits go to outsiders. I'm just wondering whether this could give you an extra angle on what you're looking at.
Thank you, Florian. Yeah. Ellen?
Thank you for your paper. It was really very interesting. Sorry, my name is Ellen Ryan. I work for the ECB. So you find that BBMs make bank balance sheets or bank loan books more resilient when interest rates rise. I was wondering if at any point in your analysis you split your sample into banks which are predominantly active in mortgage markets and those which are maybe corporate lenders, because the BBMs should directly affect really just the household sector. So on one hand, it might be that your result is driven by mortgage banks, but on the flip side, I mean, there is a potential that BBMs, by making the household sector more resilient, make the whole economy more resilient and could make the corporate loan book sort of indirectly more resilient, which could be a really interesting finding. So I was wondering if you did that at any point during your analysis.
Thank you. Any further questions? Oh yeah, please.
Thanks a lot, and again, very interesting. Here is Salvatore from ECB Banking Supervision side. A question very connected to the last one. Have you also had time to explore any sectoral characteristic of a banks? Because as far as I understood, we are dividing in small banks, large banks, high NPL, fast growing. Maybe some monoliner banks, some banks focus on specific sectors might be, in a sense, disentangled from the sample and have different findings. Thanks.
Thank you. No, I see no further question. Perhaps just two small points on my side. So the first question is, I mean, you have a lot of material. You went quite fast, despite you were very efficient, but you also went fast. So I'm not sure how your framework capture the portfolio losses. So if you have a bank, you have bonds, and some of them are trading book, banking book, and so on. So how you deal with that, which was crucial for SVB also. No? So I'm not sure how much this is captured. And then just one comment also, Luis. Okay, so the story of the U-shaped is very nice, but the question is why it didn't happen this time then? Because this time was really the perfect test, and fortunately for us, the back credit didn't have. So, but perhaps this is a conversation for the coffee break. So Ellen, you have 4 minutes. You can push it to 5, and you can
Okay.
also be selective in what you want to react.
Yeah,
to.
yeah. So, thanks first off, Jose Luis, for a very nice discussion of the paper. We'll certainly think about your specific suggestions, perhaps doing local projections, simplifying, and so on. I think we're also already thinking about, well, can we benchmark monetary policy, perhaps looking at surprises relative to some sort of Taylor rule or some benchmark. Currently, we don't do that, so we essentially rely on fixed effects to essentially look at monetary policy relative to the country-specific mean. We could do better than that, perhaps. I would say, though, that in terms of endogeneity of the interaction of monetary policy and macro-pru, what we do is to look back at previous tightenings of macroprudential policy that are not, that happen well before there is an increase in interest rates, right? So we have a 5-year moving average of our BBM measure. And then against that, we look at what happens in the interaction as interest rates then move up. So I think endogeneity is less likely to be an issue for us. But thanks for all of the suggestions. We're definitely going to follow up on all of them. There was a question here on the stickiness of deposit rates. Yeah, I mean, I think there is, we don't have information on what so we do one additional exercise that could be interesting there. We look at the stickiness of deposit rates, not just from a pricing perspective, but from a quantity perspective. So we look at what happens to the share of deposits in liabilities as interest rates go up. And we find that essentially there is attrition, right? So the deposits leave the banking system gradually as interest rates go up and as the depositors move towards money market funds, in particular in the United States, but also in other countries. And we find actually that this attrition is stronger in countries where the money market fund industry is more developed. That's on this. Financial constraints, Florian, yeah, one idea we had was perhaps not just to look at provisions, but at some sort of Tobin skew, market value to book value of the bank. We haven't done that yet. Maybe it's worth doing as a complement. But that's all I have on this for now. Then there was a couple of questions on, isn't it that the BBMs mostly are affecting default rates in the household sector? That's how they are set up, right? LTV, essentially on mortgages, DSTI, sometimes also on consumer lending. So, but here the thing is that our measure of provisions does not distinguish between, where do the provisions come from? Where do the losses come from? Do they come from mortgages? Do they come from corporates defaulting? So we can't tell. So from that perspective, in a way, our results are, biased towards not finding as much because we're only, the improvement can only come from the household defaults rather than the corporate defaults directly. But as you say, there could be an indirect effect, right? When the households no longer cut back on consumption because their leverage is less in the event of increases in interest rates, that could have stabilizing effects also for the corporate sector. It's just we can't tease it out so easily. I mean, we do have, that goes to the question, we do have information on the kind of the specialization of the banks, and we can play around with that to some extent. And some of that actually enters this measure of, do we extend loans at flexible rates versus not, right? So banks that primarily lend to corporates or primarily to consumers, they would be in that bucket. Then I'll leave you your question. Yeah, I skipped a little bit the slide on portfolio losses. We do have an analysis of this in the paper, and we find that these losses on securities held are stronger for securities that are held for trading, because those are mark to market. This channel also is much stronger in the advanced economies versus emerging market economies, where you don't see that much. Perhaps because in EMEs, these securities typically are held to maturity. Not much trading going on. And then finally, we find that banks are less at risk of sustaining losses on these securities if they have high ratios of liquid assets to other assets. And we think that's because if you start out with a big pot of liquid assets, you're less likely to come into a situation where you have to sell any of the assets at a loss.
And become mark to market.
Yeah. So and then you would have to realize that loss in the profit and loss account. So we do have this in the paper. I skipped over this in the hoping to save some time. And then finally, actually, on your question of why not this time? Why? So there's been a big increase in policy rates, I think, of the same scale as what we've seen ahead of the GFC. Yet we haven't seen as much of a financial stability fallout this time around, post-COVID, relative to the previous cycle that ended in the GFC. And again, it's maybe more for the coffee break, but because we don't have tight results on this. But it's possible to argue, given these results, that it's in part because countries did take measures, did take measures since the GFC in many countries, introducing these BBMs. That they are now, the banking systems have proven less vulnerable to the increase in interest rates than perhaps they might have been otherwise.
So you see it is a triumph of Macropru. So the Macropru saved the day. Very good. Good conclusion to this first paper. So it was a very nice start to the day. So I suggested, given that we are a bit also late, we move to the second paper. But thanks a lot, Erlen. Very, very interesting. So Victor from the Fed board will present, and Brunella will discuss.
Well, good morning, everyone. I'm delighted to present our work on the intersection of bank supervision, monetary policy, and financial stability, all in global setting. So it's a joint work with Song Lee at the Federal Reserve Board and Lucy Liu at the National Monetary Fund. And because we like our jobs and we like to keep them, with a disclaimer, so I'm going to talk about our personal views rather than views of the Federal Reserve System or the International Monetary Fund. So first, let me try to set the stage. So during monetary easing cycles, policymakers consistently worry about excessive risk-taking. And these concerns may emerge now because there is a large number of central banks that have begun their easing cycles. Of course, financial intermediaries risk-taking decisions are not taken in the vacuum. There are sort of lots of things that go into this decision-making process, and some of these sort of factors are structural, such as the supervisory and regulatory environment, and some are cyclical, like risk appetite or monetary policy stance. So, obviously, these decisions are sort of take place both in the domestic setting and the global one. And we're going to focus on the global dimension in part because we recognize that financial markets or even lending markets are highly integrated across the world. So in our paper, we'll specifically focus on the subset of structural factors which are bank supervision related. And in particular, we're going to focus on macroprudential powers. So these powers are not new. They have been around for a while, so we know how to use them. We have a pretty good idea how they work in certain dimensions. And one of the advantages of these powers is that they can be sort of used pretty rapidly and respond to current events. Whereas if you think about bank regulation, well, there's sort of a lengthy rulemaking process, which sort of will result in untimely sort of policy options. And you think about macroprudential tools, well, some countries might not have them, or they may also involve a pretty lengthy interagency process to activate them, so they might not be timely either. So despite the importance of the effects of macroprudential powers in combination with monetary policy, we actually don't really know much how these two factors jointly affect risk-taking. This is where our paper comes in. So how do we translate this sort of big question into sort of smaller ones that we actually can digest? So first, we're going to look at the question whether national macroprudential powers have global macroprudential effects. Then we're going to sort of try to connect that to differences in how banks across the world respond differently to US monetary policy. Then we're going to sort of try to figure out why actually macroprudential powers work. And finally, we're going to examine the question whether they have any independent consequences. Okay. So we draw on three strands of literature. So the first one is about bank supervision and bank risk, where most of the metrics are balance sheet based. So they sort of tend to be backward looking, and there are some identification challenges that sort of tend to be more statistical exercises. There are sort of plenty of papers there. I'll just highlight a couple. So paper by Delis and Strakouras, an old one, talks about how bank supervision is effective in reducing bank risk, again, using bank balance sheet metrics. There is a fascinating paper by Bev Hertel and co-authors that look at supervisory intention, how it reduces bank risk. And it basically tells you that you can have your cake and eat it too. You can supervise banks tightly, yet you don't really see any detriment to credit growth or bank profitability. And then there are papers that talk about differences in leniency of bank supervisors and how it can have pretty adverse real outcomes, so like bank failures. Then the second strand of literature is about risk-taking channel monetary policy. So it typically focuses on bank characteristics as either amplifiers or mitigants of monetary policy transmission, and quite often it focuses on risk of loans being made rather than the volume of risky loans being made. There's plenty of evidence in domestic setting that this channel is important. So in this context, I would like to mention paper by Intelrice, Lavin, and Suarez. Then there are papers in the national setting, like the one by Ioannidou, that sort of looks at risk-taking in Bolivia in response to US policy rates, because Bolivia is a highly dollarized country. And then there is also plenty of evidence about the existence and magnitudes of this channel in the global setting. And actually, my co-authors and I looked into this some years ago. Finally, the third strand is the sort of intersection of bank supervision and monetary policy. And surprisingly, there's not much there. So the paper that inspired actually our one is by the ECB staff. So it's Altavilla, Bucino, and others. So they look at the introduction of the single supervisory mechanism and how it dampened risk lending response to accommodative monetary policy. And we kind of think of this paper as sort of, on one hand, being great. On the other hand, it's pretty much about one but very significant change in bank supervision. So in our paper, we try to introduce sort of time series and cross-country dimension to supervisory frameworks. And we're going to study how national supervision affects global risk-taking across banks. Again, in part because we recognize that the lending markets are global, and in part just because this is how we can line things up in terms of data. Okay, so let me first talk about the most crucial component, data component of our analysis, and that's data on syndicated loans. And then, I'm going to say a few words about how we measure ex-ante credit risk and how we, loop in data on macroprudential powers. So, syndication is a great thing. It sort of happens across borders. Most of the borrowers in the market are risky, so that basically means that it's a economically significant market to look at. And the magnitudes of syndication are very similar to issuance of corporate bonds. So you have immediate implications of financial stability as well. And one neat feature of syndication is that it allows for robust identification. And here in this sort of diagram, I kind of show you what we mean. So you can have one borrower that borrows through a syndicate through multiple lenders, and each of these lenders may face different degrees of bank supervision, or in the case of non-banks, there might be no supervision at all. And so this is sort of great because we can push identification sort of further than Kawaja and Bian had, because we control not only for borrower but also for loan characteristics. You heard yesterday a lot about the originate to distribute model, and you might think, oh, it's a negative file analysis. We actually don't see things that way. So we see here banks as being gatekeepers to restaking, by the broader financial system. And in case of lead banks, these are the ones that play significant roles in syndicates. There is plenty of evidence that they retain significant stakes in loans that they originate, to sell. So they have plenty of skill in the game, and this is something that we examined in our past work as well. Then the data on loans comes from widely sort of used and well-known data set, the Loan Connect and Deal Scan. And it has one big disadvantage. It doesn't provide you any metrics of ex-ante borrower risk. For some borrowers, you may have loan create agency ratings, but it sort of appears only sporadically. So we needed to bring data from Moody's CDF-FX, and that's sort of the data on expected default frequencies that are sort of based on well-known models that include asset volatility, balance sheet characteristics, and things like that. Okay, so moving on to macroprudential powers, and this is somewhere where we had to sweat to come up with something reasonable. And it turns out that if you look deeply into the supervisory literature, there is already a really excellent source there. And that's the survey by Bart, Caprio, and Levine of regulatory and supervisory practices around the world since the late 1990s. So they cover over 100 countries. We have a gazillion of items that they pick, in the survey. But the one that we focus on is the authority for prompt corrective action, in part because we think it's a core macroprudential power, and that it's sort of widely used around the world. So, what is it? This authority establishes a structure for thematic early interventions based on certain triggers. For example, capital ratios sort of falling behind certain thresholds. These powers include multiple components. So, of course, the first one, the key one, is the power to intervene early. Then the other ones include cease and desist orders, suspension of dividends, management compensation limits, forced reorganization, and required loss provisions. And obviously, it's sort of a lot to take, and the survey codes the answer responses to questions whether authorities have this kind of powers or not into sort of 0 and 1s, and then Bart and company sort of aggregate that into a PCA index, which is a product of early intervention multiplied by the sum of the dummies for the existence of other powers, and it sort of lies between 0 and 6. Then, the other things are pretty easy. The only remaining component for our analysis is US monetary policy, and here we rely on the federal funds rate, or its sort of shadow version by Wang-Xie in case of the zero lower bound period. Then we construct two samples. So one is a global one where we basically include every country we can sort of have data for. And the drawback of the data set is that it has a high share of US banks and US borrowers. And it's sort of bad for potential indigeneity concerns. Then our non-US borrower sample is great because the share of US banks there is only 10% and is dominated by EME borrowers. So here, we can gain a lot of traction in terms of addressing any indigeneity issues. We're going to look at the data from 1995 to 2014, and there are a couple of reasons for that. First is the introduction of single supervisory mechanism, because once it got in place, we're not totally sure how to treat local macroprudential powers. And then the other issue is that when we started writing this paper, sort of BART and other survey data were not available for more recent years. So we're going to aggregate all the data, loan data up to bank group, bank holding company level, and we're going to look at PCAs by headquarter countries. Okay, so estimation strategy. So first of all, I should fix some terminology. So we're going to label a bank I share in a syndicate as a bank I loans to a particular borrower. Again, as explained later, we're going to use the structure that, same borrowers borrow on the same terms from multiple banks with different supervision strategies. So our model definitely reflects that. Then in terms of exogenate of monetary policy and credit risk, we're going to rely on a couple of tricks. First one, just like in the literature, including the paper by De La Richa, Lavin, and Soares, we're going to look at loan originations. So this is sort of ex-ante credit risk that is not affected by, sort of all sorts of, things. So it's sort of a really kind of neat way to measure what actually banks want actively to do. We're going to look at interactions with monetary policy with certain factors, and that sort of goes back to unification of interaction terms from Kashyap and Stein. And then we're going to focus a lot on the sample for non-US borrowers, because it has no US borrowers, and it has a very low percentage of US banks. Then we need to build in two nonlinearities in this analysis. So the first one is would like to differentiate risk-taking by the credit risk of borrowers. And this is where this term log EDF comes in. So for investment-grade loans, EDFs tend to be smaller than 1, and which means that log EDF is smaller than 0. And for speculative-grade loans, EDFs tend to be larger than 1, and so log EDF will be larger than 0. So having this log EDF thing, we introduce nonlinearity, so we can sort of study how different factors will affect the volume of loans based on borrower characteristic. Then another nonlinearity is the interaction term of risk of borrowers and monetary policy and supervisory powers. And we saturate our model for all sorts of fixed effects, and that has some drawbacks, which we'll mention later. Actually, I'll mention it right away. So in this slide, I'll briefly cover some descriptive statistics. So, a couple of things here to note that the global sample is different from non-US borrower sample because it has safer loans and more powerful supervisors. Again, it's not surprising just because the United States is the dominant country in that sample. And yes, the sample size is small and sort of draw back our analysis. And it's in part because we're merging 3 unrelated data sets that probably were never meant to be merged, but we do it anyway. And because we saturate our model with fixed effects. So we end up with small sample sizes, but I think they allow for robust identification and some cool insights. Okay, so estimation results. You'll see lots of statistical significance here, and the regression coefficients sort of make sense. So tighter supervision results in sort of smaller volume of risky loans being originated. Then we also find an evidence of risk-taking channel for risky loans. And we also find evidence for supervisory powers being a mitigant of that risk-taking channel. So the results are robust to a model variation. So different fixed effects combinations give you the same results, and also to sample periods. I'm not going to talk about how pre-GFC, pre-global financial crisis sample results are different from sort of the overall results, but there are some cool details there as well. So if you'd like to check the paper, that's great. Then our results also have a certain degree of falsifiability. So as I mentioned, our analysis is based on what lead banks do. So we're talking about large banks that retain large shares in syndicated loans and presumably deserve a lot of supervisory attention. So what happens if you include non-linked banks, so all sorts of small potatoes, and we actually don't get any meaningful results there. So please don't think that you get statistical significance every time you run regressions of this kind of type. Then as I mentioned, this model is highly nonlinear. So to gauge marginal effects, we need to do some extra calculations and some reference points, and that's what I'm going to show you next. Again, just to remind you, what's sort of our overall finding. So the supply of risky loans in response to US monetary policy increases, sort of monetary policy easing increases, with prompt corrective action dampening such an increase. And because of this sort of nonlinearity we built in, we can show that the opposite results hold for safer loans. So the table below kind of tries to break down marginal effects on the negligible pieces. So we have results here for 2 samples, global and non-US sample, and for 2 reference points for EDFs. So the first column in each part of the table is for median EDFs, and then the second one is for EDFs in the 75th percentile. So the first line shows you that 1 point increase in PCA increases loan sizes in a sort of inconsistent way for median loans. So it's either increase or decrease, but definitely decreases loan sizes for risky loans, right? And that's what you would like to see. The supervisory attention results in sort of less risk-taking. Then lines 2 and 3 speak about the monetary policy transmission in a sort of global setting. So first of all, line 2 shows you that, in fact, we have a sizable gross risk-taking channel of US monetary policy, meaning that with risky loans, we see significant increases in risky lending when monetary policy eases. We also have significant mitigation of this channel happening through supervisory powers. And, we sort of can draft it up somehow saying that about 1/6 of sort of risk-taking that banks would like to do in response to an easy monetary policy is being offset by sort of supervisory attention. Okay, so hopefully I convinced you that prompt corrective power is great. Now we'd like to know why actually it works. And again, we're going to rely on the Bart, Caprio, and Levin survey for this analysis. So they very conveniently break down PCAs into different components. So we can pretty much estimate our regression model with each of those components at a time instead of the overall PCA index. So I'm not going to show you the results, just run you through the findings. So, so only select PCA components actually have a statistically significant effect. So the first one is early intervention, and it's not surprising, right? Because that particular component is supposed to address supervisory forbearance or timing consistency. So supervisors may sort of want to procrastinate sort of engage an institution, just sort of hoping it will recover on its own. And so one way to stop it is actually require automatic interventions, which this early intervention power accomplishes. Then another issue here is time consistency. You may have supervisors that talk tough, expose, but then go lenient ex ante. So again, having this power that requires you to intervene automatically is very helpful. Then the next thing is cease and disease order, and that's helpful because it allows supervisors to timely stop questionable activity. So like the first point here, information forces you to act, and then the second one sort of tells you, what you actually can do. Then the other components here are kind of fascinating to us because they speak about how these powers can affect moral hazard issue or behavioral issues of bank managers or bank shareholders. So imposing limits on compensation and dividends, solves moral hazard issues and sort of aligns the incentives of bank managers and shareholders with that of creditors. Then, limits on compensation and dividends have actually stronger effects than the other components. And again, the way I see it is that actually highlights how crucial it is to line up incentives, of bank managers and bank shareholders with creditors when you actually think about mitigating excessive risk-taking. So, it's all sort of great, but, now I have to confess about some important thing that we're missing here. So we observe whether supervisors have certain powers, they don't observe the usage of these powers. And, you might think that's sort of an issue, and I think, it is. And so it reduces attenuation bias. And so it's actually amazing that despite the presence of that bias, we actually, find statistically significant, results. And, if we use maybe some other data sources that are sort of country-specific and, we're able to get this probably very confidential data from supervisors, we have been able to address the usage issue, but, we cannot. We might be able to do it in the US context, but It's not clear how far we can push it because we'll be lacking sort of a lot of variation that's necessary in this kind of analysis. Then another thing we're missing here is whether it's the usage of PCA matters or just the threat of usage. And again, because of data limitations, we're not able to say much here. Okay, now it's all great. PCA works. We know why it works. Now I have to move to a dreaded question: whether PCA, so protective power, macroprudential powers, have any adverse effects. And it turns out they do. And what we sort of show is that powerful supervisors sort of limit banks' ability to take risk, which opens the door for non-banks to do so. And we had to sort of change our empirical framework to show that, in part because non-bank participation in our sample is very low. So the median share of loans that we can attribute to non-banks in our sample is 0, and the mean is something like around 8%. Which is not surprising because we are sort of looking at the period when non-bank participation was known to be low and took off only subsequently. So in this analysis, on the left, instead of risky loan volumes, we have non-bank shares expressed as percentages of non-bank volume in a given syndicate. And then the right-hand side as a sort of notable change to PCA. So now it's sort of the average of protective powers that lead banks face in a given syndicate. So we estimate this model, and we actually find that non-banks have a larger share in risky syndicates in response to policy easing when banks face sort of stronger supervisors. Again, I don't want to sell this result too much because over the sample period, non-bank participation was pretty limited. But of course, these days, I think that result becomes more prominent, as we heard a lot yesterday. Non-banks play a major role in syndication at this point. Okay, conclusions. We provide evidence of the global effects of national or local bank supervision. And in other words, to restate the result is that national supervisors have global macroprudential externalities. Then also quantify the effects of joint effects of bank supervision and monetary policy on risk-taking. And our results sort of almost want to make us question this decoupling approach for finance policy that is often being cited, which is that monetary policy should focus on price stability and in some countries maximum employment, while supervisory and regulatory tools should be used to safeguard financial stability. Just because we have found that the two actually work together through the monetary policy transmission, this decoupling approach may not make much sense anymore. Then in our paper also identified mechanisms why protective power is effective, and a lot there is to deal with the moral hazard issues, both for supervisors and the bank managers and shareholders. And we also documented macroprudential leakages. They sort of were not significant in our sample, but obviously going forward and even at the present time, they appear to be a big deal. Thank you very much.
Thank you, Vitos, also for being exactly on time. It's really impressive. It was an accident. Okay, still good. So Brunella Bruno from Bocconi University is the discussant, and then we open it for Q&As.
Okay.
So you have 10 minutes.
Yeah. Okay. So let me move here. Otherwise, I do not see the.
Oh, okay.
The time. It's fine. Okay. So thank you so much for inviting me to discuss this paper today. This is an important paper as it raises a policy-relevant question. And this is a paper that, in a sense, complements the first paper that was presented today. The goal of the authors is to investigate the effect of monetary policy in the US on risk-taking in global banks, and whether this effect is mitigated by the more or less stringent macroprudential tool in the countries where banks are headquartered. In this respect, this is complementary to the paper that we have seen before. I guess the paper is being motivated by three main factors. The first one is that markets are integrated, and a shock in one market can propagate in other markets through the bank lending channel. The second one is that monetary policy plays a role in procyclicality, so especially when, as was described by Jose Luis before, so when interest rates go down and stay low for long, this can give banks incentive to shift from less risky to riskier lending, and this can pose a threat to banks' balance sheets, especially when rates goes up again. And the third, there are macroprudential framework that are designed specifically to address, to stabilize the financial sector, but they also may contain procyclical components. So the authors take all this into account with the goal of investigate first individually and then in combination the effect of macro factors on bank risk-taking globally. What are these macro factors? First are cyclical macro factors, that is the monetary policy in the US, that they look at in terms of the Fed rates over the 1994 to 2008 period. This is a period where the rates varied from 6% to 0.25%. Then they look at another macro factor, structural macro factors that are the macroprudential framework in the countries where banks are headquartered. And how do they look at this? By using the Barth et al. Index, that is a survey-based English that measures the stringency of the framework in different countries over different years. And as for risk-taking, how do they measure risk-taking? They look at the exposure of these banks within the global syndicated market, and they specifically look at the corporate loans denominated in US dollars. And for them, this is a good setting, as this enables the others to look at banks from US banks, non-US banks, and US borrowers, non-US borrowers. And also, this is important for identification, as this is using syndicated lending data enable the others to trace the exposure to the same risky borrowers of multiple banks that face, say, different supervisor with different powers. Okay. Let's take a quick look at the specification, why this. So we have a better sense of what's this empirical, say, approach of the others. So the risk-taking is this measure of the size of the stake in the loan syndicated by a given bank to a given borrower in a given year. And then the main variables they look at are a measure of the riskiness of the borrowers, that is this expected frequency default, that is a measure of forward-looking credit risk for the borrower. Then they have a measure of the intensity of the, say, stringency of the micropru regulation, that is this PCA index. As the author said before, they look at a limited portion of the micropru tools. Specifically, they look at prompt corrective actions only, that are actions that in principle supervisor can take in order to prevent that a situation of say, difficulty in a bank will turn into more severe distress. And as for the monetary policy rate, they look at the Fed rates over time. Okay, then they interact all these terms in order to have this measure net risk-taking channel of monetary policies, to measure the combined net effect of monetary policy shock conditional on the riskiness of the borrower, and take into account the potential mitigating effect of the severity of the macroprudential tool. Then it is also important that they saturate the specification with lots of fixed effect at various levels, at the borrower, at the bank, at the industry, at the country, at the time level, interaction across them. Okay. Main results, they find that when interest rates go down, banks tend to take on more risk, but this effect is mitigated by microprudential tools. Which ones in particular? The ones that are able to curb incentives, that are able to better align incentives of managers, shareholders, and regulators. And in this respect, they concluded that basically microprudential tools have this macroprudential role. Okay, my comments. So my main comment, my first comment, this is a nice paper. I mean, I found it interesting because the question is important. And also the results are nice in a sense. They emphasize the importance of internal corporate governance for banks to behave in a more safely manner. And so the story they tell is a nice story. So my comments will be in the direction, also given the location where we are today, to make this paper and the findings a little bit more informative and insightful for policymakers. And I will focus on 3 main points. The first one is the institutional framework and the data, the descriptive statistic they provide. I think that in this respect, the paper is a little bit vague because we do not know basically nothing about the size of the syndicated market, the share of banks vis-a-vis non-banks, the share of leverage loans vis-a-vis investment-grade loans in this context. So it's a little bit hard, to understand what we are truly looking at. And same, we do not know how the sample banks are made. There are no descriptive statistics on their basic balance sheet characteristics, so we cannot really know even how much risk they take overall in making this loan within the syndicated market. While I understand that the fixed effect strategy is important for indigeneity issues, on the other hand, it absorbs everything. Okay, so we do not truly understand what's happening here. Also for the measure of the stringency of the microprudential tool, they use this PCA index, as I said, which I guess, again, we do not, I would like to have at least a visual idea of which countries are, face more stringent regulation vis-a-vis others that face less stringent regulation, and also variation over time. So my understanding is that this is an index that varies across countries, but not much over the time. And yeah, this should be, I think, commented a little bit. And in this respect, I could also try and simplify a little bit the specification. And an idea to do so is to use, for instance, a dummy variable for the more stringent versus the less stringent local supervisor, especially because I do not expect great variation over time. And also they could do the same to distinguish high risky borrower versus low risky borrowers. This could be done by setting a threshold, and so you can look at whether the variable is above, below this threshold over time, year after year. And so as to have a triple interaction with only one continuous variable and 2 dummies, which would make the interpretation of the coefficient much easier. Read the results. I would like to spend 1 second about the validity of the results. The time span covers the 1994 to 2014 years, but then many things have happened. Under several respects. Syndication market had expanded, especially in Europe. Leverage finances expanded hugely, as we have understood yesterday in Europe. Perhaps the correlation across monetary policies worldwide has changed, so we don't know whether banks have reacted to, I don't know, a change in monetary policy in their from their local, say, authority versus the US. And my proposal here is why don't you try and run a robustness test, perhaps focused on non-US bank sample and perhaps on Europe. And because I believe that even if we have the single supervising mechanism in Europe, several things, so there is still heterogeneity. There are actions that can be exploited in an event-like manner. For instance, the European authorities have introduced guidance to improve internal risk management for banks that go a little bit toward your direction. For instance, the ECB since the 2017 has introduced guidance and to alert banks to reduce their exposure to leverage financing. So, to conclude, this is a relevant paper that addresses an important question. The risk-taking measure they use is also, say, very interesting and important and consistent with the current supervisory priorities in Europe, at least. And I suggest you all to look these ECB newsletters on zooming in on leverage finance to have a sense of what's happening in Europe in this respect. Also, the conclusion in pointing to the relevance of corporate governance measure to curb incentive. This is in line with what policymakers are doing, but also with the recent evidence. And I suggest the authors to take a look at this paper here. And in the end, if they really want to demonstrate that macroprudential tools are important to mitigate risk-taking, and certain instruments are better than others, I guess that they should put a little bit more effort to motivate the paper using more updated data and provide a little bit of more analysis and descriptive statistics as well. Thank you, I'm done.
Thanks a lot, Brunella. No problem at all. So, and I would also kind of second the point of of course, post-14 data. So, I would add also to this comment. So let me collect, if you're fine, to also collect some questions that would respond to anyone go. Is okay for you?
Yeah.
Yeah, okay. So, floor is open. Who wants to break the ice?
I guess I'm jet lagged, so probably didn't make much sense.
No, that's perfectly understandable. Perhaps why don't you just reply now and then we see if people kind of have a...
Great. So, Brunella, thank you very much for wonderful comments. So I'll just maybe address a couple of them. So it's easy to add things on sort of the market structure and sort of volumes and things like that. So one thing that you mentioned there is sort of kind of covenant-light loans and things like that. And we kind of think about relating that stuff to potential losses given default. So it's just sort of another component of economic sort of loss, which is absent in our analysis. And the prevalence now of covenant-like loans may indicate that losses given default have increased, right? So that means that actually, risk-taking channel now is maybe sort of even more important than it used to be, right? Because you're dealing with the borrowers with high probabilities of default, and on top of that with high LGDs. So I think it'll be easy to make that kind of point using descriptive statistics. Then your comment about the lack of time variation and PCA is spot on for many countries. So one of them is the United States. So the United States was sort of, I think, the first country to introduce this kind of framework in the early 1990s, and it remained sort of relatively unchanged over the years. So I think, through the sample period, the USPC index is at sort of 6, and maybe in a couple of years it goes to 5, and then goes back to 6. Whereas in the other countries, you have more variation. That's sort of, again, the reason why our non-US borrower sample is so valuable, because you get not only cross-sectional variation, but also time series variation in prompt corrective power. And you should also note that that power has increased a lot since the global financial crisis. It's sort of a pretty striking, trend. So doing this analysis for post-2014 is sort of challenging. One of the reasons is that we're not totally sure how to treat the emergence of the introduction of a single supervisory mechanism. And then, more importantly, until recently, there were no new vintages of BART, Caprio, and Living Service available. So we actually couldn't run this stuff with more recent data. But I think now they have a new vintage out, so we might sort of look into it. And then, some of the comments that Brunella, you gave kind of suggested more interest in doing more work on the Euro area or the European Union. I feel like we might be ill-suited for doing this kind of analysis because of data limitations. Yeah, but maybe it will inspire some colleagues at the ECB to do more work in that area.
Message taken. Any second thoughts about questions? Okay, I don't see anybody. Then we can open the coffee break. And I don't know, I mean, look at the organizer. I mean, perhaps we can come back 5 minutes later, like 11:05. Okay, so let's be back at 11:05. Thank you.
Okay, good morning. I hope you all had a strong coffee and your seatbelts are fastened, because now we're going to have 90 minutes of hardcore financial stability. We have two very different papers in this session, but one thing that they have in common is both are looking at financial instability and particularly financial crisis. So first, from the perspective of bank capital regulation and risk-taking behavior, and second, from the intersection of climate policy and financial fragility. A Minsky moment for our times, if you will. So, as I think has been the case with the other sessions, each presenter will have 20 minutes. That will be followed by a 10-minute discussion. And then I'm going to give the speakers 2 minutes to respond, just so that you know in advance, before we open the floor for a 10-minute Q&A. So let's dive in. It's my pleasure to introduce our first speaker, Jorge Abad from Banco de España. Jorge will present a paper which is co-authored with David Martinez Miera and Javier Suarez, offering a dynamic macroeconomic model where banks choose their systemic exposure, sometimes imprudently, sometimes strategically. So, please, Jorge.
Thank you very much for the introduction. And let me thank the organizers for including our paper in the program. We're very happy to present here. As it was mentioned, this is joint work with David Martinez Miera and with Javier Suarez, who is also in the audience, discussing later today. And the title is A Macroeconomic Model of Banks' Systemic Risk-Taking. So let me start with a definition of systemic risk-taking, or systemic risk more generally. It was given by then chairman of the Federal Reserve System, Ben Bernanke, who defined systemic risk as developments or events that threaten the stability of the financial system as a whole, and consequently the broader economy, not just that of one or two institutions. So what we are going to do in the paper is that we are going to develop a model in which systemic risk is going to originate, in particular, from banks' exposure to a common source of risk. And more precisely, these exposures are going to be the result of banks' endogenous decision, and importantly, an unobservable decision they take with respect to the riskiness of their assets. This decision is going to be distorted by their leverage, and therefore is going to be shaped by capital requirements set by a regulator. We are going to use this model to understand what are the drivers of these systemic risk-taking decisions in a dynamic general equilibrium model. So what are the general equilibrium and what are the dynamic forces driving these decisions? And then to try to understand what is the impact of this on aggregate outcomes, so on the dynamics of macro aggregates. Then on the normative part of the paper, we're going to try to understand what is the optimal design of capital requirements and what is their effectiveness in shaping these risk-taking decisions that I mentioned a second ago. So with respect to the elements of the model, we are going to combine elements in the quantitative macro literature on financial frictions, and in particular financial frictions affecting banks, which typically characterizes the dynamics of the net worth of banks driving credit and output fluctuations, being one of the main drivers of these fluctuations. So net worth of banks is going to be one of the state variables that drives the results of in the model. And we are going to combine this with elements of the more traditional banking theory papers, in which it is the unobservable decisions of banks, so banks that are affected by moral hazard, that determines their exposure to some rare but devastating common shocks affecting all the banks that decide to expose themselves to these sources of risk. Now, the novel implications we are going to derive with this model is that systemic risk-taking is not going to be determined only, as in perhaps in the more traditional banking banking theory literature only by static risk-shifting gains, but also is going to depend on some general equilibrium and dynamic general equilibrium forces, particularly what we label here scarce bank equity preservation incentives. So the relative scarcity of bank equity at the aggregate level is going to be key in determining individual banks' decisions to expose themselves to systemic risk or not. Now, as a result, only some banks in our model are going to decide at each point in time to become systemic, to expose themselves to the source of systemic risk. And then one of the implications is that systemic risk-taking is going to be maximal after long periods of calm. So when, after some number of periods in good times, where banks have been able to, where profitable banks have been able to accumulate equity, and equity is abundant, then the incentive of banks is going to be maximal to expose themselves to systemic risk. So let me give you a preview of the results, just in case I don't have time to go through all the results that I plan to present today. In terms of the capital requirements, we find that, as others have found, they reduce risk-taking, but they do at the expense of reducing also credit and output. So there's going to be a trade-off here, and the optimal requirement is the one that balances these trade-offs. In particular, we are going to find that the optimal requirement does not reduce systemic risk-taking to zero. So it's optimal to allow banks to take some systemic risk, because reducing it to zero would be too costly in terms of credit and output. We're also going to have some results regarding deposit insurance. In particular, we show that deposit insurance is going to increase incentives of banks to become systemic, but it's not the fundamental driver of systemic risk. So we are going to show that in a version of the model without deposit insurance, there's still inefficient systemic risk-taking, so there's still a role for capital requirements to be useful even in the absence of deposit insurance. Particularly, it's going to be the unobservability of these risk-taking decisions that is creating this inefficient risk-taking. And we are going to show that despite the fact that our model doesn't feature bank runs, we are going to have that removing deposit insurance still is not welfare improving. So there's a role for deposit insurance in this economy to improve welfare even in the absence of bank runs, which have been the typical, the motivation that people have in mind for the optimality of deposit insurance. Now, we also have some analysis of the optimality of adjusting capital requirements along the cycle. And in particular, we are going to find that these cyclical adjustments, which you can think of as in the spirit of the CCYB, or countercyclical capital buffer, might backfire in the sense that lowering these requirements exposed might make banks take more systemic risk ex ante. So this is going to be one drawback of this type of cyclical adjustments. But I will elaborate on this if I have time. So related our fit in the literature, I will not discuss this in very detail, but just let me say that, as I said at the beginning, we combine elements from two different strands of the literature. One is the quantitative macro, to which we add explicit consideration of systemic risk-taking. We share the fact that the net worth channel of intermediaries in particular is going to be one of the main drivers of aggregate fluctuations, but we are going to add this layer of allowing banks to endogenously decide on their exposure to systemic risk. And then regarding the more traditional banking theory literature, we are going to allow for a role of the dynamic general equilibrium considerations playing a role in the bank's systemic risk-taking decisions. So the outline of the talk is quite standard. I will now introduce the model, then some of the numerical results, and then conclude. So this is a summary of the model. We have an infinite horizon economy in which time is discrete, and there's a single consumption good. There's going to be one representative household that is comprised of workers, which save in the form of deposits, and also can invest in non-bank dependent capital, and which delegates the investment in bank equity to a special class of agents which belong to a household that are called the bankers. And this is, as in most of these macro models with banks, there's this separate class of agents that are the ones the only ones that have the opportunity to invest their wealth as equity of bank capital. This is what makes bank equity scarce at the aggregate level. Then we are going to consider two types of physical capital. The one that is produced by bank-dependent firms, so firms that can only obtain external funding from banks. Another type of firms that are non-bank dependent, so they can obtain financing directly from the households. And these two types of physical capital are not going to be perfect substitutes. So whenever there is a shock that affects the net worth of banks and constrains their lending, this is going to have an effect on aggregate output at the macro level. Now, these bankers that I mentioned before are going to choose how they allocate their equity across a continuum of perfectly competitive banks, which are going to choose between the non-systemic or systemic investment mode. And I will be more specific about what these two different investment modes are in the next slide. Now, there's a final good producer that is pretty standard, combines physical capital with labor to produce the consumption good. And then there's a government that insures deposits of banks and sets the capital requirements, so it's also the regulator. So regarding the production environment, I'm going to focus on bank-dependent firms in particular. Non-bank-dependent firms, they just obtain funding from households, and they are pretty much standard. Now, the firms that depend on the bank financing, they are going to make investment in physical capital. They invest A units of consumption good at time T, which are going to yield an amount delta times A units of capital at T+1 with some gross returns that are determined in equilibrium. Now, this delta depends on the systemic mode that the firm together with the bank decides that is going to operate. So there's two modes of bank-dependent investment, as I said, denoted by this S. S equal to 0 means non-systemic investment mode. S equal to 1 is the systemic investment mode. And they differ in their exposure to an aggregate binary systemic shock. So this systemic shock can take two values, 0 or 1. If the bank operates under the systemic mode, so S equal to 1, this will yield 1 plus mu units of physical capital if the shock doesn't realize, or 1 minus lambda units of physical capital if the shock realizes. Whereas if the investment mode is a non-systemic, so S is equal to 0, this investment always yields 1 unit of physical capital for 1 unit of consumption good. Now, we assume some parametric restrictions here that make that the systemic investment mode is going to be inefficient from a social welfare perspective. So this is going to yield an expectation less than 1 unit of physical capital. But still, this investment mode might be attractive for the shareholders of banks when operating with some leverage. And this is because they operate under limited liability. I'm going to be more specific about this in a second. Now, bankers, as I said, manage the investment of the household in bank equity. They decide on equity issuance that is costly, or the amount of dividends that they discretionarily choose in a given period. And then, more importantly, they decide the fraction of their net worth that is invested into the equity of the systemic bank, which is given by X. So this X, the fraction of the amount of equity of net worth that they invest in the systemic bank. 1 minus X is the amount they invest in the non-systemic bank. They try to maximize the present value of the net flow of dividends to the household, and then their net worth is one of the key state variables in the model that results from the previous, from the return on the equity from the previous period's operation. So an amount psi of the equity returns that they make in the previous period is going to be the equity that they have in the current period. So equity accumulates via these retained earnings and also through costly equity issuance. Now, the balance sheet of banks is going to be their investment on the asset side, either on the systemic mode or non-systemic mode, denoted by this subscript S. And then they are going to be funded by deposits that they issue to households and equity that they issue to bankers that I mentioned a second ago. And they operate subject to some capital requirement that determines that at least a fraction gamma of their investment in assets has to be financed with equity. Now, deposits might be insured. They are insured up to a fraction eta here, which can take values 0 or 1, between 0 and 1. So those obtain the promised return, which is the RD. And the fraction that is not insured might be subject to losses in case the return on assets of the bank is not enough to cover for the promised repayment of deposits. Now, equity returns are given by the maximum between the return on assets and the repayment of deposits and zero. So whenever banks do not, so imagine a bank that is operating the systemic mode and the systemic shock realizes, then return on assets is not going to be enough to repay all depositors. And then this bank is going to make a zero. So then they are protected by limited liability, equity enjoys upside risk. So then there's going to be incentives for banks to maximize leverage and take possibly excessive risk. Now, in equilibrium, we are going to have a variable here that we call V, which is the marginal value of the wealth under bankers' management. That is going to determine how profitable is one unit of net worth for these bankers. Now, this is going to be the maximum between the amount of the return on equity that they can obtain in the non-systemic in the non-systemic bank, weighted by the lambda here, and the term in the parentheses is the stochastic discount factor of the banker, or the return that they can make in the systemic investment mode, or what they can obtain, the utility they obtain if they just consume this unit of net worth, which is given by the 1 there. So this V is going to be the maximum between these three options that the bankers have, either invest in the non-systemic mode, invest in the systemic mode, or just consume unit of consumption good. Now, in equilibrium, we are going to have that an interior solution of the x, so x that is not 0 or 1, but rather somewhere in between, is going to require that the two options, investing in the non-systemic bank and investing in the systemic bank, have the same payoffs weighted by the stochastic discount factor of the banker. So with this, when this condition holds, for the individual banker, any x is going to be compatible with the individual optimization problem, but at the aggregate level, there's only one x that is compatible with equilibrium, and is the one that equalizes the returns of these two. So then we are also going to consider two regimes, one with full deposit insurance and one without deposit insurance. With full deposit insurance, when eta is going to is equal to 1, we have a pool in equilibrium in which all banks leverage up to their limit that is given by the capital requirement. So capital requirements are binding. And all banks pay the same risk-free deposit rate. Deposits are fully insured, so they just pay the risk-free deposit rate. Now, without full deposit insurance, so when eta is lower than 1, depositors internalize that the riskiness of these banks are going to affect the returns they obtain on their deposits. And we are going to characterize a separating equilibrium in which non-systemic banks commit to a safe strategy by operating with a capital buffer that is endogenous and is above the minimum capital requirement. And then the risky deposits of systemic banks are going to be priced consistently with rational beliefs, so that systemic banks are going to pay some deposit rate that is above the one of the non-systemic bank. So then here there's this trade-off between obtaining cheaper funding, but not benefiting from this risk-taking, so the upside risk of this risk-taking strategy versus having lower capital, but then paying higher deposit rates. Now I'm going to start with the numerical results for the case with full deposit insurance. So we solved numerically the equilibrium using global methods. I'm going to show you the calibration very briefly. So we calibrate the model to annual frequency to match a number of characteristics of the US economy and its banking system in the years around the global financial crisis. We proceed in 2 steps. So we have some preset parameters, and then some calibrated parameters that we calibrate to match a number of moments concerning the magnitude of crisis that we observe in the data. So let me skip the details here. This is just to say we match a number of variables such as return on equity in normal times, the relative size of the bank versus the non-bank sector, and then also the impact during crisis, like what is the fall in credit to GDP during crisis, and a number of other variables. And now we arrive to the numerical results. So these are a set of 3 endogenous variables of the model as a function of the 2 state variables that summarize the state of the economy at each given point in time. So the first row depicts these 3 variables as a function of the wealth that is under management of bankers, so the net worth that is available to banks. And the second row is the wealth that is available to households. Now, if you focus first on the first row, each of these lines fixes or keeps at a fixed level the other state variable and gives you an idea of how these different variables move with the key state variable that I mentioned is the net worth of banks. So first, you see as the bank equity, available bank equity increases, the intermediation margin of banks decreases. This is because there's a decrease in returns to scale at the aggregate level. So the more equity there is available, the more investment that banks make, and the lower is their intermediation margin. This lowers, on the second panel at the top row, the marginal value of bank equity, this variable V that I mentioned a second ago, so how profitable one unit of equity is. And as this profitability decreases, then the incentives of banks to become systemic increase, because they have lower incentives to preserve their net worth in the event of a systemic crisis happening. So the more abundant this equity is, the more systemic exposure there is. This is why, as I said in the beginning, systemic risk-taking in this model is maximal after several periods of good times. When equity is abundant, then these banks have most incentives to expose themselves to systemic risk. Now, let me jump to what are the endogenous responses of the variables in the model to a systemic shock. And we depict these dynamic responses for 2 different levels of capital requirements. First, for the baseline level of 8%, the solid blue line, and then the level of the capital requirements that we find is optimal under our numerical, under our calibration, which is 15% in the red dashed line. So you see, when the shock hits, there's this drop in output that is caused and drop in consumption that is the result of the drop in equity of these banks. So there's the shock realizing, a number of banks, those that were exposed to systemic risk fail, and then their equity is depleted because their equity is wiped out when they fail. This causes now constraints for banks become tighter, and credit to GDP falls, as you can see in the bottom left panel. This is what is causing the drop in equity is the one that is causing the drop in output and consumption. And then, as equity becomes more scarce, then there's this jump in the marginal value of equity that makes systemic exposure to decrease as a result. Now, as the economy recovers, then the amount of equity available goes up. Marginal value of this unit of 1 unit of equity decreases, and systemic risk exposure goes back to its steady state level. Now you can see with the optimal capital requirement, the drop in output and consumption is lower, and this is a result of what I'm going to show you next, which is the value of a number of endogenous variables in the model as a function of the capital requirement. So you can see in the bottom right panel, so the very last, that as capital requirement increases, the systemic exposure of banks goes down. This is because now banks have to finance their investment with proportionally more equity, and this makes them to be more cautious in the face of the event of a shock. Now, these banks being safer implies that the drop that we observe when a systemic shock realizes has a lower impact. Now, there's a trade-off between the lower fall in output when a crisis hits with the level of steady state credit, output, and consumption. So you see there the first 2 variables, which are output and consumption, decrease as the level of the capital requirement goes down. And this is because there's this trade-off. You make banks safer, but they are more constrained, so then credit and output decreases in equilibrium. which leads to our final result in the full deposit insurance case, which is that there's an optimal level that is interior in the level of capital requirement that strikes a balance between these two effects, the positive side of decreasing systemic risk versus the negative effect of reducing credit and output. And the optimal requirement that we find is a 15% capital requirement, which compared to the 8% that we have in the baseline calibration is a substantially higher level of the capital requirement. Now, I only have one more minute, so let me very briefly summarize the results that we find for the model without deposit insurance. As I said, without deposit insurance, deposits become risky for the risky bank. And then we have a separating equilibrium in which non-systemic banks operate with a systemic capital buffer, with a voluntary capital buffer, and the systemic banks stick to the regulatory minimum but enjoy but pay higher deposit rates to depositors. Now, I'm going to skip some of this. Now, we reproduce here the results, so the value of these endogenous variables for different levels of the capital requirements. You see in the top right panel that the average capital ratio increases with the capital requirement and sits above the level that is given by regulation. So banks decide to voluntarily have some capital above the regulatory requirement, which also lowers output because for the same level of equity makes banks operate with lower leverage. Then they give less credit compared to the counterfactual world with full deposit insurance. And this is why when we analyze social welfare, you observe that the scenario with no deposit insurance, welfare is lower. So there's a role to play for deposit insurance in allowing banks to operate with higher leverage and pay lower deposit rates. But that then makes it also optimal to have some interior level of the capital requirement to mitigate systemic risk, indicating that it's not the existence of deposit insurance that is driving systemic risk-taking in our model, but rather the observability of the risk-taking decisions of banks. So let me conclude with this. I will just leave this concluding remarks slide here. There's a couple of extensions in the paper that I didn't have time to cover, which is the countercyclical capital requirements. As I said, they have modest welfare gains because having requirements ease after the occurrence of a shock is going to make equity relatively less abundant after the shock, which is going to make banks take more risk ex ante. So that's why the cyclical capital requirements can backfire. And then we also analyze transition to a low capital requirement to a high capital requirement scenario, but those details you can find in the paper because I didn't have time to go through all of them. Thank you very much.
Okay, thank you very much, Jorge, and you had very rich slides there. I think that they will be posted on our website afterwards for those who were not able to speed read some of those slides at the end. What I found novel about this paper is how it weighs risk shifting incentives against an underappreciated but powerful force, the value of preserving bank capital. Also, your finding is very interesting. The optimal capital requirement of 15% is higher than current standards, but it matches pretty closely with what we see for the average I think for SSM banks. And that you find the capital regulation remains effective even without deposit insurance. I think these are thought-provoking contributions to the ongoing regulatory debate. But our discussant, Alonso Villacorta from the University of Santa Cruz, is going to reflect on the implications of your model. So over to you, Alonso.
Thanks. Okay, so first of all, thanks a lot for the invitation to discuss this interesting paper. In this paper, the authors ask, what is the optimal level of the capital requirement? And they're going to highlight specifically the following trade-off. Leverage can be beneficial because it can help expanding lending and investment in good times, but it can come at a cost of inducing banks to take systemic risks. Now, the common view is that due to deposit insurance needed to prevent bank runs, agents don't internalize the cost of leverage, and that can lead to excessive bank risk-taking. Okay? So this paper is going to propose and quantify a dynamic model that is going to allow us to think about this trade-off. And under their calibration, the optimal requirement is 15%. Moreover, their model is going to provide novel insights regarding the benefits of capital requirements. And they find that they can be beneficial even in the absence of deposit insurance and bank runs. So I'm going to give you a quick summary of the main ideas in the model, and then I'm going to give you a few comments. So in the model, there are two main agents, the workers, who are the lenders, and the bankers, who are the borrowers. There is a frictionless relationship between banks and firms, so we could just directly assume that banks manage the real project or the real capital in the economy. Now, banks have access to two projects, the safe non-systemic projects, which gives us the return on capital, and the risky or systemic project, which is just subject to a common disaster risk. So the idea is that any bank that takes a risky project is going to have a slightly better return in good times, but if the disaster realizes, then they're going to lose a big part of their asset. Okay? The safe return is better than the risky return. But the main friction is that lenders don't observe that the project is chosen, and that can lead to risk shifting. Okay? Moreover, we have bank funding frictions. So the equity of the bank is going to be limited due to some frictional issuance, and the deposits are going to be limited by the capital requirement. Okay? So as in any model with financial constraint, that is going to lead to external finance premium. The return on assets of bank is going to be higher than the return on debt. And moreover, the dynamics are going to feature a financial accelerator in which the aggregate net worth of bank is a key variable. Right? So a shock that reduces the net worth of bank tightens constraint, and it's going to lead to a recession with low capital, low output, which is going to be persistent because balance sheets take time to recover. Now, in this model, the dynamics are driven by this systemic shock chi, which is IID. So if chi is equal to 0, we have deterministic convergence to a steady state. But if the disaster realizes, part of the capital is going to be destroyed, and that is going to affect the net worth of banks as well, of the banks that took the systemic project. So the magnitude of the crisis, the drop in capital and the net worth of banks, is going to depend on this important endogenous exposure variable xt, which measures the fraction of banks that take the risky project. Okay? So let me highlight that the model here is about the severity of the crisis. The frequency is exogenous. That disaster is going to realize with some probability, and the question is how exposed the economy is to the crisis. Okay? So the important variable is xt, so we have to think what determines that. So in the case with deposit insurance, we have that lenders don't care about risk shifting because they are insured. All banks borrow at the risk-free rate. They choose maximum leverage, and that is going to induce risk shifting incentives. Now, there is this interesting dynamic general equilibrium effect in the model, which is that as more banks take the risky project, then the exposure to the crisis and the severity of crisis is going to be bigger. So spreads during the crisis are going to be larger. So it's going to give an incentive for banks to return some net worth in the crisis or to have some cash. How can they do it? By taking the safe project. Okay, so these dynamic incentives, the dynamic general equilibrium effect is going to help with incentives and leads to an interior solution. Right? As more banks take the risky project, there is higher incentives to take the safe project. So now we can think about the effects of capital requirements. The benefits is going to increase skin in the game, lower risk shifting, reduce exposure and the severity of crisis, but it comes at the cost that we're going to reduce leverage, output, and consumption in good times. Under the calibration of the authors, they find that the optimal requirement is 15%. Then they also show what would happen in the case without deposit insurance. In that case, we want to have market discipline. So lenders are going to account for the risk shifting problem, and they're going to charge a premium. The authors show that there is a separating equilibrium in which leverage signals incentives. So we can have systemic banks with high leverage. They take the risky project. Lenders know that. They charge a high rate. And we have the non-systemic banks with low leverage. They take the safe projects. Lenders know that. They charge a low rate. The question is, do we need capital requirements in that case, now that agents take into account the risk shifting problem? Well, interestingly, the authors show that they can be helpful. They can be helpful because they directly are going to affect market discipline. The idea is that the leverage limit is going to mainly affect the risky banks because the safe banks always hold some excess of capital. So it is going to lower the profits of behaving as a risky bank. So risk shifting incentives are going to go down. Capital requirements can still be valuable. Okay? So given this quick summary of the ideas, now let me give some comments starting with the contribution to the literature. So we have other papers that quantify optimal capital requirements, focusing on other types of frictions. For instance, we have the important contributions of LNF and co-authors and Mendicino and co-authors, which highlight that excess of leverage can lead to excess of default, which are costly. Also, we have Begenau that shows that leverage can lead to inefficient bank monitoring, which also affects the return on assets of banks, but in a single bank setup. So this paper complements the literature by quantifying this novel trade-off, which is relevant. The authors also quantify this optimal implementation, transition path to the optimal number, and the optimal degree of countercyclicality, which I found very interesting and important for regulators. But one may wonder, right, how important is to model the right friction? So, for instance, if our goal is to quantitatively find the optimal number, so all of the frictions are going to lead to a nonlinear relationship between bank equity and output, which implies gains from reducing leverage because that's helped us reducing the volatility of bank equity. So I think it's useful to highlight which patterns may be different when we model one friction in one way or the other. So let me highlight one particular pattern which is interesting that appears due to this dynamic general equilibrium effect, which is unique to this model, which is that the longer the booms and the higher the net worth of banks, the less afraid are going to be banks to the crisis. So that is going to induce higher risk shifting and higher exposure to the crisis. So even when the net worth of banks or the balance sheet of banks look stronger, the regulator should be concerned that that's exactly when we have the highest risk build-up on this systemic risk. Okay? So I think that may favor, for instance, tighter requirements relative to default cost models. And I think would favor even more also the countercyclicality of the policy. Then second, of course, modeling direct friction is key. It's very important if we want to understand the mechanism. And this model provides novel insights. So understanding the mechanism is helpful because that can help us with policy design. So let me just make a couple of comments about policy design. Okay, so first about optimal policy. So if the main friction, the relevant friction, is this ex-ante and observability of exposure to systemic risk, can we design a better policy? So for instance, the exposed exposure is observed. Okay? So government knows which banks default and which don't. Exposed, we cannot punish the risky banks because due to limited liability. But can we reward the safe banks? So in a similar fashion to this recent paper by Philippon and Wang, for instance. How? Well, in the model, deposit guarantees are financed with taxes to workers. So we could tax them a bit more and then reward the banks that survived to the crisis. And if the reward is high enough, then moral hazard would disappear. And maybe we will need to tax even less. Okay? So I wonder if something like that would help. My second comment is on the deposit insurance benefits. So the paper highlights that deposit insurance is beneficial even in the absence of bank runs, and even the absence of social benefits of having safe deposits, like a liquidity benefits. None of that is part of the model. The only friction is this risk-shifting friction. Okay? So, but in the model, deposit insurance is funded with taxes to workers. So that implies a redistribution of wealth from workers to bankers, which increases aggregate output, but I think at the expense of workers. So I wonder if the welfare analysis should take into account this cost from redistribution, either implemented like in the model with taxation, or I guess in reality it would be implemented with increasing government debt. Connected to this idea, I think about financing of deposit insurance. So would there be a rationale to finance this back insurance by taxing banks, for instance, instead? So during a crisis, we need to pay depositors. Taxing good banks in a crisis would be bad for incentives. But what about taxing banks in good times? So in a paper that we have at the JFE, we show, for instance, that in certain types of disasters, the optimal policy involves a mix in which we expand the deposit guarantees to banks, but at the same time, we increase the fee that banks pay for this insurance in good times. Now, we have a static model that allows us to design the optimal policy. We also have moral hazard problems, but also there is a benefit from creating safe collateral, which is not present in this paper. But I wonder if some financing in this way would work in this dynamic model. Not sure. I'm out of time, so let me quickly say, what about the shadow banking sector? So there is evidence that shadow banks substitute bank lending. So would the optimal capital requirement change in that case? So it looks like it would mitigate the cost of tighter regulation, but what about the effects on risk taking? I think it would be interesting to consider both regulated and regulated banks in this model, and this model may be ideal to do that. Maybe for a different paper, but I think that would be interesting. I had a question on the consumption dynamics. So consumption suffers more than output and crisis. I wasn't sure why. If we know that we're going to go back to a steady state, why there is no more consumption smoothing. Maybe this is related to a wealth redistribution that happened from guarantees, but I'm going to leave it there. So super interesting paper, super important topic, and new novel insights generated by the model. Thank you.
So thank you very much. Alonso, Jorge, do you want to come back on any of the points from your discussion?
Yeah, well, let me thank Alonso for very nice discussion, very kind words also on the paper. I think he did a great job summarizing the paper in 5 minutes, much better than I did. So thanks, thanks for that. Yeah, I think that the suggestions are interesting. Particularly this one about giving incentives to banks to behave by rewarding them. I guess one might want to consider then political economy implications of this kind of policy, but I guess within the model, something like that might work. But yeah, then the other suggestion or the other possible policy of having this deposit insurance financed by taxes to banks. I'm not sure how that would work, because in these kind of models where you have financially constrained banks, what you typically want to do is, if anything, transfer some net worth from households to these financially constrained agents. Now, in this model, it would depend who you transfer this net worth to, because that you also affect risk-taking incentives. So this would be a bit more tricky in this case, but certainly something we can think about. And then regarding your suggestions of including shadow banking system, I agree with you. I think this is perhaps for a different paper, but I agree that the interaction in terms of the endogenous systemic risk-taking decisions would be something interesting to try to analyze within this framework. And on the question on consumption, I need to think a bit more about this. Perhaps we can talk afterwards. But you're right that typically in these closed economy models with households that have smooth consumption, the fall in output is typically larger than the fall in consumption. So I would need to think a bit more why we don't have this result in the model. But thank you very much.
I think we have a few minutes for questions. I'm going to start with one that I wondered about in reading the paper. You have a lot of emphasis on the endogeneity of capital scarcity, and I was wondering how sensitive the results are to changes in funding frictions, but also and especially on the cost of equity issuance.
Yeah, so this indeed plays a key role. It's this scarcity that leads bank to balance the cost and benefit of taking on systemic risk-taking decisions. Now, we allow for external equity issuance, and this is something that we calibrate to the equity issuance that we observe both during normal times and during crisis. So in that sense, we try to have these costs of equity close to what we observe in the data. We could play around with this parameter, and of course, the easier is to, or the less costly it is to issue this equity would indeed drive the dynamics of the endogenous systemic risk-taking decisions of banks. And that's why we resort to the numerical calibration to discipline what is the cost of this. But indeed, different parameter values would indeed affect the dynamics of risk-taking and so on. That's why we try to calibrate that to the data.
Very good.
Yeah.
So does any colleague, so if you want to ask a question, could you just identify yourself and the name of your, give your affiliation as well, please.
Yeah, Divya Kirthi, International Monetary Fund. So I thought this was really interesting. I think of it as a kind of macro finance model in which there are kind of credit cycles, and it has this attractive feature that, at least as the discussant said, the severity of the crisis is worse after periods of calm. Now, I did want to note that this is a kind of rational expectation setup where everyone is aware of that, right? And so and you cannot do everything in one paper, but I think there is also evidence, including in some of my own work. So I have work that looks at a kind of broad country panel of countries over a long period and shows that when leverage is high and there's a lot of risk taking, subsequent macro outcomes are unexpectedly bad. And I think that's sort of not consistent with the rational expectations framework. And again, so I think the framework is really nice, and it's a nice step in adding credit cycles to macrofinance models. But I do think that having the kind of rational expectations versus kind of cycles in risk-taking or risk appetite view would be relevant for policy implications.
Yeah, thank you very much. So indeed, agents in our model operate under rational expectations. That is why the value of equity changes over the cycle, and it's lowest after long periods of calm, and then that's why it drives banks to take on more risk when they expect, or to mitigate the risk-taking incentives when they expect that the severity of the crisis is going to be higher. Then in a model without rational expectations or some form of learning, so banks forget that there's the possibility of a crisis, that then I guess that would indeed affect the dynamics that we observe. I would need to think a bit more in what direction exactly, but yeah, I mean, so far we decided to stick to rational expectations, following what many have done in the literature. But indeed, I think implications of different set of assumptions would be interesting to analyze. I need to think a bit more about that. Thank you.
Three hands went. I think the one at the back, right-hand side, was up first, and I think I can only really take one more if we're going to stay to the time.
It's me, okay.
Please.
Sabrina Bensain from Wisconsin-Madison. I have a calibration clarification question. So you use the parameter lambda and mu. What's the meaning of this parameter, and how do you calibrate them in the data?
Yep. Thank you. So mu is the excess gains from taking on risk when systemic shock doesn't realize. So and this we calibrate to match. So this is driving the amount of systemic risk that is in the steady state of the model, which we calibrate by allowing the model to replicate the drop in credit when crisis. So the amount of banks that is exposed to systemic risk determines the drop in credit during crisis, and that's the exact moment that we try to target. So what's the severity of, so that the model reproduces the severity of crisis that we observe in the data. Now, parameter lambda is the loss given the realization of the systemic crisis. And this we take from the literature, just trying to replicate what is the typical loss given default when a crisis of this type occurs. Yeah.
Okay, so I saw one hand there and one hand here, and I'll draw a line there. And could I ask, maybe we just ask the questions and then you maybe try to handle both of them at the same time, so that we finish in the time.
Thank you. Hi, I'm Massimo Ferrari Minesso from the ECB. I have a question, also a bit technical about your model. You say, I saw in the slide, is solved with global methods. Mm-hmm. I was wondering if there is a role for uncertainty in the model for pure uncertainty. So when shocks become, let's say, more volatile, what happens to the, I guess there is something on the tail and the distribution that is where the deposit insurance kicks in and not. Thanks.
And then one here.
Daniel Diekelman, ECB. I make it quick. How confident are you, given that the model is calibrated on the US, that the 15% would also apply to the euro area, for example? And would you have an educated guess in what direction it might change if it's not? Thanks.
Okay, thank you. So first, regarding question by Massimo on global methods. Yeah, indeed, since we are using a global method to solve this, this would allow us to capture, for instance, shocks to the probability of the crisis happening. So that would be like a change in the volatility, right? or shocks to the distribution, so mu and lambda, the parameters that determine risk-taking gains. So indeed, I think shocks to this volatility would have an effect on risk-taking and then the severity of crisis and so on. So our solution method would allow us to capture that. Regarding the validity of our numbers for the euro area, I have to say I'm not completely sure. So if we were to model to calibrate our model to the euro area, we would have stronger relative importance of the banking sector. That might call for, that would give, on the one hand, that would call you for, that would call for stricter regulation in that you want to isolate your banks because they are relatively more important for your output. You want to isolate them from the occurrence of the crisis, but then at the same time, so the severity of the crisis would be higher, then these banks would have more incentives to preserve their equity. So perhaps you wouldn't need as stringent regulation. So that's an interesting trade-off that you would have there. I'm not exactly sure what would be the answer, but that would be something the model might be able to.
I think you helped us already to get a sense for the sensitivities. So I think two great questions, two great answers. Now we can move to the second part of the session. Totally different topic, climate. Our second presenter is Matthias Röttner from the BIS and the Bundesbank as well. So he's going to present joint work with Matthias Kaldorf, and it's offering a nonlinear macro financial model where ambitious climate policy can paradoxically trigger financial instability in the short term. They call these climate Minsky moments. So over to you, Matthias.
Yes, so first of all, thank you very much to the organizers for including the paper in the program. We're very excited about this. And then let me also stress these are just our own views and not of our employers. Okay, so with that said, so the paper is called Climate Minsky Moments and Endogenous Financial Crisis. And really like the motivation for us to write this paper is about this prominent narrative. And this is that climate policy decreases financial stability. And what's the kind of like the broad logic behind this is that carbon tax, they reduce the return on assets. You can have also like stranded assets, which basically results in losses for the financial sector. And if these losses are large enough, there might be a financial crisis. And kind of like this terminology, climate Minsky moment, this was coined by Mark Carney. And kind of like, and so we like a lot this terminology, so we took it over for that paper. And the question that we ask us here is like, what's the connection between climate policy and financial fragility? And in particular, we want to understand, are such climate Minsky moments, like to what extent are they actually a relevant threat to financial stability? And if they are a threat, are they actually does some financial stability concerns, are they like kind of like a valid reason to delay the climate transition? And here we also like kind of like try to look at the welfare part of it. So we kind of like put the welfare relevance of the climate Minsky moments. We compare them to other costs of the green transition. And then we also have a few implications for policy, like macroprudential and monetary policy. And so how do we address this question? And where we start off is like by building like a new macroeconomic model, kind of like combining two key features. The first one is we embed the climate policy in this model, and then we also allow for endogenous financial crisis here. And because we have this endogenous financial crisis combined with this, like I would say, like a very conventional climate block, we can look, so to what extent does this possibility, are there these climate Minsky moments in the first place? And here what is very nice for us, this possibility of these climate Minsky moments, they depend on the state of the economy. Yeah? So it's not like something exogenously imposed, but it's really like endogenous here. So because we have endogenous financial crisis, if you then have like climate policy, they affect the probability of observing such a crisis. And to do this properly, we solve the model also non-linearly with global methods here. And then what we observe, or what we can evaluate here, is the impact of the climate policy stance on financial stability. And we basically look at two very related things, but the first one is that we look at how does like accelerated transition, which is aligned with the Paris Agreement, how would that affect basically financial stability during the transition to net zero. And then we also compare and look at the long-run financial stability implications in a world with zero emissions. And then the other one is that, so we look at this financial stability implications, and then we go to because the nice thing about having this model here, that we can do welfare analysis with it. And we have a quantitative model, so we can basically compare the relative relevance of these Klein-Minsky moments versus the real costs and benefits of curbing global warming. And then we can look at the implications for policies. And so what are our results in this paper is that if we look at the impact of climate policies, or like we see that during the transition initially, actually, it decreases financial stability. What is the logic behind here? I think this is really like this initial narrative we started off from, the kind of like the now that the return on your capital declines, which kind of like gives some deleveraging pressure on intermediaries combined with losses in the financial sector. And then what the results is that there's some fire sales here, and then this kind of like makes the crisis more likely in the first place. So here, kind of first result that kind of like in the short run, there is like an increase in the crisis probability, so we have financial fragility coming from this transition. But if we then look in the long run, and this is maybe like a perhaps surprising finding, is that we find that climate policy increases financial stability. And so why is that the case? What we find is that because climate policy is costly, this reduces aggregate capital holdings, and so we have a smaller financial sector and also a less leveraged financial sector, which has a positive impact on financial stability. And I mean, you can kind of like this comes back to this idea, I think first, at least once formulated by Joan Robinson, where enterprise leads, finance follows. So because we have now a smaller real sector, we also have a smaller financial sector, and this is then more stable. And because we have these two opposing effects. In the short run, we have this increase in fragility. In the long run, we at the same time have this positive impact on stability. So we basically, so we need to weigh off these different ways. And this depends on the social discounting. And if the policymaker is sufficiently patient, there is no trade-off. Or like there's really these long-run effects, they are dominating, but conditionally on the policymaker being sufficiently patient. And then the other one is like, then we look at the welfare effects of the Klein-Minsky moments, and we compare them to like the costs of doing the costs of carbon taxation for output, but also like on the gains of limiting temperature increases. And what turns out is these Klein-Minsky moments are, based on our model, based on our calibration, they are second order at most. Yeah. Before I come to more details of the paper, let me also put the paper in the context of the literature. So there is this stream of papers on financial crisis and quantitative macroeconomic models. What is our contribution here? That we put this climate dimension in, and we look at Klein-Minsky moments here. And then there's also very exciting papers about environmental macroeconomic models with financial friction. Here, really, the difference is that we have this endogenous financial crisis, and this in a quantitative framework. And so also I compare to other papers that look at financial stability. What is nice here, we can look at the impact of the transition in the long run, and we can look at the welfare dimension here from a quantitative point of view and through the lens of our model. All right, so I think this is the brief overview of the paper. Let me now go a bit more into detail of the model. So we have a nonlinear new Keynesian model with the two key features. And this is like first that we have this endogenous runs on the financial sector. And then we have the second key feature is that basically firms emit carbon, and carbon is subject to a carbon tax. So this is our climate policy, and that is in the climate policy, this is chosen by the government. And because of this carbon emissions, they face basically an endogenous technology choice between dirty technology and a clean technology, but the clean technology is costly. And so to round up the model, the key agents and elements in the model are households. They consume work, they invest, and also they run in our context. We have the financial intermediaries, the intermediate between households and firms, and they're subject to runs. Then we have the non-financial firms. They produce output and they emit carbon. Plus they have this endogenous technology choice, and they face this carbon taxes. Government and monetary authority. And then also what we do is to account for this, the climate damages, we make the temperature increases, they induce utility losses, which is quite nice because then we can like separate the different channels. And so there we focus mostly on transition risk. But with that said, we also have an extension where we include physical risk, and actually the main takeaways are robust, or they don't change even if we include like physical risk in the model, instead of like this way overlooking on the impact on the utility. Okay. And so the non-financial firms, they produce output using labor and capital, they emit carbon, they pay carbon taxes, and they can adapt their technology towards a clean technology. This clean technology is less productive, but it does not create emissions. And these emissions are proportional to output and the share of the clean technology, and all the unabated emissions are basically taxed at a rate of tau c. And so if the carbon tax is sufficiently high, basically the emission intensity is falling, and if it's basically above the net zero level, then it's basically for every firm good to invest in the clean technology, and we have a zero share of dirty technology. And this basically can then be this cost to comply, the compliance cost with the carbon tax kind of consists out of two parts. The first one is the tax bill, so coming from this if you emit carbon, that you need to pay the carbon tax. But then the second one from this adoption towards clean technology, that you have this productivity losses. And these productivity losses and the tax, they both reduce the return on security. And because they affect the return on securities, what we have is that the carbon tax affects the fire sale price of capitals or securities in our model, and thereby it also has an impact on the financial crisis probability. To kind of like finish the climate block, so this is what I talked before. So households, they get some utility loss from increases in temperature. So basically we follow there like a paper by Acemoglu. And then in the paper, we look basically to map this. We look at global temperature changes relative to pre-industrial level. And we map this temperature change to the cumulated emissions from our non-financial firms. And so we have basically the delta T we get out from the model, and then we can back out the utility costs. All right, and then the financial sector here, we have that these households, they hold deposits and securities, but the point is for the households, it's costly to hold too many securities, or like more than a target share. So they are less efficient in managing securities than the financial intermediaries, following like, for instance, Brunner-Meyer and Sannikov. And these financial intermediaries, they at the same time also have some financial frictions, so they face risk-shifting incentives, and they're also subject to the runs. And what we have here is that the securities, they pay a stochastic return, and they are tradable. So they're tradable with the households. But because, and here the important thing is that these securities and their return, this depend on climate policies because they affect the return and therefore also the price of the securities. And then they are subject to limited liability, which kind of like also distorts the choice in the risk profile of the securities they choose. And what we have is we have kind of like here endogenously determined size and leverage of the financial sector. And kind of like this gives us, based with volatility, we have some credit boom gone bust story here in the model. So like underlying this credit boom gone bust story here, and then we have on top that we add this climate policy. So how does this credit boom gone bust work? So we have that there's like runs on the financial sector. The households, they withdraw the deposits. In that case, the intermediaries, they need to sell their assets because of the withdrawal of the households. But the problem is that now the entire financial sector needs to sell their assets, and the only buyer is the households. But the households are less efficient, so they're not really willing to buy them for the original price. So they need to, the intermediaries need to sell it at a fire sale price. And if this fire sale price is sufficiently low, then the run is possible in the first place, and intermediaries cannot repay the households. And importantly is that this return and the fire sale price, this depends on the carbon tax as well, and this is how basically the climate part, or climate Minsky part, can come in here. And what we have is then basically we can partition, this is now a bit techy, but the idea is here, depending on where am I in the, let's say, business cycle, financial cycle, I can partition my state space into two regions. I have a safe region and I have a fragile region. And the safe regions, even if there would be a run, the intermediaries can always pay back the depositor, so there's no runs. And if you're in the fragile regions, they cannot pay back, so then the runs are possible. And here, because we have this endogenous in which region we are, economic, financial variables, but also climate variables determine in which region we are. And once I'm in this fragile region, then we have multiplicity of equilibria, and then like a sunspot shock basically helps as a non-fundamental coordination device if we have a run or not a run. Okay. So that's the model. And then we calibrate the model to salient properties of the financial cycle. And the climate block we set to conventional values. And to give you like one key value, the carbon price is around $143 per ton of carbon dioxide. And with this carbon price yields full abatement. In that case, that every firm operates the clean technology. And I mean, maybe like if you look at carbon prices, you maybe would think this is a tiny, like a bit low price. At the same time, you need to think here that for us, it's like we have only one sector in the economy, and this entire sector needs to pay. So, and in reality, there's often like some sectors that don't need to pay, they're less affected. So that's why like our carbon prices may be a bit lower to what you see in other papers. And we solve the model with global solution method because we want to account for these runs and we want to have the nonlinear dynamics. And importantly is also that we want to have this nonlinear solution to cover the transition path to net zero. Okay. So now finally, after we have covered the model, let's come to the results. And the first result, what you can see here, is basically we vary carbon taxes, and then what happens to the emissions, how many emissions are abated, and what happens to the crisis probability. And what you can see, of course, if I increase my carbon tax, more and more firms adopt the clean technology, and for like sufficiently high carbon price, I have a full abatement, so no new emissions. At the same time, you can see that the crisis probability is falling. So what I told you initially, in the long run, financial stability actually increases. And why is that the case here? And what we have is here that the idea is that carbon tax have this negative effect on aggregate capital accumulation. And so the capital security holdings in the new long-run equilibrium are lower. And kind of like this idea here is that the economic development shapes the demand for the financial system, coming back to this kind of like summarized like early on by by John Robinson in this quote. And then if we have a smaller financial sector, basically we have households are able to absorb more assets from the financial intermediaries. And so we have less runs. But now things are, so this is the long run perspective, but what happens during the transition? So how does the transition to net zero affect the financial stability? And to evaluate this is we first need to define the current trajectory. So this is our starting point, is the current trajectory, and where we basically, we look at the yearly global emission intensity reduction and we extrapolate this. And then based on this, like starting in 1990, we find that until 2023, that is kind of like around 1 percentage point annual reduction. So we would reach, so we assume that net zero would be reached in the current trajectory in 2090. And then comes our scenario where we deviate. Now, like we have a more tight climate policy stance, which we call here the Paris-aligned scenario. And here we have we now there's an unexpected shift towards a tax path consistent with net zero in 2050. And this is in line with the Paris Agreement, and this tax path shift happens unexpectedly in 2025. And then once this shift is announced, we assume full commitment by the policymaker. And then also we have like a last scenario, which we call tax-free scenario. So instead of like going from the current trajectory to a more tight stance, instead you could say, we say here, okay, now we just stop at 2024, the climate policy, and we just stay on the 24 level and we don't increase the tax further. Okay. So these are the transition dynamics based on our model. And in the top corner, you can see the carbon tax. So, and there you can see for the blue line, which is our Paris-aligned scenario, basically we would have the carbon tax that gives net zero would be reached 2050, in the current trajectory 2090, and in the policy freeze, you can see it stays then constant from 2025 onwards. And as a consequence, of course, under the Paris-aligned, emissions are earlier falling. And then if we look at the two key variables in our model, is in the bottom here is the crisis probability as well as the temperature increase. And what we can see here for the crisis probability, that because there comes this unexpected shift to a more tight climate policy stance, we have this increase in the crisis probability. Yeah? So the blue line goes up, and kind of like from a level a bit above 2%, we go close to 3%. And this is the annual crisis probability here. And if we compare this to the current trajectory, we see this increase, but then we also see that kind of like around a bit before 2050, there's a flip. So then the blue scenario, because we have this positive long-run impact, so then you see that the crisis probability is lower. And what you can see, like what happens if you do a policy freeze, like this unexpected shift on a more a less ambitious climate policy, like initially, like the crisis probability drops, but of course then it stays constant because you don't have this change in the long run here. And then the other one is the temperature increase. Of course, the more tight or the more ambitious climate policy I do, the less temperature increase I have. Okay. So what you key part here is like you see this. Basically, we have this, it's not clear because we have this difference between the short and the long run in the transition for the crisis probability, and therefore we kind of like want to back out what is the net effect here. And of course, to kind of like assess this impact of climate policy, we need to take into account ordinary Minsky moments, or like just like financial crisis that would happen even independent of any climate policy. And then of course, to basically get this weighting, we kind of like, we need to put a stance on the value of what happens in the near future versus in the long run. So it depends on the social discount factor. And what we define, we use like this notion of the excess crisis probability here. So we define what is the probability of a crisis under like a Paris-aligned scenario versus under the current trajectory over the future, and we discount using the social discount factor. So this is our excess crisis probability to look at the financial stability. And then we also want to back out the welfare effect that is associated with this climate Minsky moments. So here welfare depends on consumption, labor, capital management costs, and also temperature. So like there's like all these different elements in. So the carbon taxation is costly, but we also allow by having this impact of temperature on utility that if you keep emissions lower, that this is then welfare, has a positive impact on welfare. And here we calculate the welfare cost of climate Minsky moments, and therefore we need to use counterfactuals based on the run probabilities from the current trajectory. So that we want to back out here the welfare cost of this climate Minsky moments under the Paris-aligned scenario versus the current trajectory. And so this is the results here. So I mean, it's a lot of values, but let me go through, and then I think it becomes more clear. So on the left-hand side, which is the blue bars, you can see the climate Minsky, and you can see the impact on welfare, which is on the left axis, and you can also see this excess crisis probability. And then and this is not very well cutted for me, because in the bottom, what you should see would be the social discount factor. So basically, if I'm very patient, which is like close to 0. In that case, like you have a positive impact on welfare because these long-run effects are even dominating, and also this excess crisis probability would be negative. And then at one moment, if you are less patient, this effect flips. So in that sense, you have these welfare effects of climate Minsky. They depend on how patient you are. So this is on the left-hand side, and then we look at the right-hand side where we basically compare, where we look at how relevant are climate Minsky, which is the blue bars, versus the temperature gains of more stringent climate policy, like the Paris-aligned one, versus the abatement costs. And what you can see that, like, if you're quite patient, then the temperature gains dominate, which is the green bars, they dominate the abatement costs. So in that sense, there's a positive impact on welfare. But then what you can probably not see here is the climate Minsky, the blue bars. So we did not forget them. It's just they are so tiny here because they are really second order. So if you look at the left-hand side at the axis, the values are so much lower than on the welfare decomposition. So here really like key result for us was that in this model that the climate Minsky moments are second order. Okay, and then we were like, okay, so how robust finding is that? And what we did, I think we did really many reasonable variations in the climate block to look at this, what happens to this result. So here, kind of like variations in which the period of net zero is reached. We have higher abatement costs, larger losses from climate damages, extension with trend growth, kind of like technological progress, directed abatement costs. We put the physical risk extension in. But, but really, like this result is was really robust, and we to this reasonable variations in the climate block. And so let me, I think I have 1 minute left. So then we also used our framework to analyze the policy implications. And we can, let me quickly focus on the macroprudential ones here. And one really key feature is about like how relevant or how much is the impact of a more stringent climate policy depends to a very large extent on the financial cycle. I mean, so if the climate policy comes at a moment when banks are highly levered, then it really can create some risk. But if the financial sector is very stable, like this will have barely an impact. So in that sense, really like if there's sufficient buffers available initially to basically to absorb these losses from climate policy, then there's no threat of this climate Minsky moments. But we also look at monetary policy, and there we would say that if you have this unexpected shift towards a more stringent climate policy, like the model for financial stability would suggest a more loose monetary policy to help stabilize the sector. So which kind of like would, sorry, last time I go back and forth. So we kind of like don't find I mean, you could think, should monetary policy basically lean against the transition? And we say, like our findings is it should not lean against the transition. Okay, so let me sum up. So we look at the threat of climate Minsky moments. We built a new nonlinear macro model, which combines climate policy and financial stability. And now let us revisit the starting narrative here. So we have climate policy increases financial fragility. And what we find, indeed, that's the case. There is some substantial elevated increase in the crisis probability at the start of the transition. At the same time, in the long run, effects turn around. And if we look at the welfare implication of the climate Minsky moments, so there is no trade-off between climate policy and financial stability, conditional on that you're sufficiently patient, and the effects of climate Minsky moments are second order. And I think this is really a result that are, like very. We tested the robustness a lot by varying the climate part. And second order, let me say this, against the costs and benefits of curbing global warming. So I mean, our model would give an indication that these climate Minsky moments are rather manageable risk. Thanks a lot.
So thank you very much, Matthias. I mean, I think you're also a trade-off shown in this paper. I think it's very intuitive. Rapid carbon taxation can increase the probability of a Minsky moment early in the transition, but it reduces in the long-term fragility by shrinking the leverage of the financial sector. The key insight, I guess, is that forward-looking policymakers may not face a trade-off at all. It speaks a bit, you started with Mark Carney's Minsky moment terminology. He also had the terminology of the tragedy of the horizon. I don't want to put you on the spot on that now, but maybe it's something that we can pursue in the discussion, but maybe to think about how your paper speaks to that tragedy. So our discussant is Ghassan Ben-Mir. And you're there already.
Thanks to you. Exactly.
So please, go ahead.
Well, thank you very much for having me and for inviting me to discuss the paper of Matthias and Matthias. I know that I'm the last one holding you for the lunch break, so I'll probably try to cut to the chase. So I think Matthias did a fantastic job talking about the paper, but let me just summarize it a little bit in the way that I thought brought a lot to the literature. So I think the research question is really, how does climate policy interact with financial stability, and whether there is some concerns with respect to that, which is a very timely question to ask at the moment. And they try to answer it using a macro financial model, so a DSG model with climate block, where there is a nurture literature trying to really push forward this sort of like interactions. And the links will be through climate carbon taxation. So we'll be mainly focusing on transition risk in the specific context here that we're trying to look at financial stability. So I think the key mechanism and method that they bring to the paper is this idea of risky transition. And I think the last point that Matthias was trying to also highlight, that is probably second order, especially when we're thinking about it in the context of carbon pricing, so transition risk. They use a global solution method to try to answer this sort of question, and they essentially try to address these quantitative trade-offs. So, as I said, it's very timely and relevant. I think the question at the moment is quite important, especially in the context of Europe. There is an ambitious scope, so here we're trying to endogenize these financial frictions and the runs, which is probably the big novelty, at least from a core mechanism here, where the previous literature has not necessarily focused on that. And I think there is also a methodological contribution whereby trying to solving the model using a global nonlinear solution. Now, probably jumping right into it, I think the following comments are mainly comments trying to address a couple of questions that I thought would be important, especially when we're trying to speak to different type of literatures. So one of the things, and here shamelessly naming one of my own papers, that trying to look at essentially these cross sections between macrofinance and the climate. The idea is that something that comes up quite strongly is the presence of two types of capital. So there is this substitution between green and brown energy that is from fossil versus energy that is renewable. And that can be quite important, especially in terms of the transition, this element and the substitution between both. And if we think about like those substitution parameters can be really key mechanism in basically driving the results that could potentially alter, at least quantitatively, the results that you have. Given that we already know from the work of Papageorgiou that essentially the elasticity of substitution between fossil and renewable is actually higher than 1. So that would be easier to substitute along the transition, and that could play an important role. So maybe something that you might want to probably address, if not necessarily have in the model to keep it more tractable, probably more discussed in light of the work of Frick van der Ploeg and others that have really looked at this a lot in the context of stranded assets. I think another point, and this relates to just the previous presentation, whereby grounding it a little bit more, at least the literature has looked at financial stability and climate, especially in the context of transition risk, and you list a couple of papers in your lit review, have looked at it mainly from the perspective of having a balance sheet and potentially a financial accelerator, which could bring a little bit more propagation impact and could further dampen the results that you highlighted on welfare. Maybe it's not necessarily also where you want to take the paper in that direction, but it might be worth discussion, especially in light of what people have done in this specific type of work and literature. And I guess I had one point with respect to the new Keynesian part, which I thought like I didn't understand a lot. Why do you have it in the paper? Is it really necessary? Because during even the presentation, we barely touched on the inflation dynamics, which raises the question whether it's a really important element for the story. So maybe it could be good to probably just highlight a little bit more this section, or at least why is it important or not. And now jumping probably on the climate dynamics part, I tried to actually structure the discussion following the paper structure, going from the firms, financial intermediaries, and then the climate block. So in the climate block, there's been, and I think the first point was just to not forget, so it's a miscitation that we usually have in the literature. In fact, the reduced form climate dynamics that you use in the paper is a Matthews and al. Science 2009 paper that has been reused quite extensively by a lot of papers. I think Jesus's paper basically bring it up in their literature review, I think their latest paper. But there've been a lot of recent work that tries to challenge this sort of reduced form, or at least the climate block model, because in the context of your work, I think it's going to be quite important in the welfare analysis, especially because that's what will be driving the climate damages. And the recent work of Follini and al. Review of Economic Studies 2024 tries to revisit the early work of Nordhaus, where we have a little bit more complex climate dynamics. It might be worth it to try to probably at least see how those climate dynamics you have in the model relate to the Follini and all, especially in the context of the social cost of carbon and the damages that they do have. And I guess you probably already touched base on this. I didn't have it on the, I was checking the previous version before, but you sent me a newer one. So you said that you have climate damages now on the production side, so probably you can discard completely my comment in this specific sense. But the idea was that it's important, at least from a financial perspective in this specific case. And I think this one is probably worth just more also a little bit of a discussion. One of your laissez-faire scenarios, you keep emissions constant, so emissions never move, while what we do observe, and that depending on which kind of calibration you're trying to pursue here, and I understand through your paper you're trying to keep it a little bit more broad, so you did not commit to a country, or you did not commit to an economic zone, but it might be worth thinking about maybe just one or the other. So you can see that the emission dynamics are very different if we consider the whole world or if we consider the EU. So one of them is going down, the other one is trending up. So it might be important to at least discuss this or highlight it a little bit more. But I do not think it will change substantially the result. At least if you take the whole world perspective, it might give you even stronger results on welfare. And this last point is about the core mechanism, and I will probably just focus on one important element here, which has been highlighted a lot in the climate macro literature, and that's starting from the early work of Nordhaus, is the focus has been a lot on the social cost of carbon, or at least what we might refer to as the optimal carbon price. In your specific context, you take carbon pricing as exogenous, so we're trying to reach a net zero by a specific period. Maybe that's probably not necessarily a bad thing per se. We'll take the status quo, whether that's happening or not, that's a different type of question. But it might be worth probably thinking about how would your whole dynamic and discussion on welfare interact if we have an optimal carbon pricing, and how would essentially also the runs impact the social cost of carbon or the optimal pricing. It could be done in the context of a net zero policy if you don't want to compute the social cost of carbon, which is just the sum of the discounted damages that we have from today to infinity, or you could discuss it just of what would be the optimal price to net zero. So, but it could be important at least to try to understand the interaction between the macro finance and climate and vice versa. It might be interesting in this specific context, because you have the whole machinery, and I think it's quite interesting. I mean, the paper is very rich and very dense. I do understand that these are extra comments. They might not necessarily need to be answered to or added to the model, but it might be just worth probably commenting or discussing a little bit further, given that's what the focus of the literature has been for quite some time. And I think I leave it just with a summary, which are these main points that I basically highlighted. I think the paper is very beautiful, very timely, solved with non-linearities, which is quite important, especially when we're speaking about macrofinance and climate both together, and already addresses a lot of the points, I think, in the robustness, what you basically highlighted at the end. So my comments are mainly points that might worth just addressing, not necessarily doing them, but probably more just trying to discuss them within the paper. But I really like it, and best of luck with it. Thank you.
Thanks a lot. Thanks a lot, Ghassan. He said very beautiful. You don't hear that very often. You have 2 minutes to respond.
Yeah, perfect. No, like, first of all, let me really thank you, and I think for the great discussion. I think also, like, I think you mentioned very important topics. So I mean, I think one issue that always comes up about this paper is the two type of capital, and we have this version with, I mean, clean and dirty technology in the more recent version. So one issue, like what often people suggest, is like to use a Cobb-Douglas production function with brown and green capital. But there's actually a big issue if you think about in the context of net zero transition, because I mean, you can actually not go with such one to like a full net zero transition. So then you would have to have like green and brown, and the brown you either have endogenous abatement, or you need to still combine it a little bit if you really want to think about the net zero. That's why we use our current version also, because we want to a bit keep this idea of stranded assets, which I mean comes there often up a lot. So. And with that said, in our appendix, we discuss if we would, because it's a really important issue, so I fully agree. But in our appendix, we discuss like 3 other very typically used production functions. And I mean, the basic insights all go through there. And let me also defend a bit the financial intermediation part. So this, what the financial friction we use is based on work by Adrian and Shin and by Gallo Nuno and Thomas from Banco de España. And it's basically a way of micro-founding a value at risk constraint, like in a very nice setup. So we really like this friction. That's why I used it. And what's the big advantage of this one is that it gives you endogenous boom, gone bust cycles if you combine this with a run. So that's why we have the very specific one. Of course, you probably lose a bit on other sides while using this one, but I think that was the motivation for us to do it. I mean, the New Keynesian part, this is just, it helps for the quantitative part, and we both work at central banks or at some institutions related to it, so it's good for us to keep it. I think the last, very important point from you was on the social cost of carbon. And I mean, in a way, what we don't have optimum policy, we just assume the carbon taxation. But I still think the paper speaks a little bit to it. I mean, number one is that, okay, financial crisis concerns are not too important, so which could say it's second order when you do the maximization. And really depending on the state of the financial sector, so there is some time dimension. Depending on the state of the financial sector, there is a different impact on the financial crisis probability in the short run. But thank you so much for this. And I think you raised even more important points, but in interest of time, I will skip them. Let's talk later.
Okay, so we have a few minutes for discussion. I'm going to, there's one question that preyed on my mind in terms of the results when you showed the different paths for carbon taxes. I mean, is your paper saying that the Paris-aligned carbon tax path is too rapid? Or could I maybe phrase it a different way? Are you saying that if we had more phased sector-specific carbon tax introduction, you get that short-run instability, but without sacrificing the longer-term stability? Could you? I mean, I wasn't clear on whether they were boundaries or whether you could even presumably you could have worse outcomes. And then maybe if you could just elaborate for a second on, you said briefly en passant at the end, it was a question that I would have specifically asked about. You said macroprudential policy shouldn't really respond to this transition period, if I understood you correctly. But maybe you could just elaborate a bit on my understanding.
Okay, I think let me start with the last one. I think there was probably too much rushing, so I was not clear enough. No, so what we find about is that the financial cycle is very important. So I didn't show you, but really depending on what's the state of the financial sector, if I introduce this initial financial crisis probability is much higher or basically close to zero. In that sense, macroprudential policy plays a huge role. I mean, if you have enough buffers to basically absorb these losses, then this climate policy will have not a big impact.
Okay.
And I mean, I think about is the carbon tax too fast? I mean, we played with some deviations around. I mean, you always have a bit this trade-off. I mean, at the same time, if you make it too steep initially, then you create this surprise element, this increased instability. At the same time, of course, by reaching, in our model, we assume that temperature depends on emissions. I mean, of course, the earlier I reach net zero, I mean, my utility or my welfare is also better off. So I have a bit this trade-offs. And I think the other trade-off that you mentioned before, and I didn't, was the tragedy of the horizon. And this, again, I mean, fully is also in our model in this.
It's in?
Basically, yeah. This depends on the patience of the policymaker. If you're very impatient.
So what do you need, a long political cycle, or what is it? Yeah. At the back, and then, so you're next, and then, and then I think I have to draw a line there. So we got three. The colleague here.
can you, okay, now you hear me. Massimo Ferrari-Minesso from the ECB again. I have a question on the quantitative implication of your model. So if I understand, this is the SG model solved with some kind of rational expectations, non linearly. And we know that in this model, we have an issue with shocks that are announced in the very, very future, the forward guidance puzzle. And I'm a bit here oversimplifying the discussion by Gabet, but if you write the IS curve, there is no discount factor on future output. So all this big movement that you see today can be actually, an effect of the specific solution method that you use, rational expectations, that we know are particularly, let's say, have households that are particularly overreacting to things that are announced in the very far future. So I thought how much this is in the result of the increased riskiness and how much that can be mitigated with the, for example, behavioral discounting, the trick by Gabet. Thanks.
Yeah. Should I take them?
Yeah. Let's gather them, actually. Good idea. Sujit.
Kapadia from the ECB, so thanks, super interesting. Two quick things. One is just about the long-run properties of the model. So maybe I think I must be missing something, but you're saying that the capital stock will be lower, or capital accumulation will be lower in the long run. But my intuition would have been, if you tackle climate change, we'll have fewer natural catastrophes, and therefore capital stock will be destroyed less, and therefore the capital stock will be higher in the long run. So I'm kind of confused as to how the capital stock ends up lower, given you're going to have less destruction of capital from catastrophes. And then the second point, which is I think related a bit to what the discussant mentioned, was around, you said monetary policy should loosen at the margin in response to the short-run dynamics, but what's going on with inflation in the model? Because in our own projections, we say ETS2, for example, is going to add 0.3 percentage points or so to the 2027 inflation projection. I mean, what's going on? Carbon tax is probably going to exert upward pressure on inflation. So how does that factor into the calculation? Thanks.
And one here.
Divya Kirti, International Monetary Fund. So I think that the right way to interpret this model is that it is a global model in the sense that in your model, when you apply the carbon tax, climate change is abated. And I wonder how things would look if you had a slightly different model where there are two parts of the world and one of them implements the carbon tax and the other one does not.
Tricky question. Okay. So
yeah.
Do your best.
Yeah, so let me start with the rational expectations. So we have rational expectations. I mean, you could go away from it, but I think it's a great benchmark. And I mean, kind of like the runs, they are like in the model, you have them with rational expectations, but they are like a tail risk. Okay, but then coming to your forward guidance shock, I mean, so we haven't played this through, but I'm not too worried because what we have done is kind of like temporary shocks. Like we don't show, but we have played around by having like temporary climate policy shocks, and they give the same dynamic. So, I mean, of course, you have some implications from rational expectations, but I don't think they turn the idea of the paper around. And this strong increase is really, it's not driven by the losses later on, because later on you actually have lower financial, you have increased financial stability. And then I think this was a very, thanks a lot. First of all, thanks a lot for all these questions. And then, I mean, like about the long run effect, and I mean, you're very clear, like that's a very good point that you highlighted here. So when we talk about the long run, we talk about the transition risk here. And then because of the transition risk, I mean, because carbon taxation, we have lower capital. And then and that was our baseline case. And then the extension, exactly. I mean, if you have physical risk, you get this opposing effect. But we kind of like, I mean, then depends, I mean, how quickly do I go to how quickly do I do the transition? Because indeed, you're completely right. If I do the transition fast enough, then I have less climate damages and would have a larger financial sector. So we have this extension. I mean, still in our case that the main takeaways were unchanged, but you're completely right with that one. And about monetary policy, I mean, we said like, I mean, I think the idea is like of course we don't look at inflation. I would say also the model has inflation. Inflation response is too little to be fair about the model. But here's just like, if from a financial stability perspective, if you have this, then that would be what the model would suggest as the receipt. And then the last question, I mean, no, I mean, this is always, I think it's always a very good question. I mean, going on more like, I mean, how should you do the world? I mean, and how should you model this? And I mean, I think also you already touched on this. And yeah, so we kind of like, we don't really take a stance here. I mean, we want to keep it more general. But of course, I mean, if you, I mean, for instance, there is, I mean, like now we have that your carbon taxation has a positive impact on the temperature. But if you're a small open economy, of course, that channel is not there. So there's some assumptions behind it that we take, and it's just very hard to relax them. Okay, thanks a lot.
Great, thanks a lot, Matthias. So let me wrap up with a few reflections on the two papers. I think. Well, one question you might have asked at the beginning is what links these two contributions. One is about bank capital, the other about climate policy. I think is that systemic risk is not just about bad luck, it's endogenous. It was endogenous in both pieces. It's about incentives, and critically, it's about timing. I think Jorge's paper teaches us that capital requirements are a powerful tool, but their design must balance leverage, equity preservation, and systemic exposure. The surprising takeaway, even without deposit insurance, they remain vital. And I think Matthias' work reminds us that climate action, while necessary, it can strain the financial system if it's introduced abruptly or too abruptly. But over the long run, that same climate policy becomes a source of stability. So in both papers, it's not simply the tool that's in question, it's how and when it's used. So let me thank our presenters and our discussants for this rich and enlightening discussion. And then I think we adjourn for a buffet lunch.
So good afternoon. Welcome back to the conference after the lunch break. And it's my pleasure to introduce the keynote speaker today, Thomas Philippon, who is a professor at the New York University Stern School of Business. He has probably needs no introduction, but I'll do a short introduction nevertheless. He has worked on a number of topics, obviously, and he has a rich background, including, I think, having studied physics, which normally is an indicator of that you do things seriously. Sorry for the non-physicists. But also, I mostly associate you, to be honest, with your work on free markets and the lack of free markets in the US. But of course, you have worked on many other things. In another, work that I know you have done is on human capital in the finance industry. What is the productivity of the finance industry, which is also an interesting topic. I know that you also, you have a long list of publications. You are a co-author of Philippe Martin, who is, normally is a very good sign. I think Philippe today, Thomas, sorry, so now still with Philippe Martin. Thomas today will speak about, risk management approach to Macropru on financial risks, and I think it's a quite encompassing presentation. So without further ado, I leave the floor to Thomas. Again, thanks for coming, and thanks for coming all the way from New York also. Thank you.
Good. Thank you all for coming. So it's a pleasure to give the keynote speech here. And I was thinking about what I was going to do, and initially I had something a bit more modest in mind, focused mostly on stress testing, but then after Randy's dinner speech last night and discussions with various people, I decided it was a good idea to be a bit more ambitious. And so I'm going to propose a framework that I think is maybe the right one, or at least useful to think about macro risk management. And you will see that it touches upon maybe not all, but I'd say most of the papers that we've seen in this conference. So the outline is, I'm going to show you a framework where you can think about crisis resolution down to the very granular level of exactly which instrument you use to solve what type of crisis, all the way up to designing stress scenarios. And I'll emphasize that even that framework, which is not, it stays within the realm of mainstream economics, you get surprising results regarding moral hazard, what it means, how you should worry about it, and also it makes very strong connections with the prudential supervision of banks and financial firms. So for instance, PCS that we had this morning, I think are very important, but they are not important just because of the health of a specific institution. It turns out that big macro questions, like can you deal with moral hazard, they depend on PCA. So I'll show you that. And then in the last part of the talk, I want to talk about challenges for the future. It's always fun to talk about past crises, but it's a lot more interesting to think about the next one. And so I'm going to highlight 3 challenges that I see coming. One has to do with speed and segmentation. The second one with market power and market discipline, and the third one with conflicts and political risks. And I'm going to try to emphasize kind of how they change, how you can use the framework to think about them and how they change some of the conclusions. Right, so that's the plan. Let's dive in. Okay, so that's the classic framework that we used to think about crisis. So 2 periods, to be simple. Time 0 ex ante, that's when you try to prevent the crisis from happening. And time 1 is when you find out whether the crisis is going on or not. Okay, so we do backward as usual. So time 1, you can have normal times, and in normal times, the main thing is money. So how much profits are firms making? And their main motivation at time 0, given that P is small, is the profit they're going to make in the non-crisis state. In the crisis state, you have market failures. And in response to these market failures, you have interventions by, so I'm going to put together all the regulators, government, treasuries, and central banks, okay, just for simplicity. Okay, so that's what
going to happen tomorrow. And then today we assign some probabilities, P1 minus P, may or may not be rational probabilities. That's not that important. And then at time 0, we think about the problems we are trying to avoid. So we think about risk taking and risk shifting at the firm level, typically in the form of hidden leverage, typically off balance sheet, and then how that aggregates up to risk at the macro level. Okay. And then to deal with that, we have some regulations. Some have to do with solvency, some with liquidity. And then we have this tool that we've been using for the past 15 years called stress testing. Right? So that's kind of that's the framework I want to think about. Okay, so we're going to start, as usual, with, we do backward induction. So we start at time 1, and we think about what happens in the crisis state. Okay? And so typically, when we think about moral hazard, we think about the following backward induction, which is some agent in the economy anticipate that because of market failures, the regulator is going to have to do something. And that's going to involve some type of bailout, which means some of the losses are going to be borne by the taxpayer. And the anticipation of that leads to excessive risk-taking. Okay. All right, so now the question is, what are the failures we want to think about? And how do they play here? So the key questions are going to be, suppose you're in this box, so you're in the crisis state, and you want to have an efficient intervention. That is, you want to alleviate the market failure while minimizing costs to taxpayers. Okay? So then the question is, depending on the nature of the crisis, what's the right tool to use? And then the secondary question is, suppose you do the ex post right thing. You try to design the right tool in that box. Does that mean you also minimize, to some extent, the moral hazard part? Okay? And I will show you that in many cases the answer is yes, but not always. And in particular, it's very important to think about incentives in the right way, which the literature has not done until recently. All right, so let's go into the box of crisis. So that I'm going to go fast because that's stuff that I've talked about before, but I think it's still useful to highlight one key lesson. Okay. So when you're in the box of the crisis, you have two questions. The first question is, what's the right framework for thinking about what the regulator is going to do? And I think the right framework is no commitment, period. I don't think we should be discussing that. Once you're in the crisis, ex post, you're going to do whatever it takes to do the right thing. You might have said yesterday that you're going to let the house burn down for incentive reasons, but nobody's going to believe that, so let's not even talk about this. So the right framework is no commitment. Then the second question is, what are the market failures? Okay? And sticking to the very neoclassical framework, basically you have three types of market failure in finance. You have something having to do with runs, something having to do with debt overhang, lack of equity, solvency, and something having to do with adverse selection and the market freezing because of that. Okay? And combination of these three if you want. Okay? So my first point is going to be, there is a relatively simple mapping once you specify 1, 2, 3 from this into the right instrument to fight the crisis. Okay? So let's type with runs. That's the easier one. So this has been so well studied, I don't think there is much point in discussing that in very great details. We know the right tool is going to look like deposit insurance. Okay, one way or another with plenty of details, but at the end of the day, it's deposit insurance. The thing I want to highlight is it kind of makes sense on some intuitive level. You're dealing with the run, and so against a run, you want something that looks like insurance. Okay, and my point is that actually that metaphor goes further than that. Okay, there is a deep connection. There's a reason why insurance is a good response to runs. The one caveat here is we don't really know what to do with uninsured deposits. Okay, and then for that, refer to this nice paper by Drexler, Savov, Schnabel, and Wang. This framework is not complete when you think about these guys. I mean, you could shut them down saying every deposit is insured. That's one option. Or you could find a way to credibly say that you're not bailing out uninsured depositors. But right now, of course, we are squarely in between these two, and then we don't know what to do. Okay. So, but otherwise, type 1 shock or type 1 market failures because of runs, I think we know quite well. Type 2, debt overhang. Okay? So there also I'm going to try to argue that there is an intuitive connection between the right way to intervene and the nature of the market failure. Okay, so remember, we agree that the objective function of the regulator ex post is maximize, well, or you do the min-max or max-min. So you minimize the cost to the taxpayer subject to getting some level of welfare. Okay? There is nothing here that says you committed to anything in the past. You just do ex post efficient. Okay? So in the case of debt overhang, the friction you're trying to remove is credit crunch. Okay? So that I did with a paper with Philipp Schnabel. And I think the solution is relatively intuitive. So at the end of the day, a credit crunch is always going to look like there is an ideal investment set that would, or lending set, that would happen in an economy without debt overhang. Okay, so that here I make it a square. That's easy because I write the cost of lending or cost of investment and the value of the new project. So anything above K is NPV positive, anything below is NPV negative. So therefore, the first best set is just this rectangle. Yeah, that's just easy. So without debt overhang, you get the rectangle. With debt overhang, you're always going to get a downward sloping curve like that, which typically is going to be convex. Why? Because it's going to start to depend on the quality of your existing asset. That's the definition of debt overhang, which is coming from the past, stuff you did in the past that determine the quality of your asset. It's going to have an impact on your financing cost. And therefore, if you have very high quality, then you're going to invest. So the blue part here is the private sector investing by itself. Okay? So if you have very high quality asset, you're going to essentially do the first best. Okay? But once you start lowering the quality, the cost of fund goes up because of debt overhang, and firms decide not to lend or invest or both. Okay? And so the investment set shrinks. At the end, you get something like, instead of the big rectangle, you get the blue part, which is what happens, and then you lose all the green stuff. Okay? That part is debt overhang. That's the investment that does not happen because of debt overhang. So then the optimal policy is to find a way to take that red line and push it down. And the only question is, when you push it down, of course, it costs money because you need to find a way to convince people to invest when they privately don't want to. So the only question is, when you want to push down that red curve by some amount, what is the right tool to do it without wasting taxpayer money? Okay? And taxpayer money in this world comes from essentially informational rents. Okay? If you knew exactly who should do what, you could just give them exactly €1 for doing the right thing. Of course, in the real world, that doesn't happen. So you could have informational rents in the sense that maybe you give too much money to these guys for them to invest. Maybe you give money to the blue guys. The blue guys don't need your money. They invest anyway. Okay? So if you give money to the blue guys, you're wasting money. And maybe you give money to the white guy who should not be investing, and then you create inefficiencies. So any type of zombie lending is in the white thing here, and opportunity cost, or it would be in the blue box, and then getting the red curve down in the most efficient way is the right thing to do. Okay, so what's the solution? So this is like a mechanism design problem. You solve the problem, and then you find the solution. The solution is some type of efficient recapitalization. So that's the first thing you remember, like run insurance. Debt overhang fundamentally is lack of equity. So intuitively, and the good thing is that's what comes out of the mechanism design problem. Against that, you want more equity. So you need to inject equity. And the question is how, and it turns out the best thing to do is always a mixture of preferred stock and warrants. So there is no point doing, in a debt overhang world, there's no point in the government adding debt because there is already too much debt. So clearly you don't want to add stuff which would be competing with the debt market. So you want something which is junior to debt, and it turns out that preferred stocks and warrants are good. Preferred stocks, well, they don't create credit risk, so they are a good way to recap. They put a little bit of protection to the government. They also incentivize the shareholders not to waste their money if they don't need it. And then the warrants are here because then you capture some of the upside. If your intervention is successful, the market is going to rebound. You want the taxpayer to get some of the, you want the external taxpayer to become shareholders in the rebound. Okay, so that's a warrant. Okay, all right. So type 3 is adverse selection. And again, my point here is, so that's very high tech. I'm not going to go into the techniques of the stuff, but that one is hard to crack, but thankfully we did it. But I just want to emphasize the high-level stuff, which is the instrument you're going to use is tightly connected to the micro failures you're trying to solve. Okay, so now you can almost guess. An adverse selection, a market freeze, is a situation where the good guys stay out of the market because the interest is too high. Okay. So then what's the right instrument in that world? It's going to be something that pushes down that interest rate. So it's going to take the form of a debt guarantee, one way or another. Okay. It's not an equity injection. It's not an asset purchase. It's something like a debt guarantee. Okay. And it turns out that's true. Now that one is hard to solve. So that mechanism design problem is highly non-trivial, but whatever, we need it. So, and the reason it's non-trivial is because of something that every central banker knows very well. That's the stigma effect, which is you have many things that can happen. You have a private market. Okay, so you have outside investors who lend to, say, banks. Okay, but then you have a government program. That means you set up a window where people can come and discount some bonds or preferred funding or some debt guarantees. Okay? The choice of participation is to some extent endogenous. I mean, in some cases, you can force private agents to participate in the program, but that is not easy. So most of the time, there is an element of self-selection. So the first thing the market is going to think about is who is asking for government money? And if the answer is the weak types, maybe you just shifted the adverse selection somewhere else. Okay, so it's not obvious you can actually improve the situation. All right, so these guys are going to think about, are the good banks coming here or there? Because if the bad banks go here and the good banks go there, then these guys are going to say, well, I'm willing to lend to these guys at a good price. But then the problem is the government is going to deal with the bad apples. So does that mean the government is going to bear all the cost? Or vice versa. If the good banks go with the government is going to have a cheap intervention, but then this pool is going to get worse. The funding is going to get even more expensive. Okay? So it's not obvious you can actually improve. But you can. Okay? And then when you do it, you get plenty of super cool insights. So the first one is the optimal instrument is either a debt guarantee or direct lending. Okay? In the simple model, there is no difference between these two statements. Obviously, if you have a constraint on the balance sheet of the central bank or some reason why you want to expand too much, then there would be a difference. But in the simple model, if the regulator or central bank guarantees private debt or lends directly, it's obviously equivalent. Point one. Point two, how do you assess the efficiency of the program? That one is cool. Nothing to do with the volume. Literally, totally orthogonal to volume. You can have the same exact program, meaning it achieves the same welfare for exactly the same up to the penny cost to the taxpayer, and they have a volume that varies by a factor of 10. Okay? So volume is not the right metric for assessing this type of intervention. It's all the price. So the impact, you measure the impact by looking at the market interest rate. Okay? And if the program is correctly designed, the size doesn't matter for the cost. Or rather, the impact on market price is a sufficient statistics for welfare. And third, and maybe it's even more surprising given the theories, you don't actually need to shut down the market. So you could say, well, maybe why don't I temporarily suspend that market? So then these guys don't have a choice. You don't have this self-selection and signaling. Maybe that would help. It turns out, no, it doesn't help. You do as well with or without touching the market. So I think that's kind of interesting. That one was not obvious to me. Actually, that one was without Jean Tirole. I don't think I would have understood that, but whatever. Okay, so first big lesson. Optimal instrument tend to align with the market failure. So deposit insurance against runs, equity versus debt overhang, guarantees versus credit risk. Highlight here, an asset purchase is rarely a good idea. So anything that's an asset purchase, you should be very suspicious. Why? Because private agents might like asset purchases precisely because they are more costly for the taxpayers. Okay, so big red flag. I'm going to qualify that statement later, but for now, I think that statement is true. Okay, it turns out though that some of the conclusions depend a little bit on what are the other things the government can do. And the main one, I think, is disclosure of information. Okay, so if you do it ex post, that should be called an asset quality review, not a stress test. If you do it ex ante, it's a stress test. So what changes when you also have the option to provide information to market participants? It turns out interesting stuff changed. Okay, so in this paper, what we did is we just added two frictions. So two fictions together, and then two types of interventions. Okay? So we put together the run, so friction number 1 and friction number 3. Okay? So diamond deep VIG together with the standard Akerlof. Okay? So it's like diamond deep VIG meets Akerlof. That's the market failure. And then the intervention here is classic taxpayer-funded interventions, optimized. Of course, you're not wasting money, but it is costly typically, not always, but on average. But an extra instrument the government has is disclosure. That is, you can say to the market, you can tell the market participant essentially what the Fed Treasury did in 2008 and published in the spring of 2009, which is that's our estimates of the hole in the balance sheet of the banks. Okay, so, and it turns when you have these two things together, things change. Okay, what changes? Again, that's also technical, so I'm skipping all the design part. Now, this trade-off is obvious, and in particular, if anybody who's discussed that with, say, the Spanish central bank around 2010, 2011 knows exactly the problem, which is if you run a very aggressive stress test, as you actually say, I'm going to look and very tough on the banks. And if the answer turns out to be bad, then you have a run on your hand. And the next question is, can you deal with the run? Okay? But people are not stupid. So if they know that they wouldn't be able to handle the run created by a tough stress test, the rational response is not to run a tough stress test. And you can't blame them for that. It would be silly otherwise, okay? So that's the tension there. Okay, so solve the problem, and what do you find? You find a bunch of interesting stuff. The first one is suddenly the moral hazard is flipped on its head, which is government with deep pocket do waste less money. Why? Because if you have deep pockets, you can run an aggressive stress test because you know that in case of trouble, you will be able to stabilize the system. Okay? So in other words, think about it like you have if you run a clean stress test, you're going to solve the crisis at, say, little cost. But there is a 1 in 10 chance that the result of the stress tests are really bad, in which case the only equilibrium is full run on your system. Okay? And now the question is, what do you do as a policymaker? Well, the answer is pretty damn obvious. If you have enough money so that this 1 in 10 chance is something you can manage because you have deep pockets, then you will run the aggressive stress test. And what I will see in the data is 9 out of 10, you solve the crisis without wasting taxpayer money at all in this case. In fact, in the limit, you get first best. Okay. So rich governments do better. And so you would predict that governments with a deeper balance sheet or a backstop are going to run more aggressive stress tests, okay? Which is what we see. And then the direct conclusion is it's actually inefficient to restrict the government bailout options exposed. It's Pareto decreasing to do something like that. Okay, so that brings us now to the key lesson number 2 is going to be really about moral hazard. So the first thing about moral hazard is, as we saw, is if you have two instruments exposed, already the notion of moral hazard is hard to define. And then the next question is, what is a good way to think about moral hazard ex ante? Okay? So in all of the classic models, it's just the mean, yeah, the first moment, which is the expected amount you're going to spend. Okay? The expected net loss for taxpayers, because kind of in the crisis, $1 spent a taxpayer is received by somebody else who should not have received it, and therefore, to a first-order approximation, the distortion in incentives is going to be proportional to the expected size of the bailout. Okay? And I thought that was a pretty convincing argument until I started thinking more about it, and it's actually not true. Okay? There's a big missing piece here, which is all of these are written as if there's only one bank in the world. Okay? And it turns out if you have more than one bank, this is not true. Okay? Or rather, it needs to be qualified. So how so? It turns, I think it's also pretty obvious that people who run the FDIC, in fact, they know that intuitively. In fact, that's how they act, even though maybe it's not formalized in the thing. But imagine a world where you have like these banks, so 5 banks, A, B, C, D, E. Okay? So that's their names. Okay? And then in the crisis state, there will be a ranking of the banks. 1, 2, 3, 4, 5. Okay? Bank 1 is the bank that happens to be best performing in the crisis. So that's JP Morgan, and that's Lehman Brothers. Okay? Now, what determines private incentive in that world? Well, clearly it's not just the size of the bailout. It's who's going to get the money. Okay? So the incentives, say take bank C here, the incentive is driven by the idea of what is the chance. So I'm the chairman of bank C. I'm thinking, what's the chance I'm going to end up being bank 1, and how much do I get in that state? What's the risk I'm going to end up being bank 5, and how much do I lose in that state? So my incentives is much more determined by 1 minus 5 than by integral over 1, 2, 3, 4, 5. So the first moment, the average bailout is not a sufficient statistic. Because in the limit, it's actually peanuts. That's not the thing that matters. Once you understand that, you see that the more hazard again, or the design of intervention is very different from what the literature thought before. A good intervention is you rank them from the best performing to the worst performing, and you just kill the last one. That's it, no question asked. Okay? So then these guys know ex ante that to a first order, their program is, I want to try not to be the last one. If you do it that way, you go back to first best, even if you do a bailout ex post with no commitment. Okay? So we formalize that in the paper with Olivier, and then, okay, so of course you don't get first best all the time. You get first best is, I kill you is something you can do ex post. Okay? And it is true if the banks are close substitutes. Okay? Because then there is no reason for the regulator to prefer one versus the other. So what does close substitute mean? Well, the easy case, of course, they are doing the same stuff. That's really the case. But efficient merger is a way of getting exactly the close substitution. That is, if you can take, so suppose this guy here does some specific businesses you can't shut down for the economy. Okay? If you can merge 5 with 1, wipe the shareholders of 1, and that merger does not disrupt the operation of bank 5, it's as if they are perfect substitutes. So then you get first best. Okay, so that's the first point. Second point, and interestingly enough, exactly what we saw earlier with the stress test AQR. Again, once you have limited liability, so why does it matter? Well, if I can punish, they can be very, very mean to red. I don't need to be very nice to green. Okay, obviously, because it's the different that matters. Now, in the real world, we can't literally shoot bankers. So that means that there's a limited liability on bank 5. Okay? There's an amount of punishment you can. The worst you can do with shareholders is wipe them down to 0, and so there is a limited liability argument, which means that to provide incentives, you need to reward green, not just punish red. Okay, so okay, so in that world, that means the size of the government balance sheet comes back, but just like in the previous case, it comes back with flipped on its head. If the government has more money to spend ex post, or more ability to reward the good guys, then moral hazard is going to decrease ex ante, precisely because you'll be able to give the right incentives. So in this framework, typically what that means is, say, it would make sense for bank 1 to merge with, so bank 1 is the good performing, so you want to reward their shareholders. This one is the bad performing, you want to punish their shareholders. So a good policy is wipe these shareholders down to 0, and if there are still some risk on the balance sheet, you can guarantee that, that's okay. You give a guarantee to bank 1 against the risk in the asset of bank 5, that actually is not moral hazard, it's the opposite. Okay. Because again, it increases the difference between 1 and 5. So that's an example of using your balance sheet of the government regulator to do that is good. Okay, so I think I said that. All right. So that's the big lesson for moral hazard. So the first lesson was very micro, very like, how do you map specific market fear to specific instruments? The second big lesson is moral hazard. It's not what you think. Essentially, I think all the first-gen models are wrong. Potential bailouts are an insurance policy which allow you to be aggressive in information disclosure. That's first order, more so than. So limiting funds available to the government to fight a crisis is actually a bad idea, including for moral hazard. Second, the distribution of bailouts matter, probably more than the size of the bailout. You want to make sure you reward the good guys and you punish the bad guys. Okay? That's actually is the more important thing. And in that world, there's a strong complementarity between high-level financial stability, moral hazard, and micro-efficiency. So for instance, like you get rid of moral hazard with something that looks like banks are exposed good substitute. But for them to be good substitute, you need an efficient way of folding and merging failed banks. So being able to fold and merge the failed bank is not Macroprudential. It is the thing that allows you to get rid of the macro risk. Okay, so at the end of the day, when you think about your practical implications, if you're a regulator, two questions is, when you think about potential implication, more hazard for what you do, how much are you going to lose? What's the total amount of transfer you're going to make to the private sector? And the second one is the distribution of the P&Ls. Do you punish, reward the correct agents? Okay, these are the overarching most important questions. Okay, so then third tool, or third part of the discussion, stress testing. Okay, so now it's like at this stage, okay, you're trying to prepare yourself for what could happen here. Okay, and in doing so, you have plenty of stuff. So the obvious one is if you do a stress test, you discover something, you have a readiness uptake, which is you'll be ready to act exposed faster than if you didn't see the trouble coming. So it would make your intervention more efficient in that case, or quicker. Second, if your stress test picks up excessive risk-taking, it's going to lower the actual risk of the crisis. So you're going to lower P. And third, it's going to limit the amount of risk-taking here. Okay, so doing it right is obviously important. Okay, so that brings us to what's the right way to think about designing stress scenarios? And the answer is, it's like a big Kalman filter. Okay, so you want to think about what is the right question to ask, for what purpose, and what scenario allows me to answer the question. Okay, so you have a scenario design component, and then you project the losses, and then you disclose the results. Okay, so I'm not going to talk much about that. We discussed that earlier. So I'm just think about this box here. Okay, how do you design the scenarios? Okay, so if you think of this as a learning mechanism, then it literally becomes like a filtering problem, which is you have a state of the world, which is unknown to you, say like the true risk in the banking system, and you have tools to shed light on it. There are scenarios, and the question is how to design the scenarios so they shed light in the right place. Okay, now there is a bit of a conflict there with the way stress tests are run in practice, because stress tests are used for two things that are actually quite separate. One is to essentially set capital requirement, and the other one is to discover and learn. Okay? And of course, you will see that the logical conclusion is these things should be separate to some extent. All right? So I won't go through the Kalman filter, because I thought after, even if you had a lot of coffee after lunch, it would not be very nice for me to do that. So, but I'll show you some what I think is an interesting result. Okay, so bear with me here 1 second. So just, okay, so this is measuring the efficiency gain in terms of the utility of the rep agent. And it's normalized by the value of 1% of free capital. Okay, so think of it as, suppose I gave you enough equity so that you can increase the capital ratio of your bank by 1 point for free. You'd be happy. Okay, so that's my benchmark. That's 1 unit. Okay, and I'm measuring respect to that. This here is the amount of uncertainty in the economy, and then this here is the gain. Okay, so the first thing I want you to notice is the scale here is pretty small. This is 7%. So it's a tiny amount compared to having more equity. And then this is the case where you have different numbers of scenarios. So this is 2 scenarios that are designed optimally. That's this line. And then there's this tension here. So I'm saying, suppose you use 1 scenario to set your capital requirement. So then you get that line here. So 1 fixed means it's just it has to be calibrated so it gives you the right number for the capital requirement. So it's not free to explore other stuff. This gap is tiny. So the fact that you lose 1 scenario to capital requirement, as long as you keep 1 free, that's not a big deal. If you have 1 fixed and 2 frees, so an extra exploratory scenario, so now it would be like 3, you would have like the benchmark and then 2 exploratory scenarios, you do it a bit better. But remember, the thing that's key is these are small numbers. You move to the right side, suddenly you have that guy. And that guy is 35% versus 7%. So what's the big difference? Okay, that's the only thing that's really first order here. That one has a PCA. Okay, so what's a PCA? Broadly speaking, actually, it doesn't have to be a PCA, but it's an intervention which responds to the result of the stress test. Okay? In other words, there's no point getting granular information if all you can do with it is adjust one number, which is the capital ratio. If all you want to do is set the capital ratio, information is not that valuable because it's never going to be less than 12 or more than 19. So who cares, essentially, right? So information, if all you can do is change the capital requirement, broadly speaking, then you're never going to go very far. But if with information you can do a targeted intervention, that is, you figure out which bank is in trouble, and you can target that bank without changing the capital requirement of the other ones. Or one market, and you can tighten lending standards, LTV or whatever, in one market without changing the other markets. Then information is very valuable. Okay? So the punchline here is it's the complementarity between, again, the micro, what you can do at the firm level, and the macro information you get. That's why you get the big buck. Okay, so stress testing lesson number 3. Yes, you do need a baseline versus exploration. You don't need 25 exploratory scenarios. 1 or 2 is enough. So I'd say like 3 is probably good. 1 baseline, 2 exploratory, that's plenty. But that's not the thing that's important. The thing that's important is the complementarity between learning and targeted intervention. Okay? And again, that's what we saw earlier. That's the same exact thing that's important for fighting the crisis efficiently exposed. Okay, so you need to ask the right question, and one of my, well, in the last 10 minutes when I talk about the challenges, one of them is going to be precisely that, which is, what if these questions are uncomfortable? Can you still ask them? Okay. All right, so we're going to move to the more like exploratory or, I guess, less scientific part of the talk. So just to wrap up, 3 lessons and then 3 challenges. So my framework for planning and using the right tools in the right sequence. So I think what I showed you is a framework that does that. Okay. So what you get, complementarity between micro and macro tools. I don't think we should have separate discussion about macro and micro. If you don't have efficient micro tools, you will never get good macro policy, okay? Because you won't be able to implement it, and you're going to end up with tons of more hazard. Second, more hazard does not imply that you need to limit available funds for crisis fighting exposed. That's a silly idea. It implies you need to use them efficiently, but the amount limit is a stupid idea. And then it's very important to think about the distribution of P&Ls, not just the average amount of money you spend. Okay, so these are the, I think, already interesting lessons. And it's not, Lucy, it's not like, these are not words. These are like, they actually come out of the model with precise equations. So I think it is actually correct. Now, there are still 3 challenges, which is, it doesn't solve the problems, and some of the stuff we see in today's world might be challenging. So 1 is speed and segmentation, 2 market power, and 3 conflicts. Okay, so speed and segmentation, that one is relatively straightforward, I think. At the end of the day, all the arguments that we deployed earlier, they assume that you have some time to intervene. Okay? There's nothing you can do literally at time t. You need a bit of time to announce a program, deploy the funds, and stuff like that. Now, I think it was a good assumption in the past. Even runs were surprisingly slow historically. So in other words, if we didn't fight a run correctly in the past, I think the answer is not that the run was too fast, but the regulators were too slow. I don't think that's true anymore. So SVB showed that. You have cases where you can't even get to the weekend. Okay, that used not to exist, but I think even in 2008, that did not exist, actually. But today it does. Okay, so we have good evidence on that. And to some extent, LDI is also an example of that, because this is a situation where, as we saw in yesterday's great talk on that, it's very clear what the losses are. It's very clear that they are very negatively correlated across 2 people who have every incentive to trade. Okay, so the insurance companies are doing great. They should recap their stupid LDI, and they have the right incentive to do it. And yet they can't do it in less than 2 weeks. Okay, now this is unfortunate, but I think private capital can be slow moving. So speed can be an issue. So what are the implications? Well, I think speed and segmentation are actually very related. Speed is telling, if speed is an issue, that means when you send the money matters. But segmentation means where you send the money matters. Okay? And to some extent, they overlap. Okay? The first one it's clear, okay? Now, both of them, it's not clear it's altogether bad. The fact that the market reacts quickly, okay, it can be a pain in the neck. It can also be very useful, okay? So these are not, speed and segmentation are not unmitigated negatives, okay? They also have a positive side to it. But the common consequence is that it becomes more important to ask the right questions, okay? So the more speed and segmentation matter for your intervention, the more you want to make sure that in your stress test, you actually got to ask about that. Okay? So pre-positioning, planning becomes relatively more important. 2, market power versus market discipline. So that's something we also discussed yesterday, but you sent plenty of evidence of that in the industry. Many of these markets are highly concentrated. When they're highly concentrated, they lead to strategic behavior. In equilibrium, most of the time, strategic behavior is going to work against you as a regulator, because typically it's going to slow down the help. That's the Rajan Diamond QJE paper, which is people are going to sit on the sideline. They have the money, they could get in, but we haven't hit rock bottom yet, so they're going to wait to maximize their return exposed. Okay? So strategic behavior, they slow down the help. The private capital you would like to have is going to be more reluctant to come in quickly because they're going to wait for the right time. And it's going to speed up the risk because predatory trading is also much more attractive if you have market power. So that's the sense in which this plays against you. It also plays against you in terms of market discipline because it's going to be harder to punish and reward in a world where these guys have market power. Not always, but oftentimes. And it means these guys are going to try to time the intervention of the central bank or the regulator. Okay? They're going to wait for you to act for strategic reasons. Okay? So the direct implication of that is that even take an intervention which would have generated an amount of surplus, like you fight that overhang, the economy doesn't crash, the market rebounds 20%. Great. If the market is competitive and you design your intervention correctly, you can actually get this entire 20% back to your taxpayer. If the market is not competitive, that's not true anymore. And so it's going to make intervention more costly. It's also going to be harder to distribute the P&Ls efficiently because there is no reason for the more strategic ones to be the one you want to reward, and yet these are going to be the ones who end up with the most money. Okay, so that's going to be a challenge. Obviously, one implication is, to the extent we can, limit concentration. But that's easier said than done. And the third challenge is conflict. And I think it's useful to separate conflict in 2 parts: conflict with monetary policy and conflict with fiscal policy. Even though they have some elements that are common. So conflict with monetary policy, when are we going to see a central bank doing a stress test with a high inflation scenario? Well, the answer is pretty obvious, right? Because is it the case that people are going to interpret that as a true Bayesian learning exercise or as a signaling device that we don't know what we're doing and therefore inflation is going to be out of control? Okay. So that's tricky. So these are the type of questions that you want to ask, but maybe you can't, or maybe they are too uncomfortable to ask for a central bank. The second thing is, as we know, every intervention, I think, when we think about intervention, I think the Haddad-Moira-Muir framework is the right one, obviously. So everything you do becomes a plan. There is no one-time intervention. One-time intervention doesn't exist. We should not use the word, we should ban it, it doesn't exist. Every time you intervene, it becomes a plan. And the market is going to behave as if it's a plan. And in fact, sometimes it's great, because whatever it takes didn't cost anything, precisely because it was a plan. Okay? If your plan is, I'm going to remove tail risk, and tail risk doesn't realize, you solve the problem at zero cost. Okay? So it's not that we don't like that. Okay? It's just that it is the way it is, and that means that every intervention is going to be interpreted as a plan, which means people are going to think about, oh, next time he's going to do the same. Next time they're going to act in a similar way. Okay? And so that's something to take into account. And this part may conflict with your monetary policy objective. Okay? So these are, I think, are the 2 challenges. And then the other conflict is with fiscal policy. So if you think about the world today and you ask yourself, where is the big financial crisis, or what's the biggest risk on the horizon, for me it's pretty obvious. Some type of military conflict, with obvious countries that would be number one on the list of countries creating havoc. And second one is, some fiscal problem. Now, these are the scenarios that are most likely to lead to a severe financial crisis, but it's not easy to put that in a scenario for the same reason that it's not easy to do a scenario with high inflation. So then it becomes a question, what's the right proxy for it? So that's something to think about. The second thing is market discipline. So to some extent, that's very connected to the discussion on moral hazard. The reason we want to limit moral hazard is because the flip side of having of moral hazard is the lack of market discipline. Okay? So market discipline is very useful. But I think what the last 6 months have shown is that we thought of market discipline in the past mostly as a private sector issue. I think we've learned that we are all emerging markets now. So market discipline is clearly useful. And the government has some crazy, stupid idea. Sometimes the market thinking is the best way to convince them not to do it. Okay? And so that's market discipline. It's a different type of market discipline, and we may not like it, but it's here. And so that means we need to take that into account when we think about financial policy and financial stability. Okay. So that one is tricky to deal with. I don't have, of course, like a ready-made solution for that. I do think it does speak to the idea of having some type of independent board of advisors when you think about scenarios in Macropru. Because there is some stuff that central banks or official regulators, it's just going to be too uncomfortable for them to ask these questions. If they still want to know the answer, they should maybe get somebody else to ask for them. Thank you. See?
Thank you, Thomas. It was a fascinating review of issues. I mean, I was thinking a lot of times about what we do and how to frame what we do in those terms. And I was also thinking a bit of the, what John Maynard Keynes said, as economists are like being like dentists, on having a problem and knowing what to do with a specific problem. So your taxonomy of what to do, remind me of this kind of practical aspect. But let now start the Q&A session. So Thorsten starts, and then we go around.
Okay, works. Thanks. Thank you. So Thorsten Beck, EUI. Thanks a lot for this great presentation. I have a question to the first problem that you pointed out, this kind of idea of ranking the banks, and then the lowest one goes. Wouldn't that provide incentives for herding trends? You want to look alike, so you're not you're number 4 and not number 5, or would that also, does it take into account the interconnectedness between banks, this analysis? Or would it again also create incentives actually to be as interconnected as possible so that you cannot fail by yourself, basically? Thanks.
So, and the mic is right. You hear me, right? Okay. So it is the main. So it is. Herding is fine. That one you can show that's not going to mess up the incentive. The one that could mess up the incentive potentially is predatory trading. So in the sense that if you can trade in such a way that you're going to make your competitor look very weak, at the time where the regulator is deciding who is the weakest link, that messes up everything. So if you're in that world, then the thing you want to worry about is people trying to strategically spread rumors about somebody else going bust, and then that becomes self-fulfilling. So that's the one thing you want to worry about. Because in all of this model, the tricky part is there's always time 0 and time 1. But in the real world, there is no. In the world, it's like you make a decision and you need to decide, okay, now I need to decide. So that decision to when you pull the plug is typically not something we think very hard in the models. And then the danger in all of this, but that's true for every high power incentive system. If you create high power incentives, that's how you solve more hazard issues. But then you want to make sure the leaks are not too dangerous. In my proposal for the ranking stuff, the dangerous leak would be strategic predatory trading by your competitors.
Okay, there was a question. Okay, then behind you, yeah.
Thanks a lot, and really, really inspiring. Here is Salvatore from the ECB Banking Supervision side. A question on the disclosure. Do you think there is an optimal level of disclosure? We should aim, as always, to the full disclosure. With a bit of background on this question, like maybe in a crisis moment, disclosing many information, in a sense also connecting with what you just mentioned on predatory trading, might just fulfill wrong information or, let's say, interpretation of things that, especially at micro level, might have an effect, and singling out institutions that in the end were just put on the spot by wrong or, let's say, fulfilling interpretation of the market. So the question is, do you think the disclosure should always be very open and full on all the PCAs, all the intervention from supervisory side, or can be an optimal level, let's say, less than total? Thanks.
Okay, so I think it depends on what's in your information set that you're planning to disclose. I think every action could remain private. I don't have any problem with that. You don't have to say what you do. That's totally fine with me. Things that have to do with the balance sheet, I think it's hard to write down I think in that space, I think the more you disclose, the better. So if you know something about the quality of the balance sheet of a particular bank, insurance company, or whatever, I think the more you disclose, the better, both as a commitment device and also for market efficiency. The question is, what's the real constraint on that? And I think the real constraint is different, which is participation by the banks and insurance companies. Like, if you want them to answer the question you ask them. And so if they know you're going to disclose everything, including stuff they really don't want you, then there's a trade-off. So I would say anything that doesn't make them cry too hard, I would disclose. But the true constraint is that, which is you want truthful answers.
Okay, so the question was Luis.
Yeah, I think
yeah, so I saw a couple, but okay, I saw you first, and then you.
Yeah, José Luis Pedro from Rome.
So
you put a lot of emphasis on crisis in the moment of the crisis, and solutions like deposit insurance, recapitalization. What do you think, like the big systemic risk is within the crisis at those moments, or like excessive credit booms and asset prices? And at that time, it's only the stress test, or there will be other policies like borrower-based macroprudential policy or other tools?
I think to me a stress test which is well designed is exactly the answer to your question, actually. And in fact, if you do the Bayesian stuff in the stress test, that's what's going to come out. It's going to focus you on exactly the right. It's going to exactly answer that question, precise in the sense that it's going to tell you the point in time. These are the questions you want to ask, and so it's going to highlight, where the risk is. Or I mean, this is Bayesian. That means you never know for sure, but you think there's a high likelihood of, and then. But the logic of the argument is still going to, I think, be broadly correct. It doesn't really matter whether it's a capital requirement on bank, some broad requirement on some market. There's going to be a very big difference between only having very broad instruments versus having more like targeted instruments. If you only have broad instruments, stress tests are just not that useful. They only become useful if you can use the information in a way which is somewhat targeted. So for instance, if you only have one instrument which is just you change the LTV for every borrower in your economy, that's not going, the stress test won't be super helpful. If you have an instrument that says, I can target commercial real estate in a specific geography, that's very useful. So I think that applies there as well. It's the complementarity between the granularity of the information and the granularity of the action you can take.
I mean, in Europe, we have the so-called systemic risk buffer that does a bit of that, that can be sectoral, and so maybe it goes in that direction. So please.
Thank you. Robert Bixel from Swiss National Bank. There's one tension I perceived in what you've said, and I would like you to help me solve it. So in the first part, you mentioned no commitments being an important guidance, because at the end of the day, during crisis, you will do everything in order to maximize public welfare. At the same time, later, you've mentioned that this ranking is very important and you have to kill the worst bank. And for me, this is only possible if you have some form of commitment. So where am I getting it wrong?
No, you're getting that. So the answer to your question is exactly equal to the extent to which the banks are close substitute ex post. So imagine a world where you have 20 banks and they are all just pure replicate of the others, okay? And you're close to control return to scale. Then literally, you don't care which of the 19 are alive because they do similar jobs. So you could kill one and you would have zero impact in the limit, okay? So then in that case, you don't need any commitment because you care about the system and you will never let the system fail. So you have zero commitment in that dimension. You would never be able to credibly say, I will let the system fail. But if you're indifferent as to which of the 19 are the system exposed, then you can kill the weakest one with zero commitment. So now the question is, how can you get close to that? And my point here is that efficient instrument at the micro level is a way to get credibility at the macro level. So the perfect example is, suppose you have a very efficient system for closing and merging failed banks. That gives you commitment in the aggregate because you can say ex post, okay, I'm going to close the weakest one, sell it to the best one. If needed, I will subsidize the best one, and that's all good. If you can do that, but of course, if you can't, I mean, the flip side would be, suppose your rules are so bad that you can't do it, or you can't wipe up the shareholders of the weakest one, or it's too slow, and therefore you have to bail them out before you can close them, okay, if you can't get to the weekend. These are the micro stuff that make it, they are exactly equivalent to saying you are indifferent as to across the banks, and that's what gives you the credibility ex ante, even if you don't have commitment. So I'm saying, like, let's commit to having good micro instruments, and that will give us a reasonable amount of effective commitment at the macro level.
Yeah, it also makes sense, yeah. Yeah, please.
Divya Kirthi, International Monetary Fund. So you kind of emphasized that good micro, helps make the macro stuff credible. So I think you mentioned this, but I felt that you didn't emphasize just regular regulation and supervision that much. And I think so the taxonomy is very interesting and helpful, but I think that is another important element of the synergy that you described, and kind of picking the same example that people are finding interesting, this example of finding the worst bank and letting them fail. If there's just very poor regulation and something like no supervision, and all the banks have great opportunities to engage in risk shifting, that might be another situation ex ante. That might be another situation where it's difficult to implement this proposal. But the thought is broader. I mean, just regular regulation and supervision also seem to be an important part of the picture.
Yeah, but in my framework, it would be exactly to the extent that they provide you with information. See, the two things, so it's actually very connected to your question. Think about, so I am most definitely a believer that we shouldn't write models where the government can commit to let the house burn down. I think that's silly. But on the other hand, there is stuff that you can commit to. You can commit not to forget. That's okay. If you learn information at time 0, it will still be with you at time 1. And that's full commitment. So to me, supervision is exactly that. Good supervision is exactly commitment to know something. Okay? And you keep it with you. So having a good PCA framework, good bank resolution framework, these are commitment tools. Because these ones, they exist. And then you build them at time 0, they will be with you at time 1. And so I put all of them in that category. So supervision to me is useful precisely because A, it means you learn, so you have information that you keep with you. And 2, it allows you to make these resolution actions quickly and efficiently. And because they allow you to make them quickly and efficiently, they become credible.
Take perhaps one last question, so please.
Thank you. Extremely exciting and intellectually provoking. Ilya Lingorski, Bulgarian National Bank. Given what you commented on asset purchases and everything else you said, how would you look at a situation at which Gabor presented yesterday with the with the crisis igniting in the non-banking sector, actually, but inflating the safe assets and with the potential of, spreading around, regardless of, how well you've done everything you said. So
brilliant. Thank you so much.
What about commitments there?
No, but that's great because I said in passing, when I highlighted asset purchases are usually suboptimal, I said I would go back to that. And I wanted to go back to your example exactly, and I forgot. So thank you, you're saving me right now. You're bailing me out. But there's no more hazard. No, so yeah, so why is it that asset purchases are not usually a good idea? Because they're extremely costly when there is a lot of asymmetric information about these things. So anything that smells of mortgages or private credit, unless it's like plain vanilla AAA, it's very hard for the government to buy without getting screwed. But of course, the government bond is very different. So what we had in the past is, well, first there is COVID. So COVID is the prime case where, yes, go buy all the government debt, no more hazard, I'm happy with it. Okay? But so that type of asset purchase, in other words, the argument against asset purchase is relatively tightly connected to these being complex assets. If they are simple assets like government bonds, again, response to COVID, the central bank stepping in and says, I'm going to stabilize that market no matter what. I think that's what you said also in your speech, so fully agree on that. The gilt is a bit that way, but not fully in the sense that then you have the issue of moral hazard with respect to the government. I mean, there's a reason there was a gilt crisis, because there was a stupid budget before. Okay? And the US is there is a reason why the spread on 30-year treasury went up so much, because there was some crazy fiscal policies in the background. And to some extent, that's market discipline. So there you have to be a little bit careful about exactly what to do. But to a large extent, if the trouble is on the fiscal side, then buying and selling government debt as an asset class, yes, that works. And it does not contradict the stuff I showed in the slide. But thank you for reminding me, because I wanted to say that.
So again, it was a great talk. I wish we could continue, but we had to stop. So congrats. Okay, now for the online audience, just be aware that we need a couple of minutes to fix things and move chairs and so on. So hold on, and we continue.
We're going to be playing musical chairs. Yeah.
So that was very short reshuffling of chairs. So we continue without a break, but keep with us. There will be another break after the first paper. So we have actually one of the most homogeneous sessions of this conference, because 3 papers in a row on real estate markets. As you know, in macroprudential issues, always a big topic over history. And so the first paper, it's very diverse. It touches on a range of issues. Maybe most pronounced on the financial stability implications from fixed rate and adjustable rate mortgages. The second paper will be more of a business cycle paper, like the accelerator model through the lens of the financial accelerator and the business cycle through the lens of commercial real estate collateral. The third paper will be on monetary policy transmission issues very much. So very homogeneous session. So since we are always short of time, so I think without further ado, I would give the floor to Lu Liu from Wharton School for the first paper, a macrofinance model of mortgage structure, financial stability, and risk sharing.
All right, thank you so much for the introduction. Thank you so much for including our paper in this conference. I couldn't think of a better occasion to present this paper. This is joint work with Vadim Milenev, who is at Johns Hopkins. The 2022 to 2023 monetary policy tightening cycle raised policy rates by about 400 to 500 basis points across most countries. However, if you look at real economic outcomes, and in this case, you're looking at measures of mortgage payments on the right-hand side, you see that there was actually some sharp divergence. So on the bottom, you see the US in blue, where measures of mortgage payments have basically not budged despite the sharp increase in policy rates. And you see most other countries, including the UK, most of the euro area, and Canada, having mortgage payments that increase by 15 to 25%. Now, why is that? Okay, so you're in this room, you probably know the reason why. These countries differ quite drastically in their underlying mortgage structure. So the US, as you know, is typically originating 30-year fixed-rate mortgages, so we're going to call them FRMs. And most countries in the world have adjustable-like contracts that are basically intermediate fixed-rate lengths for about 2 to 5 years on average. And so basically, this difference in mortgage structure translates into differences in monetary policy transmission. Now, however, what I've just told you actually also implies that mortgage structure affects financial stability and risk sharing in the following sense. So basically, right, what I've just told you is that in fixed rate mortgage economies, households are basically protected from interest rate rises, whereas as we've seen in most recent months and years, the intermediaries on the other side who hold these long-term mortgages are potentially more exposed to rate rises. On the flip side, in an adjustable rate mortgage economy, these intermediaries are much less exposed, but on the other hand, households are experiencing these increases in mortgage payments that actually translate to greater rates of default, and I'll show you that in the data. And so one naive approach to think about, if we're thinking about mortgage structure and how should we construct mortgage structure to kind of improve financial stability or minimize the risk coming from interest rate changes, is to maybe say, okay, let's just match the asset side with the duration of the liability side, maybe pick a mortgage structure that matches the duration of deposits. Now, we're going to argue that this would be a simplistic approach that ignores the fact that interest rate risk actually is going to interact with credit risk. It's going to lead to an endogenous default decision that's going to differ across different mortgage structures. And secondly, what also matters is basically the capitalization of the banking sector and how they're going to price those mortgages. And so in order to understand this more holistically, the effects of interest rate risk, we need to take into account that they're correlated with credit risk as well as intermediary net worth. And so as a result, we propose to answer this question, so how does mortgage structure affect financial stability and risk sharing in equilibrium, by building a quantitative macrofinance model with 3 key ingredients. So we're going to incorporate flexible mortgage structures that are going to be able to map to these types of mortgage contracts that you are probably more familiar with, for instance, things like 2 to 5 year fixed rate mortgages. We're also going to introduce an additional type of default. So we're going to have net worth driven default, which is fairly standard, but we're also going to build a new way to incorporate liquidity driven default, basically default that's driven by an increase in your current mortgage payments. And lastly, we're going to have a banking sector with sticky deposits and occasionally binding constraints. So what we're going to do is we're going to calibrate all of this to the US fixed rate mortgage economy. And we're going to study financial stability and risk sharing properties across basically counterfactuals where we change the underlying mortgage structure to, for instance, a 2 or 5 year fixed rate mortgage. And so we're not going to calibrate actually to something like the euro area, but you can think of the counterfactuals that we do as having some similar intuition. Okay, so let me preview the 3 main findings of our paper. The first finding is that increases in interest rates are going to affect banks and households in opposite directions depending on the underlying mortgage structure. To give you an example, in the FRM economy, bank net worth is going to be decreasing in rates, and bank net worth is actually increasing in rates in the adjustable rate mortgage economy. And so as a result, we're going to find that actually an intermediate fixed rate length of about 3 to 5 years is going to minimize banking sector volatility and is also going to be best for risk sharing. So what's the intuition, briefly? So if FRMs are less volatile than ARMs, precisely because we're going to calibrate to the kind of degree of deposit stickiness that we see in the data, and so that may sound familiar. So FRMs, in some sense, are kind of providing a hedge for some of the liability side. But on the other hand, ARMs are going to have lower risk premium. They're going to be They're going to be basically hedged in the sense that defaults are going to be very interest rate sensitive. Defaults are going to occur precisely in the states of the world when net worth is actually quite high, when intermediaries are actually earning quite high mortgage interest rates as part of their earnings. And so that's going to offset the effect of a rise in default, and it basically causes a net worth hedge that's inherent in adjustable rate mortgages. A higher fixation, we find that a higher fixation length, something like 5 to 6 years, but still, not 30, is going to optimize risk sharing between households and savers. And lastly, we're going to show that these mechanisms, of course, interact with the macroeconomic environment. So if you have a pro-cyclical rate environment, so an economy that's driven by demand shocks where interest rates are positively correlated with income, so low rates, low income shocks, high rates, high income shocks, there's going to be a relatively higher optimal fixation length. All right, so without further ado, this is a relatively short presentation. I'm going to jump straight into the model. I'm going to give you an overview of the model. So time is infinite and discrete. We're going to have two household groups, borrowers and savers, and they're going to have preferences. They're going to have CIA preferences over bundles of non-durable goods, C, and housing. Housing is in fixed supply for each of the two household groups, and they're going to have non-durable income that's represented by Lucas trees for each of the types. And the borrower tree in particular is going to be subject to idiosyncratic shocks epsilon. Think about these as kind of a low probability of a large shock when you get unemployed to your income. And they're going to trade and price trees and housing, these borrowers. Borrowers and savers interact by trading in mortgage markets and deposit markets. And a deposit is a one-period risk-free bond issued by saver-owned banks at rate RD. Mortgages are long-term defaultable bonds. So the mortgage payment is going to include an interest payment as well as some principal payment. And we're going to have two stages for these mortgages. In a fixed stage, a mortgage is always originated in a fixed stage, and the interest is going to be fixed. The fixed stage ends with probability pi tau. So in a pure adjustable rate mortgage where interest rates reset every year, that probability is going to be 1. But you can imagine if the probability, for instance, is 1/2, we're going to be able to mimic the idea that on average, the rate is fixed for, say, 2 years or 5 years or 10 years. And so then after the fixed stage, these mortgages enter the floating stage where interest rates are floating, so they're going to be a fixed spread over the policy rate. And the benchmark is going to be US fixed rate mortgage economy with pi tau equals to 0, so basically approximated as not resetting at all. So I'm not going to delve into the details of the model, but I want to give you kind of a visual representation of some of the key innovations in the model. So basically, household decision problems are split into 2 stages. The first stage is going to be the consumption stage, where households only have access to their liquid assets. In particular, their deposits, as well as whatever income they're earning in that period. So there's a friction where they can't access their illiquid assets. So in that state, they can decide to default or not default. So these 2 branches. So in the top branch, when they're defaulting, what are they gaining? They don't have to make a mortgage payment, but they're going to pay a non-pecuniary utility penalty ADA. If they do not default, they have to make their mortgage payment, but they can carry any of the savings that they have intra-period, anything that they save in that period, they can actually carry it over in the next stage. So what's the next stage? We'll call that the trading stage. There you actually do have finally access to your illiquid assets, including your housing. So if you default, you're going to lose your house, you're going to lose a kind of pecuniary penalty, you're going to lose fraction lambda of your trees, and your mortgage is written off. If you do not default, you can keep your home equity in the trees and your intra-period savings, if any, and you kind of choose, again, you kind of make portfolio decisions about housing, mortgages, deposits, and trees. So what's the idea? Why are we doing this? So it's basically a cash in advance type constraint to characterize differential default behaviors. The first default behavior is when there's ample liquid assets. Households basically want to equalize the marginal utility of consumption and wealth, and that's kind of very familiar, that's standard, and so that's kind of net worth driven or strategic, what people typically think of as strategic default to increase wealth. So they're going to default in order to increase wealth. The second type of scenario is where households actually have low liquid assets. Households would like to give up wealth in the trading stage in order to increase their consumption in the consumption stage. And the only way to do that is to basically default, to kind of get rid of the mortgage payment. And so that would lead to liquidity-driven default, to basically increase the liquid assets in the consumption stage, even at a high cost to future wealth. So it's not necessarily net worth driven. And so that's going to help us map to the empirical facts that we find that there are spikes in default as a response to kind of increases in mortgage payments, and that's found a lot of kind of more empirical evidence in more recent work for liquidity-driven default. So we're going to implement that in a macro model. Okay, so briefly on the banking sector net worth is basically the value of the mortgage portfolio minus the deposits, net of an intermediation cost. The mortgage portfolio value depends on borrower default decisions and mortgage prices, so it's going to depend on payments, remaining principal for non-defaulted loans, foreclosure proceeds for defaulted loans. Lending and financing works as follows. So banks are going to raise equity from and pay dividends to savers. They're going to issue deposits to borrowers and outside investors. And the risk-free rate, RF, is going to pass through imperfectly to deposit rates. So basically, the intercept is going to be smaller than 0, and the slope is going to be smaller than 1. So that's what you may have come across as the deposit beta. Banks make new mortgage loans, and they're subject to capital requirements, so they can only fund their mortgage portfolio up to a fraction psi in deposits. Okay, so I'm not going to walk you through the details of the equilibrium conditions. So there's given exogenous processes and idiosyncratic shocks. And equilibrium consists of the things that you would expect it to, and markets such that markets for housing, Lucas tree shares, and mortgages clear. So I want to flag that basically the one market that doesn't clear is the deposit market. It's demanded elastically by outside investors. In that sense, we can also kind of introduce fluctuations in interest rates exogenously. We're going to use an aggregation trick from my colleagues, Will Diamond and Tim Landvoigt, where despite idiosyncratic and undiversifiable risks, borrowers make identical choices per unit of wealth, and as a result, we don't need to keep track of the wealth distribution as an infinite dimensional state variable. And as before, this is kind of in theme with the conference, maybe we're going to use global solutions. Okay, so some calibration highlights briefly. We're going to introduce, we're going to have an AR1 estimated from 1-year real rates to characterize risk-free rates. We're going to keep aggregate income constant. We're going to relax that later and going to introduce aggregate income risk. And idiosyncratic income, as I said, is basically 2 states in order to match the frequency and the income loss that you experience when you get unemployed. Deposit rates are 1.8% lower than the policy rate on average, and the sensitivity is 0.34. So when policy rates go up by 1%, deposit rates only go up by 0.34%. We're going to internally calibrate parameters to match the SCF and mortgage market moments. So for instance, preferences are going to calibrate it such that we match mortgage income and housing to income ratios. The cost of default is going to match default rates, deposit to income, and the loss given default. The operating cost is going to map to the mortgage rate levels that we observe, and the principal payment share is going to match to a contractual mortgage duration. So with that being said, we can look at some results and look at, in particular, differences across FRM and ARM economies. The ARM economy right now that I'm showing you is basically a stark example where interest rates reset every period. And so you see that they respond differently to rate shocks. So we're looking at household outcomes. So in the second panel, so basically this is in response to about a 3 percentage point policy rate increase. You see that for our mortgage payments, they see a sharp spike. No effect on impact, basically, for fixed rate mortgages, kind of mapping to what I've shown you right at the beginning. Mortgage market values, basically, if you're thinking about kind of finance concepts, there's basically a discount rate shock that's reducing the market value of fixed rate mortgages, and also kind of cash flow shocks. Basically, your mortgage payments have gone up. That's basically increasing your income, your cash flows from a perspective of an ARM bank. And so that's going up, whereas it's going down for FRMs. And we also see a divergence in defaults. So where does that come from? There's basically now a liquidity incentive for ARM defaults. That's something that I'm going to show you. But actually, interestingly, we would predict a kind of slight decrease for FRM defaults. Why? Because I'm holding on to a fixed rate mortgage that, whereas market rates have gone up right now, so it's actually the opportunity cost of me giving up my mortgage that has a low rate has gone up. So I'm going to hold on to my mortgage longer, and I'm not going to default, all else equal, as much. Okay, so now let's look at banks. So what do we see for banks? Basically, the net interest margin goes down somewhat for fixed rate mortgages. Why is that? Payments, right, have stayed relatively flat. Deposits, however, deposit funding costs have gone up somewhat, right? So there's the deposit kind of rate does respond. It does increase. It doesn't. The only thing is that it doesn't increase one for one. So the net interest margin declines somewhat, but it goes up a lot for ARM mortgages. So basically, mortgage interest income more than offsets the increase in defaults that we saw. Right? So banks are basically the mortgage rate is linked one-to-one to the policy rate, and so that's why the income net interest margin goes up, whereas deposit rates basically go up for both. So as a result, FRM basically, they've experienced these market losses, ARMs experience these market gains on mortgages. So bank net worth for ARMs actually goes up quite sharply and goes down for FRMs. Now there's a kind of intermediary asset pricing logic where that leads to non-linear effects. So basically, there is a kind of an increase in both directions, but basically leads to a sharp spike in risk premia for ARMs, whereas the kind of improvement in net worth only leads to a small reduction in risk premia for the ARM world here. Okay, so just to conclude what we've just seen, basically increases and fluctuations in interest rates affect banks and households in opposite directions depending on the underlying mortgage structure. Okay, so just to show you what I promised, basically there's some kind of, you shouldn't take this as like a close empirical mapping, but kind of stylized facts that are consistent with our model. And these would be the predictions that are kind of slightly, when we reduce the kind of time series over about 5 years, we would expect this increase in default rates and reduction in FRM default rates. And we actually do see that in the US, default rates actually did go down by about 20%. And they did go up in the UK, as an example, by about 60%, from a low level, but they went up quite a bit. Similarly, if you look at the predictions for intermediary net wealth, you may notice, but basically UK, Euro area, and other countries, kind of bank equities have dramatically outperformed bank equities in the US over that period, and they have subsequently converged. That's against the backdrop where US equities, other non-bank equities, have actually done very well. Okay, so that's some kind of stylized kind of, does this make sense in any kind of way? There seems to be some vague empirical mapping. Now, I've shown you kind of these divergent outcomes. What does that mean for financial stability outcomes? So I'm plotting here average intermediary net worth to GDP over different interest rate levels, ARM, the 1 year adjusting ARM in orange again, and you see basically there's a much steeper slope. So when rates are low, basically, net income is not coming in, and so things are not so great for intermediaries. When rates are high, that's a good state of the world for intermediaries, and that relationship is the opposite, but it's not as interest rate sensitive. Okay, now so ARMs basically lead to higher, so basically there's more volatility for ARMs. Depending on interest rates, ARM banks are gonna be doing well or not so well. And that's part of the reason why FRMs are relatively more stable is deposit stickiness. So if we double the deposit stickiness from what we observe, you actually see that the slopes kind of get closer to each other. So it makes the ARM economy relatively less cyclical and the FRM economy kind of more sensitive to interest rate changes. However, as I already explained, ARMs basically create a strong net worth hedging channel. And so how can you see this? I'm plotting intermediary net worth and default rates. And you see that both are positively correlated. That means there's hedging actually in both economies. Defaults happen in states of the world when intermediaries are doing relatively well. But that correlation is much stronger in the ARM world where default is much more interest rate sensitive. Okay, so that's what you basically see here. Defaults are spiking when interest rates are highest, but that's also the states of the world when intermediaries are doing well. The converse here is true, where defaults are high when interest rates are actually low, or defaults are low, right? As we've seen, they're kind of relatively low right now when intermediary net worth is relatively low, but that hedging channel is weaker. So as a result, we're going to find that an intermediate fixed rate length basically flattens net worth and default sensitivity. and basically balances both advantages and disadvantages of both systems to some extent. So here we're plotting a 3-year fixed rate mortgage, so an intermediate fixed rate length. And you see that basically the sensitivity of intermediate net worth to the interest rate level as well as the default sensitivity kind of flattened out. And so we can do this. So what I've shown you until just now was basically these stark contrasts between adjustable rate mortgages that we set every year. We can basically solve for economies, different counterfactual economies that have different fixation lengths, and look at financial stability outcomes. Here we're taking one, but they all look relatively similar, which is the volatility of the intermediary's return on equity. And you see that the adjustable rate mortgage, sort of fully kind of resetting it every year, is the most volatile in using that measure. And FRM, on the other hand, is also relatively volatile, but not as volatile because of the deposit stickiness that we calibrate to. And you see that there's an interior solution, and the lowest point that we find is about, so that volatility is minimized at about a 3-year fixed rate contract. Now, this is all about financial stability. So now what did we do on the risk sharing side? So what's the idea for optimal risk sharing in complete markets? Aggregate shocks basically cause equal consumption growth rates across agents. So in this case, we have borrowers and savers. So when we look at the FRM and the ARM borrower and saver consumption in response to an interest rate shock, they are quite different, meaning that, and in this case, the 3-year ARM basically overcorrects a little bit, so it eliminates the large savers exposure that savers have in the FRM world, but introduces too much borrower risk. So we find that we can do a little bit better by increasing the fixation length to 5 years and kind of equalizing those consumption drops across, and that's an indicator of good risk-sharing properties. Lastly, we can also show that these mechanisms kind of interact with the macroeconomic environment. So we can recalibrate the exogenous environment and basically have a VAR between income and the interest rate process, and the contemporaneous correlation that we get in our 1987 to 2024 sample is 0.31. So that's kind of an indicative of kind of, on average, there's been demand shocks. So interest rates and income are kind of positively correlated, right? When rates are low, that's also when income is low. When rates are high, that's also when incomes are high. But that's not always true. So that's just a side note that we thought was actually quite interesting. If we look at a much longer sample, on average, the correlation is actually 0. That's indicative, of course, of the economy typically being a mixture of both demand shocks and supply shocks, where the correlation is negative. And so we find that basically FRM default rates are more sensitive. Basically, when we introduce this positive correlation, this makes FRM default rates more sensitive to rates and basically strengthens the FRM hedging channel, and conversely makes the kind of hedging properties of the ARM mortgage worse. So we can show this by showing basically, depending on what kind of underlying correlation you introduce into the income and interest rate process, the optimal fixation length from kind of volatility, intermediary volatility minimizing perspective does go up, as does the one for risk sharing, but it doesn't go up to something like 30 years. It's more something like, here going from, say, 0 to from 3 to 3.5, and for risk sharing from 4.5 to about 5.5, if you include a kind of calibrated correlation. So all else equal, there is a kind of somewhat of a shift depending on the underlying macro environment, but it is not as stark to justify maybe some of the extreme kind of mortgage structures. Okay, so this is kind of me coming full circle as a European having moved to the US, is that if you are American and you look at your 30-year fixed rate mortgages and you look across the world and you're like, everyone else has these weird mortgages. But actually, if you think about this, I now tell the story very differently, is that across the world, these intermediate fixed rate lengths are very prevalent. They have emerged in, with much less government intervention, and maybe one reason that explains their prevalence is that these mortgage structures are relatively stable. Okay, so I'm going to conclude. So basically, mortgage structure matters for financial stability and risk sharing. We provide an equilibrium evaluation of mortgage structure, financial stability, and risk sharing. One way to think about this is that now when we're thinking holistically about hedging the financial system in equilibrium, we don't just take into account the kind of interest rate duration, but we also want to take into account the kind of equilibrium effects with credit risk and kind of intermediary asset pricing and kind of net worth logic. I want to end this by saying there are important implications for mortgage design, macroprudential, and monetary policy. So I think one thing to take away from this is that there's much to be learned for mortgage design across the world. And secondly, that macroprudential responses to rate changes may actually look quite differently if you sit at the Fed or if you sit in here. And lastly, we hope we contribute to basically formalizing linkages between monetary policy and financial stability. Thank you so much, and really looking forward to Javier's comments.
3, 2, 1, Javier. The eternal Javier Suarez from SEMFI, our discussant exceptionally today.
Thank you very much. Thank you, the organizers, for inviting me to discuss this paper. It was a great opportunity to read carefully and learn a lot, and also to have the chance to participate in this nice conference. So the title of the paper says a lot about what is it about. This paper is going to provide a quantitative assessment of the financial stability and risk-sharing implications of fixed-rate mortgages versus adjustable-rate mortgages, or more generally, the implications of mortgage rate fixation lengths. How, as the presentation by Lou was making clear, by developing, calibrating, globally solving, and analyzing a dynamic general equilibrium model, somehow with the minimal ingredients necessary to capture a very rich set of effects associated with fixation rate length. In the model, there are some borrowers that receive mortgage loans from financial intermediaries owned eventually by savers. These financial intermediaries in most of the paper are called banks. They are subject to capital requirements and the effects of fixation lengths on the evolution of the net worth that feeds the intermediaries' capital requirements is important for the dynamics of the model. There are many frictions in the background. The model is very carefully crafted. There are many moving parts, eventually a relatively small number of parameters, and a beautiful aspect of the construction, as Lou was mentioning, is that there is no need to keep track of the evolution of individual borrowers' net worth because everything is proportional. And so it works essentially as if you had a representative borrower, except for the fact that there is heterogeneity in the endogenous default decisions. I think having endogenous default decisions is also a nice feature of the model. The model is calibrated to annual frequency for the US economy using a reasonably long time interval where interest rates were moving all over the place, and assuming that the US belongs to a fixed rate mortgage regime. So the fixation length of the mortgage is essentially a parameter in this model. And for the US, these rates are fixed for the whole life of the mortgage. The model is solved globally using methods that have been introduced recently in the literature, and is going to compare the baseline calibration with fixed rate mortgages to alternative counterfactuals where the rate fixation lengths vary. The analysis is a structure, as we could see in the presentation. This is mimicked in the paper. First, looking at impulse response functions to a positive interest rate shock, which in the model follows an AR1. So it's essentially an exogenous process that affects how some outside investors are fixing the deposit rate at which they are willing to provide perfectly elastic deposits to the banks. This is going to set the deposit rate in a simple, basic formula-based manner. paper is going to also look at financial stability implications through two proxies, essentially, mortgage default rate and the volatility of banks' net worth, or also return on equity. And finally, more briefly, looking at the risk-sharing implications measured through the dispersion of consumption growth rates, both between borrowers and between or across borrowers and lenders, savers. What are the main findings of this paper? As actually summarized by the paper itself, this is very clear. The first finding is that rising interest rates affects households and financial intermediaries in opposite directions, depending on the mortgage rate fixation rule. I think this is common wisdom in financial stability discussions seen in the last 3-4 years. Everyone was aware that the nature of the fixed rate versus adjustable rate mortgages was having an influence for who was bearing the interest rate risk. Households with debts, or the more generally also maybe the firms with debts, or the intermediaries. However, what is very hard is to quantify those effects, and this paper is a very serious attempt to do that. Then there is, to my taste, the most novel finding in the paper, that is the existence of actually an interior optimal rate fixation length. I would like to know more. The paper explains quite a bit what are the forces behind the trade-offs, but what exactly provides an interior solution as opposed to a corner solution. There must be some curvature in the relevant trade-offs that leads to a magic number. And we saw in one of the graphs that the 3-year fixation rate is minimizing the volatility of financial intermediaries' return on equity. So maybe a detailed exploration of why in particular 3 years, and at 3 years you get such a big change in a slope, will help get further intuition on this result. The last result emphasized by the authors is that the optimal fixation rate will be higher if there is also income risk correlated to interest rate risk. So if such a correlation is positive, it makes sense, in a sense, to financial intermediaries provide greater insurance to households by making the fixation length longer. This is very commonsensical, but I think it was not previously quantified. So the paper is very important. It's ambitious in trying to measure something very relevant for financial stability, and also beyond that for risk sharing, probably more welfare relevant than financial stability. It captures elements that are in everybody's in the field, everybody's in the field discussion on what are the implications of raising rates. But the merit is at capturing all those many effects in a compact and tractable manner, and eventually being able to run counterfactuals that could be informative on different performance of different economies based on the underlying structure, or maybe trying to design what the optimal structure is. I'm going to have 3 very connected comments, hopefully not too long to make. The first is that being this such an important, the interest rate fixation length, such an important driver of the results, the paper is treating it as an exogenous parameter, as a fixed forever country-specific parameter. Somehow I would like this to be an equilibrium object. So I would like to understand why the US has, if it is the case, fixed rate mortgages only, whereas some other European countries have adjustable rate mortgages only. Well, if it is because the law has fixed it, even there could be some historical explanations. But I don't think it's that the law has fixed it. Maybe it's custom. Maybe there are fundamental factors of each economy that explain why each economy is focusing on a different fixation convention. Moreover, this is not necessarily a fixed parameter for a given economy. Spain, during the days of the housing bubble, had a very predominant adjustable rate mortgages, but in recent years, I don't know whether out of the experience learned from that crisis, we have seen a lot of variation in the newly originated mortgages, how many of them are fixed versus variable. You see that at the beginning of the period shown there, most mortgages originated with variable rates, but towards 2020, about half were of one type and half of the other, and then probably in the perception that interest rates will start moving in an opposite direction, the practice in the market was changing. And actually, basically, this points to a model where instead of fixing this exogenously, financial intermediaries are willing to offer both types of mortgages at potentially different equilibrium prices. So as we see in the Spanish data for these newly originated loans, if you originate fixed rate mortgages, you demand a higher rate as a bank than when you originate adjustable rate mortgages. So there is like an insurance premium paid in between, which is also endogenous and part of the story. So if I were to apply Luz and co-author model to Spain, I will think of how to extend it to have these intermediaries offering the two products simultaneously and households making a choice based on some underlying heterogeneity, which explains why not all of them want the same type of mortgage at the same time. And in a model where we had that, we could wonder whether the equilibrium mortgage rate fixation length, which is result of individual optimization by banks and households, is the one that is most convenient from a macroprudential perspective, right? So macroprudential policy discussions tend to be based on externalities. So in a model like that, I will wonder what is the externality, if any, that will motivate the equilibrium fixation length not to be the one most convenient from either a welfare perspective or a financial stability perspective, and then what type of policies could be devised to address that issue. So this is actually, to say, this is a very nice paper that I recommend everyone to read, but I see it as a first step in an ambitious research program. There are many open questions. Thank you so much.
Thank you, Javier. Do you feel an urge to answer immediately, or shall we first collect some questions?
Happy to collect questions.
Yeah, let's do that then. So, okay, let's engage our audience. Usual presentation, even though repetitive.
Victor Stebanos, the Federal Reserve Board, Washington, D.C. So I really like the idea of studying the implications of the sort of fixation of mortgage rates. After all, interest rate risk should live with someone, and whether that sort of type of agent is appropriate to hold it, and whether they adequately compensate, I think it's extremely relevant. I feel though that selling this model to American audience may be challenging, and I'll also try to explain why. So I think there are a couple of ways how residential mortgages are funded. There's a bank-based system and there's a market-based system. So the US went with the market-based, right? So most mortgage originators actually not banks, they're sort of special companies. And, they sell quickly their mortgages to government-sponsored enterprises like Fannie Mae and Freddie Mac, which packages them into mortgage-backed securities and sort of sell to investors, right? So basically, it's not that banks are exposed to interest rate risk in residential mortgages. All that stuff lives with non-banks or, some investors. And, these guys, these agents have very different set of constraints. They operate in different environment. They have very different incentives from banks, and they have, very different sort of imprint on financial stability. Whereas I feel like your model is perfectly suited for Europe, for example, where residential mortgage finance is bank-based. So, I completely sort of buy what you have, if I think about Europe. But if I think about the United States, this is where, I have some difficulties. So if you can dispel my difficulties or maybe think about, changing the picture of your paper, I'll be glad to hear your thoughts. Thank you.
Livio, and then in the back there.
Thank you, Livio Stracca, ECB. I'm sorry if you already mentioned it because I missed the very first part of your presentation, but is there a role for also market refinancing in the model? So can mortgages be refinanced? Because of course, for refinancing makes long-term, so fixed rate mortgage is more similar to variable rate. So and then there is also cost of refinancing, but again, perhaps I missed it. Thanks.
There was a third question in the northeast.
Thank you very much, Daniel Dickelmann, ECB. I like the paper a lot. I have a question that goes into Livio's direction. You showed this really nice figure for the different interest rate environments. And then when interest rates were low, for fixed rate mortgages, the default rate was quite high. And I wonder whether first that has to do with the US perhaps, where walking away from a mortgage is relatively, I don't want to say cost-free, but it's less costly than other fixed rate countries. And then secondly, my thought was, oh, is this not a great opportunity to refinance rather than to default? Thank you.
If I may, I would add one. I don't know. There was another. Okay, sorry. There's a fourth question there in the back. Sorry, we have a lot of questions.
That's good.
Hi. Thanks, Edgar Vogel from the Bundesbank. Very nice paper. And as Javier said, simple and complicated at the same time. So just have one thought and one question. So from a welfare perspective, it is essential who is the better risk manager. Is it the household or is it the bank? And I think the literature shows that households are less sophisticated than banks in managing risks. So I was wondering whether you see a way in your model to incorporate this feature, because that makes me think that the optimal length of fixation period should be higher, right? Thanks.
I keep my questions for myself, so you have a lot on your plate. So let's see. Maybe if there's a room afterwards, I still ask them. Otherwise,
okay, wonderful. So let me go in somewhat reverse order. I want to address the mortgage-backed securities and the U.S. system being quite different first, because I've presented this paper primarily to U.S. audiences. It was well received, but the comment that we did get was, mortgages are not held on balance sheet. But if you actually look at the flow of funds data, of course, banks are the main holder of MBS, right? So the origination structure has there's different incentives given the prevalence of the government-sponsored enterprises. But the vast majority, we have a chart in the appendix that basically says that the vast majority of MBS are then bought back by banks for interesting reasons that I think warrant further research. Now, what we can do and the way we think about the way we model the financial system is that this includes the kind of financial system as a whole. We do calibrate to banks' deposit sensitivity, but if you do think that's the one way where we can kind of play around, if you do think that, for instance, non-bank financial holders of mortgages are, for instance, different in how flighty their deposits are, then one counterfactual we have is kind of increase the flightiness of the deposits to kind of reflect different agents. So in some sense, right, the risk has to be held somewhere else. So it has to be held somewhere in the system, unless you think it's kind of outside agents who bear the interest rate risk. So I think we can deal with that, but you tell me afterwards. On mortgage refinancing, so basically we can introduce a refinancing option. It's not in there right now. The thing is that it's basically going to make properties slightly worse. It's going to make fixed rate mortgages in particular even worse because of the kind of negative convexity. So households are going to prepay exactly then when it's quite painful for lenders. So we can do it. It's also similar actually for ARMs. It's also households want to do that when it's not ideal for lenders. I want to come back to the question on the default behavior and why there's different levels. Of course, so what I've shown you is basically changes relative to a level. If you look at the levels, of course, the US and Euro area levels are not the same, because also, again, the US is quite special in terms of its recourse regime, as you said. And so one way, I think, this is a bit of a hand-wavy kind of way to address this, but basically the US has the GSEs. We're currently not actively doing anything about that in terms of modeling. We can, and we have some ideas of how to do that. Vadim has done a lot of work on that. But one way to think about it is that there's basically mostly prepayment risk that banks are bearing. It's not necessarily the default risk. And so maybe in some sense the kind of things kind of even out, and maybe these two are actually relatively comparable. But of course there are level differences. I like the welfare question. That was kind of the grand idea that we had when we set out doing the paper. The reason why we've kind of shied away from that and talk about mostly risk sharing is because one of the reasons is that we don't clear all of the markets. Not everything is endogenous. There's kind of this deposit market where there's outside investors, so that kind of makes it difficult to think about aggregate welfare. And the other reason is actually precisely what you said, is basically I've done some work myself on mortgage refinancing and how households don't do that optimally. If we were to introduce that into the model, I think that would change, that would kind of mediate some of our conclusions, but that's not what we're doing in this paper. So we basically didn't make very strong kind of prescriptive statements. To some extent, it's kind of a positive description of what's going on. And I think that brings me, I want to thank Javier so much for his very kind words and very thoughtful thoughts. I want to kind of talk maybe briefly about why we think the kind of country-specific reset probability is in some sense a good approximation. So the US is in many ways, the US is the big outlier. And we know that in the US there's been a lot of government intervention. If you look at the history of the US 30-year fixed rate mortgage, it's actually quite interesting. There was a lot of government intervention to kind of create that market. Of course, now you've created also the liquidity for the MBS market. It kind of becomes a little bit self-fulfilling. But in some sense, that's a bit of an extreme policy choice. In most other countries, there's some kind of equilibrium effect where there's demand and supply of people. And I've done that a little bit more in my job market paper. It's a little bit more of a micro analysis of how do households choose the fixation length given the relative costs and benefits of insurance. And that's kind of precisely something that's going to be determined by things like how costly is the overall funding cost. It's going to interact with risk. So it's a slightly different decision that we think is extremely interesting, and I've done some work on, but is not something that we currently kind of are able to encompass in this model. And I really like Spain as an example, because if you look at the data that I've shown you, Spain is one of the only outliers that had a massive shift actually in its reliance from adjustable rate to fixed rate mortgages. We had to look into this because it sticks out on that chart that I've shown you. It's only Spain that kind of has this different, when we look at different measures, it kind of basically more recently has had much more of a shift to fixed rate mortgages. That was actually government policy to incentivize households to switch their adjustable rate more to fixed rate. So I think it was kind of forward-looking government policy that incentivized that. And I think within that kind of framework, it is genuinely a kind of a household optimizing decision of costs and benefits. But I think overall, the approximation that they're relatively stable with some kind of reasonable economic variation around something that is kind of country specific is a reasonable approximation. I'll leave it at that.
Okay, thank you very much to both speakers. So we ate a bit in your break. Now you can eat into the pastry. We see each other for the last two papers at 4:15. I please beg you to be on time, because at the end of the conference, some people have to take travel options. So we want to finish on time. Thank you very much. So welcome back to the last mile of this Financial Stability and Macroprudential Policy Conference. So let's just jump into the substance. So I promised you 3 real estate papers. Now comes the second one, which is the Financial Accelerator based on commercial real estate collateral. So the speaker is Ellen Ryan from our Financial Stability Department. The floor is yours.
Thank you very much. I'm very happy to be here. Thank you very much to the organizers for inviting us to present our work. I'm going to do some work done together with my wonderful co-authors, Aoife Horn and Barbara Jarmulska, where we look at the link between asset prices, collateral, and bank lending. And specifically, we look at it in the context of commercial real estate collateralized lending following the outbreak of the COVID-19 pandemic. So the usual disclaimers apply. Of course, these are our views, not necessarily those of the ECB. So I'll start with a quick overview of our whole paper before we get into the detail. So our paper is an empirical paper. Our data set is a very important component of this analysis, so we use AnaCredit. This is a widely used data set in the euro area. It's credit registry data covering all lending by euro area banks to companies. This loan level element of the data set is very well known and very widely used. A less commonly used element of this data set is that it's also collateral level. And this means that we have data on almost 5 million pieces of real estate collateral, which we can follow on a monthly basis throughout the COVID-19 pandemic. And this means that we can see the impact of that big negative shock that was COVID on commercial real estate markets. We can see how that affected the collateral, how the banks treated it, and then we can see lending outcomes associated with that collateral. In terms of our findings, we find that banks did sharply cut lending against commercial real estate collateral following the outbreak of the pandemic. We also find that this relationship between collateral and lending outcomes is, stands up very well against very strict endogeneity testing. Surprisingly, when we go and look at the revaluation of collateral happening behind that lending outcome, we actually find that there was no major change in revaluation behavior happening behind this huge drop in lending. What we propose, taking these facts together, is that potentially during a crisis, this collateral channel, or potentially the financial accelerator, can operate via an uncertainty channel, where banks cut lending because they're uncertain about collateral values, not necessarily because they have a concrete belief that this collateral is worth less. So in my presentation, first we're going to go through the motivation for our work and the literature. I'll give you a quick overview of our data, and then we'll get into the meat of the analysis. So first, what we do is we ask if banks did avoid lending to firms that were reliant on commercial real estate collateral following the outbreak of the pandemic. Then we dig into the revaluation of the collateral happening behind that lending decision, and then we try to pull all of these facts together. So in terms of motivation, we can take a few steps back first and just say, why do we care about collateral and collateral values? And even if we don't think about it every day or talk about it every day, when we do financial stability work, a lot of the theory behind what we're doing is based on collateral. And collateral plays a very central role in how we understand the financial cycle. So maybe the most famous example of this is the Bernanke and Gertler financial accelerator mechanism, whereby you have rising asset prices. This increases collateral values. That means firms' borrowing constraints are relaxed. They can borrow more, they can invest more, there's more economic activity, and then asset prices go up again, and the cycle starts again. As financial stability people, we all know that this can also work in the opposite direction. And actually, during the outbreak of COVID-19, we would be expecting the opposite direction with falling asset prices. We won't discuss this, but because we were all financial stability kind of people who wrote the paper, and it's a financial stability conference. But of course, also, collateral is very important to our understanding of monetary policy transmission, also via the collateral channel. So we have this big, very important theory. We also think that COVID-19 and commercial real estate are a really interesting case study for testing this theory, or using microdata to understand how it works in practice. So on one hand, COVID-19, and particularly the accompanying lockdowns, which closed shopping centers, closed office buildings. No one knew if we'd ever use an office again. People were talking about this massive rise in e-commerce, was a huge negative shock to commercial real estate markets. And we illustrate that here with REIT share prices. REITs are companies that own real estate. And you can see that the share prices for offices and retail companies dropped sharply with the outbreak of the pandemic and stayed sort of 30 to 50% below pre-pandemic values over the period we study. We find that residential markets actually also had a huge initial negative shock, but the market recovered. So we have a big negative exogenous shock, and actually commercial real estate is very widely used as collateral on lending by euro area banks to companies. So on aggregate, almost 40% of euro area NFC loans are collateralized by commercial real estate. So we would expect this big negative exogenous shock to have had a very economically significant impact if the financial accelerator channel happened the way we'd expect it to. In terms of the existing literature, you can mostly break it down into two big chunks. On one hand, you have the big macro papers, the Bernanke-Gertler, the Kiyotaki-Moore, who lay out this mechanism. We then, of course, aren't the first people to try test it using microdata and looking at real estate and commercial real estate. So within that literature, Cheney et al. Is the sort of the main, most famous seminal paper. It's the big AER paper. And they find that rising real estate prices in the US before the GFC increased investment of firms who owned real estate, and they narrow this down to a collateral channel. There's also a wide range of other papers who also typically find this collateral channel in operation for real estate. There are, however, if you go and try and do this work in practice, you spend a lot of your time dealing with endogeneity. The first form of endogeneity, of course, is that it's hard to tell if the real estate shock drives the investment or if the investment drives the real estate prices. As I've already said, our case study deals with that quite effectively because we know that the price shock or the market shock came from lockdown, not from firm investment. The second, even more problematic form of endogeneity essentially is that it's hard sometimes to differentiate the collateral from the business model. Cheney et al. Argue that maybe companies who own real estate are more exposed to local economic shocks. In our case, this is a huge problem because companies posting office buildings as real estate maybe ran office buildings, and no one wanted to lend them money during a crisis because no one knew if they were going to go bankrupt or not. They probably weren't borrowing to expand their business. This is going to be an issue. And actually, the Cheney et al., again, the seminal paper, accept that they can't fully address this form of endogeneity. This is because a lot of the literature uses company-level data, so there's always an unobservable characteristic you can't control for. However, our data is incredibly granular, so we apply Croisian mean. We do this by looking at our work at the bank-borrower relationship level, and then including borrower fixed effects, which means we can look at individual borrowers with multiple banking relationships and compare outcomes across those relationships, particularly relationships that are commercial real estate collateralized and those that aren't. And we can then fully control for this source of endogeneity, which we think is quite powerful. Our other contribution to the literature is that when we think about this financial accelerator model, we have a tendency in our heads to implicitly assume that banks are sort of doing a one-to-one mapping of asset price changes onto collateral values. But we don't know if that's true or not. So ours, as far as we're aware, ours is the first study to actually study this link, and that green circle on the chart there, which is banks' revaluation of collateral following shocks. In terms of our data set, again, our data set is called AnaCredit. It's loan-level data. It's a huge, very valuable data set. It only covers lending to companies. So to be very clear at this point, there is no household mortgage lending going on in this paper. The data is monthly. We have loans and collateral. In the chart on the right here, we break down again the share of lending to companies, and we show the share that is collateralized by some type of real estate. These are the three categories of real estate we have. We have income-generating commercial real estate, own-use commercial real estate, so that's when you post your own shop as collateral. There's also residential real estate, so that is residential assets owned by companies, again in this case. Unfortunately, we can't differentiate between office and retail, which is a bit heartbreaking, but we had to live with it. It's also why we don't at any point try and compare valuation changes with index changes, because we can't compare to an office or a retail, and they're all moving in different directions. One important thing to note before I keep going, within the data set, when we pulled it apart, we found that the structure of CRE lending is actually very different to traditional mortgage lending, where you have one new loan and one new piece of collateral. In CRE lending, firms typically post a pool of CRE collateral and they borrow against it. So 65% of new loans over the period we study are against collateral already posted with the bank. The remainder are typically against a mix of existing and new collateral. So again, that means the revaluation of the collateral is crucial for driving this financial accelerator model. So our first question, did banks avoid lending to firms who relied on commercial real estate collateral? We're going to address this using a difference in difference model. So our treated sample are bank-borrower relationships, which were fully reliant on real estate collateral prior to the pandemic. Our result is robust to us moving that cutoff around. And we use pre-pandemic measurement because it would make sense for the the collateral used to be varying following the outbreak of this crisis. We look on the right-hand side chart here at the share of new loans in a quarter to firms who were in this treated group. We find that the share is stable pre-pandemic, and we find that it drops very sharply following the outbreak of the pandemic, which would support our hypothesis. There's also no offsetting sort of overlending after that negative shock. Of course, we need to deal with endogeneity. In our specification, as I've said, we're very strict with endogeneity. Our dependent variable, we collapse our difference in difference into one period. So our dependent variable are new loans in that relationship over the first 6 months of the pandemic. We normalize by the stock of outstanding loans in that relationship pre-pandemic. Our coefficient of interest then is beta 1, which is the coefficient on our treated dummy. We would expect that to be negative and statistically significant in a scenario where the collateral channel is at play. And crucially, we include our borrower fixed effects. So we're comparing outcomes for a given borrower. Also to note that we are able to remove all government guaranteed loans from our sample, which were quite widely in use during the period. We do find, even when we've controlled for all of the endogeneity that the literature can't address, that banking relationships in our treated group received almost a third less credit following the outbreak of the pandemic than other banking relationships. So the collateral channel was alive and well during the outbreak of COVID. We find this effect is pretty equal across different types of real estate. And we find also that this finding is robust to many, many, many robustness tests. On the next, so we have many shown here. I won't go through them all. One thing we do is we replace our borrower fixed effects with industry location size fixed effects. And that means we can include our whole sample of borrowers, not just people with one banking relationship. We also account for the possibility that what we're seeing with our borrower fixed effects is substitution, intentional substitution across banking relationships. Essentially, we find that if we look at borrowers with only one banking relationship who can't do that, we still find the negative effect. So going into this, we then expected that this drop in lending would be associated with this mass downward revaluation of collateral, or at least a big drop in upward revaluations. One of the things about using microdata is you don't always find a result that actually aligns with the theory you're trying to study. So what we do here is each of those blocks, we take the total stock of collateral held by euro area banks across the 3 different types in a given year, and we categorize them by the revaluation over that year. And the main message here is that the blocks look quite similar in 2019 and in the pandemic years. We have some increase in downward revaluations of income-producing CRE, but they're not huge, and they're not what we'd expect. When you're a macroeconomist and you look at this, it's very confusing. Luckily, we worked very closely with our colleagues in supervisory, the people who were doing supervisory deep dives on CRE at the time, and when they looked at this, they were like, yes, obviously, which was helpful. So we can actually explain this. There's a few different explanations. First, I guess, if prices are falling, there's a disincentive to do a revaluation because it's going to increase your LGD and increase your provisioning requirements. At the time as well, there was mass uncertainty regarding CRE prices in the market because there was no transactions. So it was actually very hard to price real estate at all, and therefore very hard to do a revaluation. We are able to dig into this further, of course, because our data is spectacularly granular. So we did check if maybe there was big intra-year revaluations. So this is the same thing, but at a monthly level, and the dotted line is the start of the pandemic. We didn't find much change. One thing we did find, however, is that there are clear cross-country patterns in the data. So we find that there's quite significant variation within the euro area about the share of collateral that gets revalued in a given year. And they were also very consistent across years. So you have France, for example, where a lot of collateral gets revalued. You have Germany, where very little gets revalued. We quickly checked if this could be explained by differences in market dynamics by looking at the residential real estate component. We found it couldn't. But you can explain it by understanding sort of the institutional frameworks around revaluation. So in France, there's a lot of models used, which are very easy to update. So it's easy to update your whole portfolio. In Germany, there's a different kind of conceptual approach where you should value the collateral kind of once every 10 years, and it should be a through the cycle measure. And this doesn't need to be revalued. So what this shows us is that the model that we run in our heads kind of maybe is not including very important institutional frictions, which may change how this model works. It also means that as a regulator, if you're ever looking at an LTV 1 year into a crisis, you should maybe approach that value with caution. We do also, and I won't show this, we check if the low revaluations are driven by, say, the COVID measures in place, and we don't find that this is being driven by, say, government guarantees or moratoria. We find that what gets selected to be revalued is very different also in different countries. And then also, I won't go into the detail of this for the sake of time, but we do also check that these revaluations aren't just like box-ticking exercises that the banks don't believe in, or that they've just put into AnaCredit to keep us happy. So we do that by checking if the revaluations that did happen had economic outcomes, or had economic significance, and in particular, if they affected lending outcomes. We do this by building this big monthly panel at the bank lending relationship level of CRE-collateralized lending. We use, again, our borrower fixed effect. So we then say for one borrower, if one banking relationship revalues and the other doesn't, does this affect your lending outcomes? We find that they do, and exactly the way you'd expect to. So with a negative revaluation, you're 18% less likely to get a new loan. If you're highly leveraged, the effect doubles. The size of revaluation matters. Again, we throw a million robustness tests at this. In particular, we lag the revaluation by 6 months so that it can't be really strategic, that you're doing a negative revaluation because you don't want to give out credit. And even in that case, we get the same results. So this, I think, has been quite interesting, but some of these facts seem to contradict each other. So we've established 3 facts: that banks sharply reduced lending against CRE collateral following the outbreak of the pandemic. However, despite the shock, but also this major change in lending behavior, they carried out limited revaluation of this collateral, and the revaluations that they did carry out did have economic consequences, so they were real. These 3 facts are hard to fit together. So this is our proposal as to how you can fit those 3 facts together. What we propose is that maybe this collateral channel or financial accelerator can operate via 2 separate channels. One is the traditional textbook one, the revaluation channel, where you have an asset market shock, banks revise their beliefs regarding the collateral value, so they revalue it, and then they change their lending behavior. Another is an uncertainty channel, whereby you have an asset market shock. Banks are very uncertain about the value of collateral, so they can't revalue it, but in response to this uncertainty, they cut lending. Maybe a more mathematical way to phrase this is if you imagine a bank looking at a piece of collateral and it has a distribution of beliefs regarding its value, and the mean is what it's going to write down. A revaluation channel is a movement of the mean, and an uncertainty channel is an increase in the standard deviation. But again, let's say the mean stays there. This is our hypothesis. Why should we care about this hypothesis? We propose 2 reasons. First, under the uncertainty channel, banks could cut lending against an asset class that otherwise actually did quite well, which had quite a good outcome. But of course, if bank financing is a big part of that market, this could itself cause a credit crunch. You'll note, if you remember, that the banks in the first months of COVID really cut lending against residential real estate as well. So that would support this. The second reason is that it shows us the macroeconomic effect of this lack of revaluations. So if you pretend I had only shown you that revaluation segment, and that's all the analysis we had done, we would probably all come away from this saying, you know, the revaluations are quite small, but maybe that's a good thing because you have credit smoothing and maybe it stops the impact of the shock being so big. That's the revaluation channel playing in your head. So under the uncertainty channel, if there's a very low level of revaluation happening, that will increase the uncertainty, and that might actually amplify the effect of the shock. So we do test this. So what we want to do is to test this empirically. You're going to have to compare outcomes for banks with higher and lower levels of collateral value uncertainty. We could have done this. Well, I mean, the obvious first thing you think of is, okay, we'll kind of think of a measure of market uncertainty and we'll compare it. That doesn't work because, to be frank, the whole market was uncertain. You can't say it was higher and lower in different places. You also couldn't use a borrower fixed effect because if we're saying Germany was less uncertain than Spain, then it's hard to use your borrower fixed effect. You can't do that endogeneity control. What we can do is look at the cross-section of banks and see how much collateral they had revalued the year before the pandemic. Because at least if coming into the pandemic, you had very thoroughly revised your collateral portfolio and you at least knew the condition you came into the crisis in, we would argue that you had less uncertainty than your peer who hadn't touched the collateral portfolio in quite a while. We are in no way arguing that this will encapsulate all of the uncertainty in the market, but we do think that it will produce cross-sectional variation that we can measure. So we go back to our original difference in difference, our baseline specification, and we add an interaction between the CRE reliance dummy and a dummy that equals 1 if the bank in question revalued more collateral in 2019 than the average bank. We find that basically still, do I have a pointer? No. We find that everyone cut lending, but if you were a bank that had revalued more than the average, you actually cut lending by half as much. This result is robust to playing around a bit with that cutoff. We can pull it down, we still find the result, push it up, we still find the result. It keeps working until you get to the very high share of collateral revaluation. This could be that the certainty returns to revaluing the whole collateral portfolio, or maybe not as big, maybe they're decreasing. It could be also the distribution of that variable. We do also find that the effect is strongest for income-producing commercial real estate, which was probably also facing the highest degree of uncertainty. So we would suggest that this provides at least first evidence for our argument around the uncertainty channel. So that is our paper. Oh no, sorry, we have one more slide. One final thing you could say here, of course, is like, okay, that's all very nice, but COVID was sort of an exceptional period and it was exceptionally uncertain. So you've shown us something about COVID that probably doesn't apply at any other point in time. So I think, again, as financial stability people, we are probably aware at this point that exceptional things happen more frequently than we would expect or be comfortable with. So actually, if we extend our analysis by a few more years, so we can also cover the monetary tightening period, and we know that interest rates in the euro area went up very quickly, which in terms of asset pricing would push down commercial real estate values and therefore commercial real estate collateral values, we would expect the onset of monetary tightening to also give us a huge increase in negative revaluations. Again, we find some increase, but nothing crazy. But we do, when we look at the share of lending, which was CRE collateralized during this period, again, see a massive drop in the share of lending that was CRE collateralized. So we would say that this is the same pattern repeating again. Of course, this was also an exceptional time. That period of monetary tightening was exceptional in how fast it was and in how extreme it was. And I mean, so we talk as part of my job to people who work in CRE markets, and I remember one guy in the middle of all of this just saying, we can't value. What he said was trying to value right now is like trying to drive your car down the highway when you can only look in the rear view mirror. So they were also in a period of heightened uncertainty, and we saw the same thing. So to wrap all of that up, in terms of the main takeaways from this, real estate is an important form of collateral for euro area banks' NFC lending. So understanding how this operates is very important for understanding how the collateral channels should work. We find clear evidence that the outbreak of the COVID-19 pandemic reduced firms' access to credit when they relied on commercial real estate for collateral. And again, this is robust to really strict indigeneity controls. Interestingly, we find that behind all of this, there wasn't a major change in collateral revaluation behavior, and that we propose, taking all of these facts together, that perhaps there was also an uncertainty channel at play. So I will hand over now. So you've got some extra time. I'm somehow ahead of schedule. Here you go. Thanks.
We're discussing this, Thorsten Beck from the European University Institute.
First of all, thank you very much for inviting me. And of course, I'm very happy that Ellen sold 2 minutes for me. The payment comes later. Let me maybe also start with a little bit of a warning. If you see me leaving very quickly shortly after my discussion, this has nothing to do with the paper. It has nothing to do with Ellen or with her co-authors. It's simply the fact that I have to go to the airport. Right. Very brief summary. So credit declined during COVID-19, especially for firms that relied more on commercial real estate pre-COVID. However, at the same time, there was not this widespread revaluation, and the authors basically suggest an additional channel that comes from the uncertainty that we all hopefully, well, we don't want to, but we all remember from this spring 2020. What I wrote here is already, it's a great combination of microdata. It's very clearly identified. Of course, you had a shock, and it's also very carefully executed. So I'm not going to start talking about econometrics at all. It's all very straightforward. I also very much like, as Ellen pointed out, there is this whole literature on the collateral channel. There's a theory behind it, but there's this one missing element which Alan her course was kind of point to, and that's the actual valuation. I mean, we talk about the value of collateral going down, but we normally typically don't care about how this is actually going about. And this paper actually looks directly at it, at the revaluation that happens, and that should, according to the literature, the theory, lead to the lower credit. But this link, as they argue, somewhat was broken during the pandemic. So my comments, and it's a bit of I guess, not sure I completely buy the story. Let me put it this way. I'd like to believe the story. I think it's actually, I think actually it is right, but I think there's something somewhat missing here. This is a comparison. So yes, banks did not engage in widespread revaluation. It was clearly shown. The figure is figure 6, which Ellen also showed. At the same time, there was this negative link between revaluation and lending. More negative revaluation, lower likelihood actually of getting a new loan. The question is, of course, how much was this link? I mean, was this link weaker during COVID between revaluation and lending than during normal times? And that is kind of the part that I'm somewhat missing, because that would be then ultimately then the uncertainty channel. So if I looked, and again, I know that for identification purposes it's difficult to do, but if I looked at the same period in spring 2019, this link, according to you, this link between revaluation and new lending should have been much stronger. And in 2020 it was not. But the 2019 results, I don't see them. So that's what kind of what I'm missing. But I'm also writing here, it's going from the internal to the external validity, basically. Maybe a kind of a minor point. So you link the extent of revaluation to the extensive margin in the sense of is there new lending, yes or no? Can you also link it actually to the intensive margin? Maybe that also gives you already a little bit of a way how much additional lending comes depending on how much there's a revaluation. And then the other thing, which you showed, but which I think you could exploit much more, is this heterogeneity. I mean, you have, what was it, Ireland with 80% of loans being revalued, and then Germany, I think it was like 10% or so. And does that actually also explain some of this variation? Does this explain some of this variation in lending, for example? So I think there is a great opportunity to exploit this heterogeneity and kind of get a little bit deeper. And maybe also, I mean, lockdowns did not match completely during COVID. I'm just coming up with this on the spot here. The lockdowns did not match completely across countries. Maybe there's something else that you can actually use. But I think there's a way to actually go further and kind of actually get to the fact that this was really about uncertainty and it was different from the normal times. Good. So on the uncertainty channel. So I believe it. It makes sense to me. It's the second rather than the first moment. So it's more that you don't know what to do. So kind of like we don't know how to, as Alan quoted, but although somebody from 2022, we didn't know what to do. It's this car kind of, yeah, I wouldn't like to do it, honestly, at least not on a German Autobahn. Now, on the uncertainty, yes, you made the case actually. You kind of anticipated that, I guess, that market-based measures is not because everything was uncertain, so you can't really use it, and there's probably not as much variation anyway that you could use in terms of the uncertainty. Although there seems to be, again, within the sample, I mean, you had different sectors that the CRE was exposed to, right? You had manufacturing, which basically continued, maybe on a lower level, and you had the retail, which not. Then, of course, you had essential retail that continued. And I was very glad to find out back then that the essential retail, at least in London, included my wine store. So there could be some variation, again, that you could actually explore. Are there any data, and that I don't know, this is not my field of expertise actually, no? So are there actually data on price expectations? Is there something that you could also use? And then finally, I mean, what we normally would use, liquidity. We know that the liquidity goes down, volatility typically goes up, or uncertainty goes up, or alternatively, if there's uncertainty, liquidity goes down because nobody wants to trade. I remember that actually also again 2006-07 in the US in the residential real estate market. First, the market dried up, and only then the prices started falling. So, is there something else that you can actually use to make the case? Yes, and then of course, if there's also, there might be the uncertainty, there might be the setback in terms of different sectors, there might be also across different countries. Good. Now, here I'm kind of, I mean, you gave a nice anecdote, but I kind of disagree on the comparison between 2020 and 2022. Because 2022 was very clear, the interest rates would go up. I mean, yes, there was a bit uncertainty at the beginning of how quickly they would go up, but there was one way. They would go up. 2020, March, again, we don't want to remember it, but we do, unfortunately. There was uncertainty about everything. I mean, there was uncertainty about how big would the GDP drop be, which price would go up, which one would go down, how long would the lockdown be. And when the lockdown was lifted, everybody was, oh, great, yes, and then boom, the next one came. So there was, I think there is a bit, so I think the 2022, I would see more as an adjustment, whereas the 2020 was more like a clear uncertainty. So there is a difference. And actually, which offers you again some nice space to make a comparison. Was there a difference in in your estimate? Could you do the same estimation for 2020 and 2022? I understand, of course, the identification is not as clear cut in 2022, but still you could use similar methods, I think, or similar approaches as you did for the COVID period, and to make really kind of, and the effect, again, in my opinion, the effect should be stronger during COVID than it should be during the tightening period of 2022. With this, oh my goodness, I'm also 2 minutes early. What do we do about this, Philip? Anyway, so very nice paper.
I hire you.
Oh! No, you're just a very good moderator, I think. You are onto something, I think, and I really like this work. It's, again, let me just repeat what I said earlier. I think looking at this kind of, as far as I'm aware, this is this missing link about the valuation, and I really liked it, and I'm glad you have these kind of data. But I think you can do more. That's what I want to push you towards. And with this, thank you very much.
Not all the spare time.
Not all of it, but a little bit of it?
A little bit of it. So we do it the other way around from before because of Torsten's plane. So you first answer to him. So he hears all the rebuttals and then can go home.
Good.
But there will be time for questions. So no more. Bear with me.
So thank you so much for your feedback. We really, really value it. And it's great to have someone read our paper and give us feedback. Where to start? In terms of, actually, first off, it was great to actually have someone give us feedback on the uncertainty element of the paper, because we had to put it together, and we like our result, but we're aware that lots of people might not. So it was great to get feedback. In terms of how we measure the uncertainty, as you gave a few examples of like additional ways we could do it, so you could look at different types of assets, say manufacturing versus offices. We can't, in the data, differentiate within our three categories, our income-producing CRE, income-producing RRE, and own use. We do, however, and maybe we should actually put this in the paper, we do find the effect is much stronger for income-producing CRE, which is probably the bit which was most uncertain. We didn't put that in because it's a little bit hand-wavy. In terms of the cross-country uncertainty being different, again, you get into this problem that the borrower fixed effect is a really important part of the identification, and that gets a little harder when you have like...
The triple one, I think it might be.
Yeah, but then you're kind of trying to say if you are one borrower in Germany and one of your lending relationships is in France and one of them is here, you end up with it being a bit complicated. But it is a very good point. The cross-country heterogeneity, I had a whole plan to write a monetary policy paper on that, about monetary policy paper transmission being different across the countries.
You saved it for
because the revaluation is different. But then when we actually extended the sample, we found that this uncertainty channel as opposed to the revaluation channel was probably still dominating, so it probably wouldn't have been much of a paper anyway. In terms of the two periods being different, that I would totally agree. I guess we added the monetary policy bit on the end just to almost make the point that like this was not just COVID. And actually, maybe we should say this more in the paper. It's actually interesting that it's a different type of uncertainty, but it was still there. And I guess you need to keep in mind that when you revalue real estate, it's not like valuing a bond where you can do it instantly on a day-to-day basis, right? So in markets, what the real estate guys were all trying to figure out is where's the end point of the hiking cycle, and then how long do you stay up, and then when do you come down, because you don't revalue as regularly. So there was still huge uncertainty there. But it is a good point, and we should actually maybe make that point more in the paper. One more on the link to the revaluations and the intensive margin. So I skipped over that, and it's actually in an appendix of the paper because the revaluations themselves and the lending outcomes, I guess it's not a main part of the paper. So we show the probits. We do also look at whether revaluation affects the size of your loan. We look at the size, the interest rate, and the maturity. We find that when we have our borrower fixed effects in, we don't find big effects, except for in the likelihood of a loan being made. What's really interesting, though, is when you then take out the borrower fixed effect, and you allow for there to be endogeneity, and you allow for the fact that you're more likely to get a negative revaluation if your business model's falling apart, we do find an effect. So the guys who were getting negative revaluations were also much less likely to, they got smaller loans, higher interest rates, shorter maturities, all of it.
I wonder whether you can do this on a cross-sectional level. You know, you can actually go up to the borrower level. You take the dummies from the first, from the within, and then take it up to the cross-sectional.
Yeah.
That might be an option to actually get to, but yeah, to overcome the heterogeneity, I mean.
But yeah, so that's, thank you very much for your feedback, though. We really appreciate it.
Okay, so now comes the broader audience. First question.
Tivia Kirthi, International Monetary Fund. So a few thoughts. So the first of these is the kind of your main narrative is that this is a period where lending backed by the CRE kind of fell sharply, and at the same time there weren't many transactions going on. So the first thought that comes to mind is, what were the borrowers doing? Were they able to hold on to the CRE, and did they find some other way to finance that? So that's one question that comes to mind. The second question that comes to mind is, I wonder if what your results really show is that CRE valuations are generally quite stale. Because, you know, as Thorsten was saying, you know, when interest rates go up, it's kind of perhaps clear what that means. So it sounds like they're generally quite stale. And I shared Thorsten's thought that it would be nice to do much more in the cross-section. And two specific versions of that. One, your aggregate result for the drop in lending. You know, it would be nice to see a picture that corresponds with that really striking chart that you had, which is that there are some countries where it's revalued a lot and some where it's not. It would be really nice to see whether the drop in lending during COVID had that pattern to it or not across countries. And the second is that your very last test, which was about uncertainty in you know, kind of how much uncertainty the bank had. I wonder whether you're using only within country variation across banks or not. And if not, I'm not sure it quite speaks to your channel.
Okay, we have time for more questions, actually. Erland?
Hi, yeah, Erland near IMF. I missed the very beginning of your talk, so maybe you talked about it, but I wonder whether banks may structurally be reluctant to do these revaluations, because if they do one of those, presumably that would affect the LGD they have in their models, and it'll essentially push capital requirements further up. So that could be a reason that they don't like to do these formal revaluations. But at the same time, they may have privately, you know, a re-estimate of what is the likely value of the collateral, and that can affect their business decision as to whether they want to extend more credit against the collateral. So there could be a disconnect that comes from essentially the desire to manage capital requirements. And what do you think of that explanation?
Jean-David?
Very nice presentation. Thank you. Just a suggestion that may tighten some of the identification. So Glenn Chapman and I, we have a paper in the JF. We use an accredit, and we show that what matters for the lender, among other things, is the correlation between the borrower risk and the collateral risk. So, for example, take a real estate company and a supermarket, and they give the exact same headquarter as collateral. They're going to receive a different interest rate, because by the time you know the real estate company defaults, it's also a time where the collateral, the real estate collateral, decreases in value, much more than in the supermarket case. So you could use this correlation, separating companies that are linked to the real estate industry and companies that are not linked to the real estate company, and to identify your uncertainty, the effect of the uncertainty. And you can posit that the uncertainty is much more, the problem of the uncertainty in the value of the collateral is much more present in the case where the borrower is linked to the real estate industry.
So you have
Great.
5 minutes to answer. So, and then we start on time.
Mm-hmm. Okay, thank you so much again for your questions. The question again on the cross-section being very different across countries, we do also think it's quite striking, and that we haven't looked at kind of the impact that has on lending outcomes. I guess there's two reasons we haven't done it. One is that we find that the revaluation channel is probably not dominant in this case, so we might not find a major impact on lending outcomes, although that would also be really interesting. Again, of course, when you start doing that, you come back into endogeneity territory, right? Where it could be that there was more revaluation in one place because the market was doing worse. So maybe that's also all you're really capturing. And then again, with the uncertainty, yes, we would be looking at within country variation in the share of collateral that gets revalued. But again, we like that because it could be as well that we actually think in a way it is good to strip out the macro elements a bit, because it could also be that German banks tend to revalue less and they also had less uncertainty, and they could be two separate facts, but you might end up accidentally equating them if you aren't controlling for that country element. So actually, once you spend way too long thinking about it, the macro control element or the interaction with a degree of uncertainty within different countries doesn't quite work for a number of reasons. On the reval, is this just gaming your LGDs? We completely acknowledge that that's possibly going on, but it is also why we then went and tested and checked that the revaluations, when they do happen, do affect lending outcomes. So we do know that there must be some correlation between that revaluation and what the bank actually thinks, because otherwise they wouldn't be making lending decisions based on them. On your point, that's actually very interesting. I guess one of the problems there again is that once we start bringing in the type of borrower, our borrower fixed effect stops working. And then you get back into this whole, the main endogeneity problem in the literature, which is also incredibly present for us, is that it's hard to differentiate between the fact that that company runs office buildings and therefore was making no money, and also posted offices as collateral, when we're really trying to identify the role of the collateral. And it's really important to control for the business model. But maybe then we just need to make it more prominent in the results. Actually, maybe the finding that the uncertainty result is greatest when we look at this income-producing commercial real estate as the collateral, because that is probably the collateral which is most relevant in this case. In your case, where there's a correlation between the income and the business model, but we can still use a borrower fixed effect because they may have used one collateral here, different collateral there. But it is also, I guess, will give you this other measure of uncertainty because it's the collateral that was subject to the most uncertainty. But thank you very much for your questions. They were really very helpful. Thank you.
Okay. Good, then it's time to move to the last paper. So we end on a central banker's note on monetary transmission. I would say, Alexandra, 25 minutes. You have them in full.
Good afternoon, everyone. Thank you very much to the organizers for inviting us today to present our paper. So this paper is co-authored with colleagues from the Bank of England, and the usual disclaimer applies in that the views in this paper represent only our own, and they should not be reported as representing the views of the bank or its committees. So I just wanted to start with some of the motivation for this paper. So in the UK, fixed rate mortgages are really uncommon, and most households need to refinance every 2 to 5 years in order to avoid lapsing onto the much more expensive standard variable rates. As a result, there is a role for kind of the pass-through of monetary policy to be stronger in the UK than perhaps it is in other countries with longer fixed-term contracts, such as the US. And this has been particularly important in the context of the latest monetary policy tightening cycle that began in the UK in December 2021 and saw interest rates being hiked at levels unprecedented over the past 2 decades. So they went from 0.1% in December 2021 to 5.25% in December 2023. So the aim of this paper really is to examine the transmission of monetary policy through mortgagors in the latest policy tightening cycle, and to examine how household finances, especially across spending, debt, and savings, have reacted to this. So we examined 2 questions in this paper. The first one is we want to very simply understand how UK mortgagors have responded to the latest policy tightening cycle. And in particular, we want to quantify the cash flow channel. So the idea that higher interest rates lead to higher mortgage repayments, which reduces household disposable income and leads to balance sheet adjustments. The second question is around kind of examining heterogeneity across mortgage flexibility. In particular, because households in the UK, when they refinance, they have the ability to modify their loan characteristics. And we really want to see how kind of modifying these loan characteristics affects borrowing, savings, and debt responses in the UK. We find that around 30% of the households in the UK have indeed modified their loan characteristics at refinancing, not just in the latest tightening cycle, but across time. And they do so mainly by kind of changing the amortization period over which the loan is repaid, or by extracting equity. So the idea is that an increase in the amortization terms really is used by households to reduce debt servicing ratio. So if you kind of extend the amount of time over which you kind of repay your loan, mechanically your monthly mortgage payments get smaller, so your debt becomes more affordable. But we've also seen that some households experience nominal house price appreciation between refinancing events, including in the latest policy tightening cycle, which really allowed them to borrow against collateral by extracting home equity. And this is what we will call in this paper the collateral-driven borrowing channel. So I won't do a full literature review here, but I just wanted to mention a few papers that are most relevant to ours, and to say that our kind of major contribution is to the literature that examines the transmission of monetary policy shocks to mortgagors via the cash flow channel. The first paper that I wanted to mention is DiMaggio et al. 2017, which kind of similar to us focuses on adjustable rate mortgages in the US, but they look at these mortgages when rates decrease. He finds that around a 50% decline in mortgage repayments in the US lead to around 35% increase in car purchases. Flodden et al. In 2021 is another paper that uses Swedish data also on adjustable rate mortgages, and finds that a 1 percentage point increase in central bank rates decreases spending by around 0.2%, but they do the analysis in comparison to households with no debt. So they compare mortgagors with households with absolutely no debt. And then the third paper that I wanted to mention is Kartashova and Zhu from 2020, which uses auto loans and spending financed by unsecured debt to look at both rate cuts and a period of tightening monetary policy. And really, they find no meaningful response in the contractionary case, but they find that spending goes up in the expansionary case. So then kind of our contribution to this literature comes from kind of 3 angles. So the first one is around data improvement. So in this paper, we use transaction level data, so very granular data on spending, liquid savings, and unsecured borrowing at the household level, which kind of gives us a nearly complete view of households' balance sheets. Our second contribution is in terms of the kind of a novel configuration that we look at in this paper, which is we're essentially looking at the period when rate rises were really accompanied by a period of very robust house price appreciation. And this has been different to the literature so far, which kind of generally looks at rate cuts that are associated with house price booms and equity extraction. So kind of we are able to observe really the opposite of that. And then our third contribution is in terms of this kind of novel mechanism that we look at, in that we're interested in kind of mortgage flexibility, in how and in how that changes kind of mortgage borrowing and refinancing, how that affects the monetary policy transmission, and ultimately kind of balance sheet adjustment. So we will claim that this is a very important consumption smoothing mechanism via which households can weather the impact of the monetary policy tightening. So in terms of the data, we use two data sets. The first one is Exact One Clear Score, which covers the period of 2018 to 2024. This really this data comes from a budgeting and financial advice app. So it gives us detailed transaction level data via open banking. So just imagine your kind of bank statement with all the transactions there. We can observe everything. So for every transaction, we observe whether it comes from a current account, a credit account, or a savings account. We can observe transaction date, the description of the transaction, the amount, whether it's in credit or in debit, the merchant, and the balance in that account at the end of once the transaction is made. We then merge this data set with the product sales database in the UK, which essentially gives the universe of all the mortgages issued in the UK, both at the stock and at the flow level, and has very granular information, both on the loan characteristics, so kind of LTV, LTIs, interest rates, house prices, and so on, but also kind of household level characteristics, such as income. We merged the two data sets based on date of birth, partial postcode, the mortgage payment that we see in both data sets, the reporting period, and the mortgage provider when it's available in ClearScore. And then once we clean the data, we have around 55,000 remortgagors and approximately 1.6 million observations between 2021 and 2023. Just one note here, because we want to kind of look at refinancing, we only look at kind of remortgagors. So we kind of exclude from the data first-time buyers and households who move between properties. So we only look at households who stay put, but then kind of refinance their loans when the time comes. So I just wanted to give a bit of a sense of how representative the matched ClearScore PSD data is for us. So the chart on the left compares household weekly expenditure in the UK in the matched data set in blue, I think, with data from the Office of National Statistics in orange. And as you can see, with the exception of kind of transport and maybe recreation and culture, our match data set does a pretty good job at capturing weekly expenditure relative to the Office of National Statistics. The two charts on the right show the distribution of LTV and income in our matched ClearScore PSD dataset against the universe of all loans in the PSD. And again, you can see that kind of with the exception of the very low tail for the LTV distribution, we are kind of pretty good at matching the two distributions relative to what we see in the whole of the PSD. So in terms of the methodology, I wanted to highlight three kind of key aspects of our identification. So the first one is that we exploit the exogenous nature of contract expiry in the UK, and this term has been introduced by Cloyne et al. In 2019. So the idea behind Cloyne is that when households choose a fixation period, they cannot perfectly foresee the macroeconomic conditions that they will face when their fixed rate contractual period ends. And as a result, the timing of refinancing onto a new fixed rate period is really independent from current household characteristics. So it's only kind of correlated with previous household characteristics. The chart on the slide essentially shows that indeed the majority of the households in the UK refinance at the end of their fixation period, or kind of in the months around when their fixation period ends. And this is mainly due to very high refinancing costs for breaking fixed contracts in the UK. So they kind of range somewhere between 1% and 5% of the outstanding loan amount if people want to refinance earlier than they should. So this is quite punitive, and because of that, households don't really refinance earlier. The second aspect of our methodology that I wanted to emphasize is that we examine mortgage flexibility at refinancing as a standard debt management response to shocks. So this is quite important because what we see in the UK is that households don't really use mortgage flexibility because they struggle with financial resilience. And indeed, we kind of remove households who are either kind of receiving forbearance from their lenders or are in arrears from our model completely. And then analysis, probability estimates from this data show really that mortgage flexibility in our data is strongly correlated with higher property value, with higher incomes, and with lower savings. So what we see is really that kind of wealthier households, presumably those with more financial literacy, that are taking advantage of this mortgage flexibility more than households kind of who are in a poor financial situation. And also what we find, which we think is quite striking, is that there's no decline in these measures in the hiking period, in the policy hiking period, despite the rising rate. So the table shows the proportion of households who use mortgage flexibility at refinancing prior to the hiking period, so prior to December 2021, and during the hiking period. And you can see that around 70% of the households are not modifying their loans in any way at refinancing, and that stays pretty stable across time. And then around 30% do use mortgage flexibility, and out of this 30%, around 23% are extracting home equity, and the rest are either extending mortgage terms or are kind of using both mortgage flexibility measures at the same time. And then finally, we run a difference and differences event study with regression kind of pasted on the slide. So a few things to note here. First, we compare households remortgaging between June 2022 and December 2023, which is our treated units, with similar households remortgaging between January and December 2021, which is our kind of control units. And we asked that our controls are not remortgaging again in the hiking cycle. We also, and we think this is quite important to deal with some endogeneity issues, we compare treated and controls who make the same mortgage flexibility choices at refinancing. So in this way, we kind of ensure that the treated and controls are comparable in terms of the mortgage flexibility choices that they may choose. We control for a number of demand-driven factors, such as LTVs, income. We have time-invariant household characteristics, as well as time-fixed effects, which cover kind of broader time-varying economic shocks. And then finally, we control for the months around refinancing in order to absorb any baseline effects that are due to the remortgaging event itself. So we kind of know from previous studies that just the act of remortgaging kind of may make households to behave in a different way. The fact that their mortgage would change in some way would cause some potentially some behavioral changes. And we want to make sure that we control for that in our regression, so that really the remaining variation that we capture via the kind of the second term in this regression is the effect of the tightening cycle alone. So not the effect of refinancing, but the effect of kind of having to refinance in the hiking cycle, the effect of the interest rates. So before I go on to the result, I just wanted to very quickly show that household characteristics and mortgage flexibility choices are very similar across treated and controls. So I just highlighted kind of the mortgage flexibility bit in here. So between treated and controls, the proportion, we have a similar proportion of households extracting equity between the two groups. We have a similar proportion of households extending terms, and the amount of equity extracted is around like 35,000, which is again very, very similar between treated and controls. So these two groups are quite comparable for the purpose of our analysis. So I just wanted to highlight 3 findings, and then if I have time, I'll go into some robustness checks as well. So the first finding that we have is that mortgage flexibility really played a big role in the transmission of monetary policy during this tightening cycle. So the chart shows aggregate non-housing spending for households with and without mortgage flexibility. So just taking all these three lines in turn, first we find that households who do not adjust their loans at refinancing, which accounts for about 70% of the sample, cut spending by around 5% on impact, with the declines quite persistent over the following 6 months. So this is the blue line in the chart. Households who do modify their contracts, around 30% of the sample, they actually increase spending by around 6% at the refinancing event. And then when we put this all together in aggregate, we find that consumption declines only temporarily, which really suggests that loan modifications do play an important role. And by not distinguishing between these two, we kind of miss very important heterogeneous effects. One other thing to mention here is that the trends before time zero, the trends for the treated and control are very much overlapping and not statistically significant. So that basically is indication that there's no evidence of anticipation for the controls, even though this is a perfectly expected shock. They know that at time zero, their interest rate is going to go up, and so is their monthly mortgage payments. Households don't do much to kind of change spending in anticipation of that. The second result is that these positive balance sheet adjustments that we see are due to the collateral-driven channel, and especially are due to nominal house price gains for these households between refinancing events. So the two charts on the slides show aggregate non-housing spending and savings for the household extracting home equity. And then we split these households into two groups. Those who observe very small or modest house price increases since the previous refinancing event. Those who see house price gain going up by somewhere between 25 and 50% since the last refinancing event, and those who kind of see very large increases in house prices since their previous refinancing events. And what you can see from the charts is that really households who experience property price appreciations in excess of 25% are really those who kind of use this equity extraction and channel it into spending. And then in the paper, we go into more detail to show that this is kind of mainly durable as well as non-durable spending that this goes into. And then similarly, the higher the house price kind of appreciation since the previous refinancing event, the higher the saving balances of those households. So those households actually withdraw home equity, and then they increase their savings balances, which kind of is high and remains very persistent over the following 6 months, as you see by the green line. And then finally, the third finding is that within the collateral-driven channel, results are amplified by households extending mortgage terms. So what we show on the slides is non-housing spending split between those who extract equity and also extend mortgage terms in red, compared to those who extract equity and do not extend mortgage terms in blue. And what you can see is that when both mortgage flexibility measures are used, this kind of increases spending relative to controls by around 20%. Now, this channel, so the extension of mortgage terms is really not a new channel. Mortgage terms have been extending in the UK for a very long time. So for instance, the average length of a loan in the UK was around 23 years in 2013, and this increased to almost 28 years in 2024. So this is not a kind of a channel that's been present in the previous policy tightening cycle. It's been there for a long time, so this is very likely to matter for future cycles as well. And then in terms of robustness, I just wanted to say that we've shown before that prior to time zeros, controls and treated behave in a very similar way. So there was no evidence of anticipation effect. But then still a question remains on whether kind of households who are treated at different points in the cycle and exposed to different interest rate increases may behave differently, also because they kind of adjust their expectations, and as interest rates continue to increase more rapidly than expected, then they may start anticipating some of those effects and insurance against those. So the chart shows non-housing spending for households who don't use any mortgage flexibility, as well as the unsecured debt repayments of those households. And in these charts, we split households into those who are treated early in the tightening cycle. So in 2022, when interest rates, central bank interest rates were around 1 to 2%, higher than they used to be, versus those who refinance late in the hiking cycle. So in 2023, when interest rates had peaked to 5.25. And really, what you can see from this chart is that the behavior of these households is not really that different. So late treaters consume slightly less on impact, but kind of other than that, they don't really, there's no other sign of anticipation effects. And then finally, the last set of results that I wanted to show is around heterogeneity across liquidity buffers, which is driving the results for households using the collateral-driven borrowing. But there is still a role for income in driving some of the heterogeneity as well. So the charts show non-housing spending, saving balances, and unsecured debt repayments for households who enter the refinancing event with low levels of savings, so who have liquidity constraints. And then within those households with liquidity constraints, we split them into households either in the top quintile of the income distribution or the bottom quintile of the income distribution. And what you can see, so starting with the chart on the left, is really that regardless of income, households who have liquidity constraints entering the refinancing event behave the same. So they both increase spending by about the same. Where income does become relevant is really for other areas of balance sheet adjustment. So what we can see is that households with low level of income, as well as kind of liquidity constraints, increase their saving balance. So use some of the equity extraction to increase their saving balances as well. Whereas households with high levels of income use some of that equity extraction to really repay their unsecured debt faster and consolidate their unsecured debt balances. And this is not as outraging as it seems, because even in the hiking period, borrowing secured was still much cheaper than borrowing unsecured. So they basically kind of use some of that cheaper funding to finance the more expensive debt. So just to finish off with some policy implications for the transmission of monetary policy. So really, this tightening cycle caused brief aggregate spending cuts. But these effects have been shaped by heterogeneity in mortgage flexibility, which influence the monetary policy transmission. So on one hand, we've seen that rising rates induce larger spending cuts for those households who did not adjust their loans at refinancing. We find that spending decreased across most expenditure categories with very little evidence of kind of spending reallocations. But then on the other hand, we've seen that monetary policy transmission was weaker for households who did use mortgage flexibility measures, such as equity extraction and mortgage term extensions. And we've seen that kind of this was very much amplified by households who've experienced large nominal house price gains between refinancing events. There is a question for further research, and especially for policymakers to ponder. On one hand, this mortgage flexibility made households more resilient because it allowed them to respond to the increase in monetary policy shock without defaulting on their loans. But on the other hand, it made them more indebted, which means that it could make households less financially resilient to future shocks that may hit the economy. Thank you.
Discussant is Jean-David Sigaud from the Research Department of the ECB.
Thank you, and thank you for staying until the very end. Let me jump right in. So in this very nice paper, they asked the following research question. What happens if there's an increase in mortgage interest payment? What happens for consumption? And they have the data to answer this research question. They are able to take mortgage data and consumption data and to merge the two together. What are the results? They find some aggregate effects. Upon impact, they see a decrease in current consumption. I think upon impact is 5%, and then 3% by the third month. Interestingly, they find heterogeneity. So for the households that did not modify their loan, they find that the drop in current consumption is persistent, whereas the households that did adjust their loan by extracting equity or increasing the term, they do not find that drop in consumption, especially for non-durable and transfers. They have other results. They find that equity extraction was made possible by house price gains and also used to repay some unsecured debt, and that the term extension amplified the effect of equity extraction by lowering monthly payments. So now what I'm going to do is, suppose I don't know the findings, okay, and I want to make some predictions about consumption. How would I do that? I would have a setup with some households that face a mortgage rate increase at time t. And these guys must reallocate consumption across today, time t, tomorrow, time t plus 1, let's say within the next 5 years, so near future, and then retirement, t plus 2. If you put enough heterogeneity, you would have 3 types of behaviors. Some households will not do anything, okay? So basically, they would take the hit on their current consumption at t and probably at t plus 1. But by doing so, they will preserve their retirement consumption. And you may want to do that if, you know, at retirement, you think you're not going to have a lot of savings left. Some people will use their savings, and so that would smooth consumption. So their current consumption will not change so much, but that puts a little bit at risk their future consumption. And same for borrowing. Some people will borrow and smooth consumption, but by doing so, you make a promise to repay via your future savings. Now, regardless of the strategy, your lifetime consumption is going to decrease eventually. If it's not today, it will be in the future. Very importantly, we would expect that households are forward-looking. Okay? So they're not going to wait their refinancing date to act, to change their consumption pattern. They should act as soon as they see the interest rate increase. Now, if I compare this prediction with the findings, most of the findings are here, but a couple are not. So the first finding is some households did not modify their loan, and that's what they find. And they suffered a drop in current consumption, so that's consistent with my first hypothesis. Second finding, some extracted equity or extended the term of their loan, and they did not suffer a drop in current consumption, let's say in 10 years, but at least in current consumption, they did not decrease consumption. The third finding is it was not that prominent, I think, in the presentation, but the authors do not find that households are using extensively their savings to smooth consumption. Okay? So my second hypothesis is not there in the data. And that's going to be the first focus of this discussion. They also find that everything happens after refinancing, as if households were not forward-looking. And that's going to be the second focus of this discussion. So let me speed up a little bit here. So the first focus, why didn't households use their savings? And I tried to come up with 3 candidate explanations. The first one is, you may say, okay, households do not have savings to begin with. That's plausible for some households, but not for the average households. If you look at the data in the paper, you would see that the average savings is around 5K pounds, which and the monthly payment increase is around 150 pounds a month. So if you do the NPV of that, you would find an NPV of around 8K pounds. So yes, the average saving is not exactly the NPV of the increase in mortgage payment, but it's quite close. They could have used that. So the first explanation is maybe not the prominent one. Second explanation, maybe they want to keep their precautionary savings for a future shock. Why not? But why not using their saving for this shock? I mean, precautionary savings are exactly made for that. You have a negative shock, you use them. The third one, the one that I like the most is, yes, they have savings, but they do not have precautionary savings. These savings are earmarked for something else. Holidays, retirement, what have you, but they will not use them to smooth at least their current consumption. I would encourage the authors to test or at least discuss the possible channels, because for me it was a bit of a puzzle. Second focus of the discussion is, why do households act as if they were not forward-looking? And again, I came up with 3 explanations, and they're not equally likely, I think. So here are the first 2, and next slide, the third one. The first explanation is they have extreme short-sightedness. What they do, they wake up at each period, they look at how much cash they have in the bank account, and they consume accordingly. That's a possibility, but it's extremely unlikely, because it means that they do not even look one period ahead. They live period by period. Okay. I think we can do better for an explanation. Maybe, second possibility, they expect rates to mean revert. So they've seen an increase in interest rate, but they think, by the time I'm going to have to refinance, the interest rate would have gone down. That's also a possibility, but it's also extreme, because it means that the household that is 1 month from refinancing and have seen a 300 basis point increase in interest rate would expect a reversion, which is, again, unlikely. Let me propose a third explanation, which I like the most. If you look at this chart and you look at the blue line, for example, and consider households that did not modify their loan, not like households that do not want to modify their loan, but households that tried to modify their loan and the banker said no. Okay? Imagine that. And so you would have the blue line, the one that were negated a refinancing. From period -1 to 0, they receive the bad news from their banker, and they have to suddenly reduce consumption. The green one, they receive a good news from the banker, and they increase consumption. Ex ante, what do? They form expectations about their likelihood of being granted a loan modification. Okay? So you see for the blue line that the coefficient is negative, but you see very high confidence interval. Why is that? Well, the econometrician will find very large confidence interval because some households are going to overestimate their probability to be granted a modification, whereas other households will be more realistic. Okay? So they are forward-looking. They ex ante form expectations about their ability to extract equity from the banker. Some will be lucky, some won't. And that's why it appears that households are not forward-looking, but they actually are. And I would like the authors to explore a bit more. I'm out of time, so It's a very interesting paper. It quantifies how rising mortgage rates affect consumption, and they find some interesting heterogeneity. To me, there are two open questions that remain to be dealt with. Why not using savings, and why do households act as if they were not forward-looking? I very much enjoyed reading the paper and look forward to the next version. Thank you.
Okay, let's collect. Shall we go the other way around, or you feel an urge to answer immediately?
No,
because
we can
I'm not
collect.
sure like how. You have a question?
Is that allowed? Yes.
It is allowed. Yes.
This is maybe suggestions, but I think your paper is very interesting. When you were presenting, I was thinking that maybe part of the story that so many people extend the mortgage instead of cutting spending could be that this happened during a sort of cost of living crisis, that people couldn't cut spending because that meant spending less money on groceries and food. And I thought from there that there's further interesting questions there, right? So I was wondering, did you look into kind of, are these effects different across the income distribution, that maybe the guys who cut, or also, are you able to see from your data set, when people cut spending, what were they cutting? So were they spending less money on, say, fancy hotels or sort of frivolous things they didn't need? So they said, I'm not going to extend my mortgage so I can have a nicer hotel, so I'll cut my spending. Whereas the other group were maybe saying, we can't. We have to keep buying groceries. So I was wondering, did you ever look into, what got cut? And can you see that? And did you ever look into maybe a different way to do that is to see if wealthier households were more likely to not extend the mortgage and cut spending versus maybe less well-off households? Or on the flip side, it could be that the less well-off households are less likely to be given an extension. And then from that, we could say something about financial stability, because that cohort is more likely to default and their banks are less flexible. So I was wondering, if that was something you were able to look into, because I think the paper is fascinating, but that would be more interesting again.
Okay, let's collect a little bit more, and then Livio, give it a good example of having some energy at the end.
Energy is a strong word. I have two questions. The first was exactly like Ellen, so perhaps I just put also my weight on the same question. I mean, I was thinking and saying that this probably was during high inflation period, and this must make a difference for that. The other point, which was the point of the discussion, so the using savings as, I mean, I'm not an expert of savings, but I just don't know anybody in real life who uses savings in that way. So, it's a way that we economists imagine. It is in our models, but I literally haven't met anybody who thinks of saving in these ways, in a kind of consumption smoothing way. So, as you said also, they have savings for specific, but the idea of countercyclicality or smoothing, I mean, I literally did not meet anybody who has this way of thinking. So it just exists in our models, but it just doesn't exist. So that could be the answer, but again, I'm not expert enough of the literature to say that I'm right. Thank you.
Looks like we're running out of questions. So, no, okay.
So I'm sorry if I missed this, but I didn't understand what drives whether or not the borrower gets to change the terms at all.
Alexander. Yeah.
Should I?
Yeah.
So thank you very much for your comments and for reading our paper so thoughtfully and thoroughly, and for all your feedback. I think it's spot on and it's great. So thank you very much for that. So I'll kind of answer these questions in turn. So in terms of why we didn't use savings, so we do have some versions of our regression analysis where we do include liquid savings as a kind of robustness measure. We just didn't put them in the paper. They don't yield anything else. And the reason why we didn't pursue it further is because in the data, we really can see kind of what people have left into their accounts, but we cannot see if they've invested their savings into kind of illiquid investment accounts. So for instance, we can see transfers from their accounts to Vanguard, but we cannot see how much they've invested there across time, especially if they've been in the data for much longer than kind of 2018. So that was kind of one of the reasons why we didn't pursue this further. But I take your point that it's an important kind of potential way in which people could kind of consume and smooth their spendings. The other point to make here is that indeed this period coincided with the cost of living crisis. So the uncertainty shock, both around kind of interest rates going up, but also around income, employment, it was really high. So I don't think it's implausible to think that people, especially those who maybe found it hard to tap into unsecured debt if they run into trouble, I don't think it's implausible to think that they just set some savings aside and then they kind of adjusted consumption as a response. In terms of why they're not forward-looking, we were asking ourselves the same question as well. And the literature does support the fact that households are not generally forward-looking. So there are two kind of Nordic papers that come to mind. One is on mortgage payment holidays, where some households were giving some mortgage flexibility because they were in financial, they were struggling financially. They consume out of those mortgage payment holidays up to the point where they expired, and then they started kind of decreasing consumption. And then there's another kind of paper also on very granular Nordic data that looks at households who were on interest-only payments, and then they knew when kind of the interest-only repayment stopped and the capital and interest-only repayment started. And then again, they didn't react at all in kind of anticipation of that, even though it was kind of very clear, and the bank sent them letters to remind them of the exact date. Both papers, although kind of they're not able to test it, but their hypothesis and ours as well is that people generally are quite myopic.
I try to save the households, but maybe there's no saving.
Yeah, so they're generally quite myopic. And also what matters for them is cash in hand. So what matters for them is really kind of how much I can spend this month. And then if next month interest rates go up and I get an income shock, then I adjust back then. But there's no point, not buying an extra iPhone today if I can afford it. So that's kind of the way we see it. In terms of kind of why households were denied mortgage flexibility, I think denied is the wrong word. In terms of equity extraction, they were able to do it if they wanted to do it, as long as they're kind of repaid enough of their mortgage and their loan to value went down. So the way that it works in the UK is that unless you are kind of very close to your credit limits, the bank won't deny you equity extraction if you've repaid your loan kind of long enough. So if it had decreased, you can kind of essentially bring it back to where it was initially, and the bank will be happy with that. They will do, of course, some kind of tests on your kind of ability to repay your loan, but they will do that. With the mortgage term extension is kind of the same story. So we've seen evidence from banks in the UK that they will lend up to where kind of the borrowers are nearly 80 years old. So they will extend the terms as much as they can, so up to well into retirement. So as long as the mortgagor kind of meets this 80-year-old threshold, then they are able to extend their mortgage terms. So what we think is happening here is that just some households don't know that these mortgage flexibility measures exist, and they don't take advantage of these, rather than kind of the fact that the lenders would deny them. It's also in the benefit of the bank to essentially extend mortgage terms, because then their interest profit is increased. And then on the question around whether we looked at the distribution of income and different spending categories, we haven't looked at the distribution of income, so we mainly kind of focused on households using home equity extraction. But I think this is something that we definitely should be looking at. But what we did look at is kind of changes across different spending categories. So we've seen that for the households not using mortgage flexibility, they've reduced spending across all of the consumption categories. So durable, non-durable, groceries, investments, cash, everything, they've kind of reduced. And especially the fact that they pulled back on groceries, it was quite puzzling for us. Like you could kind of presumably reduce other areas of spending rather than reduce your groceries. What we did find is, so we looked a little bit into this, and households didn't really go to retailers that were cheaper. So they stayed with the same retailer, but they just consume less. So what we're thinking happening there is that they just swap to kind of essential goods or kind of less costly products. Yeah, I think I've addressed all of them. So yeah, thank you very much for all your comments.
Thank you, Alexandra. So then we are approaching rapidly the end of this year's Macroprudential and Financial Stability Conference. It was a bit of an experiment this year because it combined this first day together with the Federal Reserve of New York on non-bank financial intermediation with the more traditional program day on the macroprudential and financial stability research. I think it worked very well, actually. So we had an emphasis on a very topical topic where we all know that we need to make a lot of progress on the NBFIs on the prudential front compared to the banking sector, where there's the framework, the prudential framework is quite, and the safety net, to say, is actually quite elaborate. And so in terms of the NBFI research, my impression from the first day was, apart from the high quality of the papers, was that the often asked for differentiation between the different risk characteristics of different NBFIs was really reflected in the program. So we even learned, of course, for example, there was this example from the insurance sector, that even within the insurance sector or within the life insurance sector or with the different, there can be very different reactions to different shocks in terms of financial risks. And the program also included on the NBFIs very new developments like these, for example, just pick one example, research on these synthetic risk transfers. So the research is quite at the frontier of also of current developments, which is very promising. While the differentiation is there, so the research starts to treat these different NBFIs differently. Obviously, we have to recall what I think Doug Elliott said based on his book on rewiring the financing machine, is that in the end we have to, for the macroprudential perspective, we have to put the dots together again. We have to look then, once we understand the individual components, we need to look at the system again. And this is really truly important. Then on the second day, on today's day, so I learned that we have ever more macro-financial models now that put financial instability into macroeconomics and into general equilibrium frameworks, which is very good news. So there was tremendous progress in the last 10 years in this regard, and we saw one or two of them in this conference. And we have ever more diverse research on different financial intermediaries, markets and business models on the macroprudential side, and the program was very reflective and of high quality in this regard. And Cornelia started the conference yesterday morning listing the 3 financial risks that are on the top of our agenda, and you can read them in our Financial Stability Review and in other publications and speeches. So let me make one remark on macroprudential policy, even though one of a more general nature. So a key point remains, and we should never forget, that a truly macroprudential approach to prudential policy requires that all risks in financial systems and their real economy implications are treated in a proportionate way, and irrespective where they are located in the economy. So once you have achieved a prudential framework of that way, actually, I may even, so maybe it's utopian, but if you think about the talk by Thomas Philippon, where he said that actually microprudential and macroprudential are complementary, here, from that benchmark of a fully developed macroprudential approach, although we are not there, my hope would be that one day, actually, we can lighten prudential policy at some end to the benefit of the financial sector, because if we can keep the system stable, we can have individual components fail, which is not really the case in all dimensions, as we all know, at the current juncture. So maybe that's a point of discussion. But as I said, I'm afraid that despite the significant progress since the great financial crisis, that means in the last 10, 15 years, it was tremendous, I have to say, on the macroprudential was tremendous. If you look at central banks today, it's not, or other bodies, the European Systemic Risk Board or the Office for Financial Research in the US, the Financial Policy Committee in the UK and so on, the world is not anymore the same. But we are way not there in this benchmark that I just set in the terms of the proportionate treatment of risks in both supervision and regulation in all components of the financial system, unfortunately. And as you all realize, times are not good to complete the business. Times are not good. And that reminds of a historical regularity of cycles of crisis, re-regulation, deregulation, and then question mark. No? So I think prudential policymakers need to be very attentive if we enter a new cycle of relaxation, let me put it this way, that we do that in a way that cuts bureaucracy and red tape, but that doesn't neglects risks. But the good news is from this conference, if you look at it, is that actually the research is not subject to this problem, in my mind. I think the researchers are alive and kicking. It has become very good and quite encompassing. I have to say, if you take the range of issues that were addressed over the last 2 days, it's a lot of things over there. Of course, there were some things that were not there. What are the financial stability risks of artificial intelligence penetrating the financial sector, say, for example? Or like, how bad can trade conflicts be in terms of some aspects of the financing change or the financing of supply chains and other? I think they were not there, but I'm sure they will come. The broad analytical toolkit, in my view, is now there of macroprudential policy being supported by research, and most of the data, not all of the data, because the financial system is dynamic, there's innovation, we want innovation, and then sometimes, I don't know, LDI crisis, question mark, in the heat of the moment you don't have the data, even though afterwards you can do research about them, so we need to be mindful. But most of the data, if you think about our credit registers and so on, we have seen many papers, here also, the data also mostly there. Overall, we had 15 papers, a keynote and a panel, and the panel actually sneaked in 2 more papers, I believe. So actually it was a very full program. And if I look at, so we had this nice emphasis on real estate. So we should always recall that the most of the worst financial crises came from real estate problems. So many of the great systemic crises in history have come from them. So it's always good to have a reminder of that, even though the papers didn't focus on those, but we saw a lot of risk channels. So it's very, very good to have one emphasis in the program here to remember that and to make sure that we become better in managing that in the future. And then my last point is that, and there I make the circle to yesterday's dinner speech from Randy Krosner, is that actually the most frequent topic of the papers was actually monetary policy transmission, I counted. So it was like, I counted 4 papers. It's either 3 or 5 or 4, depending on what emphasis to put to the different sections in the papers. But it was the biggest topic, and I think this is rightly so. Because if you think about the central banks, our objective in terms of price stability, then the monetary transmission mechanism is what enables us actually to cushion the impact of financial distress on achieving our primary mandate. And therefore, an emphasis on monetary transmission is justified, and that's reflected in our 2021 strategy review, where there is this focus on monetary transmission in our preparation of the monetary policy also, and potential disruptions of the transmission mechanism from financial instability events, and that's one emphasis. There's a couple of others that I won't mention. And we're going to have a new strategy review. We are like, I think, reaching the end of it slowly. So I hope that actually this aspect of our strategy that is important and was emphasized by Randy, saying that we need in the strategic framework of central banks, financial stability must have an important place. And I think we do have an important place in our policy strategy. That was it. I conclude with thanking again the organizers and all the people supporting this event. So among the organizers from the European Central Bank, those who are still here can raise their hand when they hear their name. So I'm sure all are here. Markus Behn from Johannes Breckenfelder, Madeleine Castells-Jaragi, you are here. Very good. Maurizio Habib, Christoph Kaufmann, Angela Madoloni, and Livio, of course, Livio Stracca from our Financial Stability Department. And then for the first day from the Fed New York, this was Nicola Cettorelli and Fulvia Fringuelotti. I hope I did manage to pronounce that. And then, not the least at all, last but not least, there's the support from our business area assistants, Daniela Polastrini and Novak Novakovic, probably not here anymore. Then the DG from our communications department, the meeting support, Stefan Seitz, there in the back, Nasser Hanafi. Yeah, the applause, you can do it at the end. The list is huge. I mean, I'm sorry. It's a so-called level 1 conference, so it's the top of the conferences. So it's actually very, very, very professionally supported. Anya Sinch and all their colleagues that probably somewhere in the booths and in the back office. And our trainees who made sure you could ask your questions with the microphones, Paolo Baudino, Fabian Wagner, Kleidas Petrevicius, Philippos Philippidis, Mathilde Valla, Olivier Wolf, and Anna Ruffert. Wow. Thank you very much. Have a safe trip home.